Good morning, everyone. Thank you very much for joining us. My name is Emma Nicholson, and I'm with the Federal Energy Regulatory Commission's Office of Energy Policy and Innovation. We're having a conference to discuss Regional Transmission Organization and Independent System Operator, or RTO and ISO, energy and ancillary service markets in the evolving electricity sector. This is the fourth technical conference the Commission has hosted this year in a series of technical conferences called Modernizing Electricity Market Design, and docket number AD 2110. Today's conference will be the second of two conferences this fall that will focus on energy and ancillary service markets. And the first conference was held last month on September 14th. Before we begin with opening remarks from our chairman and commissioner, I wanted to communicate some logistics of the conference. We'll have two panels this morning, followed by a lunch break, and two panels this afternoon. Panel one will start immediately after the opening remarks. The conference is being webcast, but it will not be recorded for future viewing. With these initial remarks out of the way, I want to introduce our Chairman Richard Glick, for his opening remarks. Thank you, Mr. Chairman.
Thank you very much, Emma, and thanks to the team for assembling this very important technical conference. I think this is going to be a very interesting staff-led technical conference today. And I also want to thank the panelists for taking your time. I know everyone's busy, but taking up your time to participate today. We really appreciate that. As Emma mentioned, today is the second of the two technical conferences we're having on energy and ancillary services market reform, and very interested to hear everyone's views on the subject. During the first conference, we kind of looked at it from macro level and examined some of the energy and ancillary service market reforms that might be needed to address the changing resource mix. Today, we get down into more of the detail, kind of the nitty-gritty, and the first two panels are going to focus on how resources offer their services into RTO and ISO markets. The third panel is going to talk about how these markets actually select least cost resources in the various markets around the country. And the fourth panel is going to focus on out-of-market actions, out-of-market activities, and how that impacts the energy and ancillary services markets as well, in terms of what we're looking at today. So again, I want to really thank everyone for participating today. I think it's going to be an interesting conference. I think I'm going to be here for most of it. Unfortunately, got a couple of conflicting appointments, but for the most part, I will be listening intently, certainly following the record, and really look forward to the discussion today. Before I turn it back to you, Emma, I'm going to ask our colleagues if they have opening comments, and I'll start with Commissioner Danley.
Thank you, Mr. Chairman. I appreciate it. I don't have a whole lot to say in preliminaries, except that I appreciate everybody being here, and I look forward to the discussion. I, too, will be coming in and out as necessary for other appointments today. The one thing that I want to say is that in those markets that have capacity markets, even though I acknowledge that there are any number of potential valuable reforms to the energy and ancillary services markets, those reforms cannot take the place of a properly functioning capacity market in those cases where there is one. So I just want to make that point before we begin. And I look forward to listening to the discussion and reviewing the transcript once everything is completed. Thank you, Mr. Chairman.
Thank you, Commissioner Danley. Commissioner Clements?
Thanks, Chairman Glick, and good morning. It's nice to see you all. Thanks to staff for putting on this second technical conference. It's a lot of work under good circumstances, certainly, as we continue to do these virtually. We know you're putting in a lot of time, and my advisors and I really agree that this agenda is really excellent. I look forward to learning from all of today's panelists. As the chairman said, it's really getting into the weeds, which is a place I like to be. I'm thinking I'll learn a lot from all of you and all of the panels. I won't be in person for the fourth, but we'll get to see that later. But in particular, three things come to mind for me. First is whether and how the existing market rules resource offer, and whether those rules are promoting the inclusion of the costs that resources are incurring for being flexible. Second is the extent to which self-commitment and self-scheduling rules are impacting the flexibility available to operators. I know some of your pre-conference comments covered this. And then Third, whether eligibility and offer rules are falling behind advances in the capabilities of newer technology resources, such that those rules may be acting as a barrier to full participation. So with that, thanks for being here today and for investing the time.
Thank you, Commissioner Clements. Commissioner Christie?
Yeah, thank you, Mr. Chairman. I just would like to thank staff for all the work that you did putting these on. These are very time-intensive, very energy-intensive, no pun intended. And so I really want to thank staff for all the work you put into these. And also want to thank the panelists. You put a lot of time in as well. And so I want to thank you for that. I'll be listening today. I don't think I'll have any questions. I'll reserve the right to jump in with one, but I don't have any planned. So I'll mainly be listening and learning. And again, thanks to everybody who put all the work into putting this conference on. Thank you, Mr. Chairman.
Thank you, Commissioner Christie. And now I'll turn it back to Emma to get us started today. Thank you, Emma.
Thank you very much, Chairman Glick, Commissioner Danley, Commissioner Clements, and Commissioner Christie for joining us today and providing opening statements. We will now proceed to our first panel for today. I really appreciate everyone for joining, and I thank our panelists. This is the first of 4 panelists, and panel 1 will focus on incentives that RTO and ISO system resources have to offer their operational capabilities into the market, the energy and ancillary services market today. Again, my name is Emma Nicholson. I work in the Energy Regulatory Commission, or FERC's Office of Energy Policy and Innovation. And I'm joined by my colleague and co-moderator for panel 1, Michael McLaughlin, who is a director of Division of Economic and Technical Analysis in the Policy Office. And this panel will run through. And before we get started, I want to have a traditional request that all panelists avoid discussion of that are active and pending before the Commission. We issued a notice that noticed all the dockets that are currently pending. We have my colleague Adam Aldine from the Office of the General Counsel is available here to notify us if we're discussing ex parte matters, but we request that all of our panelists today avoid the types of discussions that would require us to redirect the conversation. But I'm very excited to have this conversation today in panel 1 about resource incentives and the extent to which current RTO and ISO and energy and ancillary service market rules encourage resources to offer flexibly into energy markets. So right now I will pass the mic to my colleague, Michael McLaughlin. Thank you.
Good morning, and thank you, Emma. Thank you all the panelists for being here. As Emma mentioned, I'm Mike McLaughlin with the Policy Office and have the opportunity to ask the first question of the day. First question will be addressed to all panelists. I will call each panelist in turn and will ask the initial responses are no longer than 5 minutes. After all the panelists have responded, there will be time for each panelist to respond to the initial comments made. First question. Do any existing RTO, ISO, energy, and ancillary services market rules, requirements, or procedures actually encourage resources to offer into the market inflexibly? And if so, what changes should be made? First up is Dr. Nicole Bruchez, the Principal Economist, Market Design, and
Thank you very much. First, I'd like to thank the FERC commissioners and staff for the opportunity to participate in this technical conference. In New York, our focus has been on the wholesale energy products that are needed for reliability in the face of an evolving resource mix, and at the same time, ensuring that the broadest set of resources possible can participate in those markets. Generally, the New York structure of our market rules is to increase the financial returns for resources that perform flexibly and reliably in the real-time markets and reduce compensation for inflexible units. Co-optimizing in our energy and ancillary service markets, both in the day ahead and the real-time market, causes the prices for energy and ancillary services to reflect the costs of the system providing the ancillary services, to compensate for providing ancillary services when the unit would otherwise be providing energy. This opportunity to sell different products also has the potential to encourage resources to make investments or modify operating practices to participate in those markets. These investments can, however, be costly, which is why the focus on reliability and the products needed to maintain reliability is so important. We have a very solid market design that performs very well, and market design will continue to serve us well as we look towards the grid of the future. We do not have any preference for specific technologies or resources. The market rules we have are based on the reliability needs, both the needs of our operators and the requirements of the reliability oversight organizations. In our case, that would be in particular NERC and the New York State Reliability Council. We are continually looking at our rules to increase participation because, as you recognize in this technical conference, more participation in ancillary services is a good thing. If we don't have sufficient parameters modeled to adequately model a technology's capabilities, we work on evolving the participation model so that they can participate. In the next panel, we will be talking about new and emerging resource types and what the NISO is doing to accommodate their participation models. So I won't cover it here. But I wanted to talk about two examples that are a little different. In New York, we've gone from hourly scheduling of imports and exports to quarter-hour scheduling on several of our interfaces with our neighbors to provide additional flexibility. We are even considering moving towards 5-minute scheduling to provide further flexibility. To give another example, our current rules are not completely able to reflect the ability of combined cycle units to participate in ancillary service markets. We have a current project that is looking at ways to better reflect their operating capability. Finally, you asked to the extent to which our rules account for existing fuel limitations like natural gas supplies that have the potential to impact resource flexibility. Resources bid and notify the NISO of fuel limitations, and they're taken into account in the reference prices that are developed for mitigation and obviously in the dispatch as well. That was about, I think that's it for now. Thank you.
Thank you, Nicole. Next up is Joseph Daniel, Manager, Electricity Markets, the Climate and Energy Program of Union of Concerned Scientists.
Thank you. Thank you, Mr. Chairman, Commissioners, and Commissioner staff for assembling this technical conference and for inviting me and the other panelists to speak. The first thing I want to get out of the way is to make very clear why I think flexibility is important. And those reasons are reliability and affordability. A more flexible grid will lower costs and therefore be more affordable to the end consumer. And a more flexible grid will be more reliable. And those are my priorities when I'm thinking about flexibility. And as such, I sometimes find it difficult to disaggregate some of the flexibility issues with some of the behavior that I would categorize as uneconomic behavior in the markets. I also want to recognize that the bulk of my pre-filed statement focused on questions 3 and 4 about self-scheduling, and I will save the bulk of my responses to those questions when we get to them. But in the meantime, I will just recognize that I do feel like self-scheduling and self-commitment are a limiting factor in the current grid's flexibility, and that while some of the most inflexible resources like coal steam units are often categorized as being inflexible and operate inflexible, those operations do not necessarily represent their inherent engineering limitations. Though there may be exceptions to this categorization, many coal plants are not being operated to their full potential. And when I look at the current rules that govern our energy and ancillary services markets, where I've kind of come to the conclusion that most of today's rules were written for yesterday's resources. And I think there can be no doubt that the They just have to look at any one of the ISO or RTO queues to see that the resource mix is changing. And I'm encouraged by orders 841 and 2222. FERC is clearly working to find ways to accommodate that inevitable wave of new, lower cost, more flexible resources, and those efforts are laudable. However, I think some of today's existing rules, including those governing the commitment and scheduling of resources, tend to bias towards inflexible, long lead time resources and against newer, more flexible technologies. Though these rules appear to be neutral in application in that they allow all resources to, say, self-commit, they in practice affect resources very differently. And that's one of the things that I want to talk about in greater detail later. FERC should pursue market fixes to promote competitive resources to enter the market and to offer in their full range of flexibility. And just as important, we need to recognize that the market or incentive-based solutions to this issue often rely on a fundamental assumption that power plant operators will respond to the price signals formed by market auctions that the ISOs and RTOs administer. And this assumption is not universally applicable to all power plants, particularly those in the RTOs and ISOs where most of the resources are still operated by vertically integrated utilities and these power plants are in rate base. And so long as power plant operators are out there and might be insulated from those price signals, price signal-based solutions are going to struggle to reach their full potential. That's not to say that we shouldn't pursue those. It's just that we need to kind of go into those conversations with open eyes about their limitations, and also recognize that we're not limited to sort of price signal-based solutions. Market monitors are authorized to conduct a range of oversight and regulatory functions in order to prevent, say, market manipulation and help ensure just and reasonable rates. And there are ways to sort of translate those types of actions into similar actions that govern our commitment practices in a way that will promote flexibility. And then I also, look forward to talking about a range of options I think that FERC should look at when pursuing fixes, including finding ways to help encourage utilities to operate their coal plants at lower PMINs, and also more tangible actions that the commission could take when it comes to information gathering, reporting, working with state commissions directly, and my final recommendation that kind of alluded to earlier is just that to make sure that as we make these steps towards creating market rules that will promote flexibility, we recognize the limitations to that and try to find ways to make sure that the market rules objectives actually achieve what we're solving for. And I look forward to expanding on this today with some of the later questions, and just want to thank the Commission for inviting me to speak.
Thank you. Next up is Sherman Knight, President, Competitive Power Ventures.
Thank you, Michael, and thank you, Commissioners, for this opportunity to speak. My remarks today reflect my opinions in my own capacity, not those of my company. Having said that, our company's success is entirely dependent upon really the ability to build new renewable resources, which I think is all dependent upon the ability to manage intermittent resources within the existing grid, which I think ultimately comes down to flexibility in doing so. So we are very interested in this technical conference and very much appreciate the opportunity to speak. I think from my perspective, I think that one of the key attributes here is really distinguishing between cost, value, and price. This came up actually this weekend. I had a leak in my upstairs bathroom. It dripped into the ceiling of my dining room. Shut off the water, brought a plumber over. He said, yeah, it's going to, the material is about $20. This time is about $30, and he's going to charge me $100. I was like, no problem. The cost was obviously only $50. The value to me was well over $100, and we arranged for a price. And I think one of the fundamental things with flexibility right now is that we don't have to distinguish between the value of flexibility. out there. So back to the question, I think there's two issues. Ultimately, it's ramp rate ancillary services, the volume of ancillary services. As a generator, we dispatch typically 5, 10, 15-minute intervals. We put in energy offers at various levels to for the cost of generation, and we also put in the ramp rate. The reality is there's no value distinguisher if you put a ramp rate of 5 megawatts per minute, 20 megawatts per minute, 40 megawatts per minute, or 1 megawatt per minute. You get paid the same amount in the energy market. And so the ISOs are relying on the ability for a lot of the fast ramp units currently, whether it's peakers or combined cycles, to flexibly manage that intermittent resources as they're coming on. The value to the generator is zero. There's literally no difference in terms of what one gets paid for that. And so I think, kind of going to Nicole and Joe's comments, I agree with them. I think that what that leads to is basically it would be me going back to the plumber saying, I'm going to pay you less than cost. Please do my fix. The value to me is high. I'm not going to pay you anything for it. And so he might get to my house. He might not. I think from a generator perspective, it's like maybe there's not a lot of value putting in flexibly into the ISO. Why do it? I will do what I need to, but I'm not going to really push, and there's not an incentive to be super flexible. And then part of that is then all that flexibility is going into the energy market, where in 5 minutes you're getting fluctuated up and down quite rapidly. The volume of ancillary services then needs to be procured gets shrunk, and because that gets shrunk, the value of the actual ancillary services in terms of regulation and everything else actually diminishes. Whereas if that's measured in terms of the actual flexibility across the value of the actual flexibility needed across the system, it's not truly reflected. So I would just encourage us to be candid about what actually is needed to bring on the renewable resources. Let's make sure that there's incentives out there for coal plants, to put a PMIN down, put a ramp rate higher to what their capabilities are, to not self-schedule. All of those actions are done because there's not value in the market to do so. And whether that's through the energy market, some form of incentive to show your true ramp rate, or to increase your ramp rate and make technical fixes, or put more volume into the ancillary services and make the energy market just more of a steady market. Either one can work from my standpoint, but actually finding what that value is important here. Thank you again for the opportunity.
Thank you. Next up is Karen Unaran, Vice President, Electricity Consumers Resource Council. Karen?
Great. Well, thank you so much, Chairman Glick, commissioners and commission staff, for the invitation to speak today, and of course for providing a platform for the consumer perspective, because at the end of the day, whatever we do, the consumers will be paying for it. And so in answer to the question, whether this particular rules are either hindering or promoting certain resources and the flexibility, I would say there's not a one-size-fits-all, and so that all of them could use some improvement to some extent. And I think what we really need to focus on is what is the problem that we are trying to solve? And that is not a reserve problem. I think if you look at the generation that we have available now, and even what's in the queue, we have more generation than we could possibly ever use. So what we really do want to be solving for is the flexibility to manage variability. And there are two sides to that coin. There is the supply variability, and there's also the demand variability. And they both should be at the table to focus on these issues and help solve them. So I think, one of the things that we're seeing is perhaps an over-procurement.
of resources, some of which are just sitting there waiting to be called on. And as consumers, we really want to be paying for generation that provides the services, provides the energy. I think we don't want to pay for generation just because it exists. And so I think that we really need to be looking at the variability and the flexibility as something that we need to incent. And the way that we can possibly do that is, what are the attributes that we really need and really want out of our generation, and place a value on that. So, if it's more flexibility, able to ramp up, ramp down quickly, put a value on that. If it is for longer term backup resources, put a value on that. And I think that, with those incentives, hopefully it will send the correct price signals. Now, of course, as Mr. Daniel brought up earlier, that, sometimes generation is not always responsive to price signals, but, we would hope with the proper incentives put in place that they will be inclined to, to bid into the market according to their capabilities. So I think that it really takes some reflection and looking at all the possible contingencies and what the likelihood of those contingencies, to make informed decisions. Do you know in the winter that there will be supply chain issues, potential supply chain issues? Do you know that some of your generators, are unable to perform once the temperature reaches a certain level? Are you winter peaking? Are you summer peaking? Do forecast errors, sometimes that doesn't make a huge deal. In other regions, that does. We'll probably hear from Mr. Sorensen and SPP later on that they have tremendous variable resources with their incredible wind potential. But so a forecast error in SPP has a greater impact than, say, a forecast error in a place that relies primarily on natural gas or other base load fuels. So we really want to make sure that we're measuring those contingencies and how often they may happen, place that value so that we're replying to cost signals and that price signals, and that the operators who, her or his first priority is reliability, and so he or she is not always going to rely on cost to make those decisions. And so we want to make sure that they have the tools. And then we look at the demand side of this. Of course, that is also going to be variable in the upcoming future, the near future. As we see more demand response, we see distributed energy resources. Demand is sometimes very questionable, especially as we get closer to electrification. When are people going to be charging, their cars? And so it's going to change the load profile. And so we need to make sure that we understand that profile as well and are able to respond to those customer decisions. Also, I think separately, we need to have customers at the table when we do talk about this. And that's to really gain an understanding of the tolerance level. Again, for the industrial customers that I represent, having a potential outage or, a limited outage, maybe an hour, maybe even a day, some of our customers would have a tolerance for that. They can reroute operations to a different facility and would rather do that than pay exorbitant costs for generation that's just sitting there waiting to be called on. Others, are willing to pay a price for reliability. They, don't really care. They're not as price sensitive. They just need to have that reliability, that 24/7 good power quality. And so I think an understanding of what tolerance levels are, and I think in the prior technical conference that DC's Public Office Council, brought up a good point, is we need to have demand at the table when we discuss this to understand the level of tolerance. And I think a little bit of education even for the average retail customer, and I know that's difficult. I've always been taught that the customer only thinks about their utility in two scenarios, and one is when their lights go out, and two is when their bill arrives. And either time they're not very happy.
So let's have them understand exactly what they're paying for and what their tolerance level is as well. You know, they hate it when their lights go out, but you know, is the price that they're paying so extreme that we could, you know, lower those costs and have them understand and come to the table with solutions and perhaps their tolerance level as well for interruptions in power supply. So with that, I'll wrap up, but I look forward to the future questions, and thank you again for having me.
Thank you, Karen. Next up is Tom Kaslow, Vice President, Market Policy, First Light Power.
Thank you, Michael. And first, a thank you to the chairman, the commissioners, yourself, Emma, and David, and other staff who put this conference together. I really appreciate that opportunity to share First Light's thoughts on the panel. I am the Vice President of Market Policy for First Light Power. We own and operate a New England fleet of hydro resources. We have the largest pump storage facility in New England, and we also have another facility is the oldest pump storage facility in the United States. We also have a solar farm and 2 customer-sited lithium-ion batteries. So we provide considerable flexibility in the supply of energy to meet the region's ramping needs, peak supply, dispatchable load to manage generation oversupply, offline and synchronized reserves, and AGC. We do it all. So we're really interested in this topic. At least in New England, uplift eligibility and other details in the day-ahead and real-time market seem to work reasonably well, with, of course, the biggest exception in the New England market is we don't have a day-ahead reserve market yet. We're hopeful that ISO New England completes that day-ahead design and files it with the Commission soon to correct that flaw. However, supply offer rules governing the flexibility into the day-ahead and real-time markets really starts at the point of capacity sale. Those rules require provision of dispatch flexibility that the capacity resources design can support. For existing resources with known designs, the current rules that apply upon their sale of capacity do obtain the flexibility that is possible from them. While the current market rules require flexibility from equipment inside the generating fence, some resource designs, like gas-only fired resources, do rely on equipment outside the fence, like gas supply and transportation infrastructure. And the market rules can and do require them to seek gas, but the market rules cannot require them to get gas. They're not in control of that. Further, as the cost of spot gas increases, the least efficient units get pushed up the dispatch stack, and as for practical purposes, really get out of reach of the ISO system operators and other resources run, maybe hearkening to Karen's earlier comment. So with respect to new investment, we think the question that needs to be asked is, why would a new investor considering adding resource flexibility want to do so if their outcome is only to be paid the same capacity price as the resource that is extremely inflexible and rarely or never run? The consequence of this flaw is likely to manifest itself by either narrowing new investments to technologies less capable of flexibility, under-designing technologies that could otherwise be flexible, are the most inefficient of all, precluding ISO dispatch of otherwise flexible resources by their choice to operate outside the RTO ISO markets as unregistered distributed generating resources or behind-the-meter resources. Those resources must be scheduled 100% of the time, and not only does ISO not control them, they cannot even see their operation in real time. First Light encourages the Commission to think of the operating reserve market as a three-legged stool, with the day-ahead market, the real-time market, and the capacity market of the 3 legs. There's no day-ahead or real-time fix that substitutes for correcting the capacity market flaw that exists, which I think is driving some of the concerns that Karen mentioned. The effectiveness of that compensation signal is central to encouraging flexibility. Equal pay demands equal work. A lot of hope was placed on pay for performance to do that. However, in New England, with only one event in 3 years, that design, at least as designed, does not appear up to the task. The common obligation under some form of enhancement or adjunct to PFP should apply to situations where the system is tight, but prior to reaching a deficiency. We have ideas, and there are other stakeholders within New England that are talking about these types of changes. And we hope that that will be considered in light of the priorities that are given to ISO New England, at least. I thank you for the opportunity to present these comments, and I look forward to questions. Thank you.
Thank you, Tom. Next up is Greg Sorensen, Manager, Market Surveillance and Mitigation, Southwest Power Pool. Greg?
Thank you. Good morning, Chairman. Good morning, Commissioners. Thank you very much for inviting me to be part of this panel that represents the Southwest Power Pool Market Monitoring Unit as we discuss the future of energy and ancillary service markets. These markets are a very important part of ensuring reliability as they allow the system operator to specify the quantity of ancillary services required for safe operation and then allow the market to obtain the optimal set of resources. Certain maintenance costs increase as units operate in a more flexible manner. Additionally, we've observed that price volatility can reduce generators' confidence that market prices will remain high, which leads them to sometimes operate near their day-ahead position instead of being flexible in the real-time market for unforeseen events. And as renewable generation increases, we have seen the price volatility increase in both the SEP integrated marketplace and the Western electricity market. Volatile prices make starting a unit more financially risky. In particular, additionally, we see as the variable energy resources increase, that 5% forecast error can manifest itself on a 15,000 megawatt wind day as a 750 megawatt shortage, which is the size of many power plants. In the SCP market, the Market Monitoring Unit has spent time the last few years discussing the importance of placing units in market commitment instead of self-commitment status. This practice of not allowing the SCP practice of not allowing make-whole payments to self-committed resources has encouraged resources to offer in a market status. As more resources offer in market status, they have learned that faster startup times lead to more commitments. Additionally, we have observed units increase their ramp rates after major overhauls, likely in response to negative prices that appear in real time. The real-time market in SCP sees significant price volatility as ramp shortages lead to high real-time prices for a very short duration. While some resources have increased their ramp in order to capture this value, some resources have chosen to maintain their day-ahead position as a result. The ramp product, which has been approved by the Commission and will be implemented in April 2022, will help smooth out these price spikes. The fast start changes to provide uplift to fast start units will help encourage them to start. SCP could change the day-ahead commitment cost algorithm to consider minimum run time instead of treating all units longer than 24 hours the same. This would encourage shorter minimum run times. On the other hand, the startup and shutdown for a steam unit leads to the thermal damage, which can be relatively expensive to repair in major overhauls. The MMU, in response, spearheaded an effort a few years ago to allow the major maintenance costs to be included in the mitigated startup and no-load offers. Surprisingly, some resources have not yet applied to the market monitor for this additional cost to be added to their offers. While a rule could be added to require resources to offer their full flexibility, more flexibility does come at a price, and that needs to be considered as a rule is volatile. Transitioning, natural gas limitations are reflected in offers in two ways. Sometimes units must offer on a ratable take. That is, they have to take the same output for all 24 hours of the gas day, which removes all the flexibility that unit had. A few years ago, when gas prices were very low in West Texas, a number of natural gas resources were running constantly quite economically at their maximum, which reduced the flexibility that normally exists with those units in system operators. And finally, the MMU has observed that some natural gas providers are not open outside of 8 to 5 Monday to Friday, so units that could otherwise start in 10 minutes to solve some sort of emergent problem have very long lead time after these hours. Requiring all natural gas providers to provide some level of service 24 hours a day would help improve flexibility greatly. I thank you for the opportunity to present and look forward to additional discussion with my expert panelists.
Thank you, Greg. Our last panelist is Dr. Catherine Tyler, Deputy Market Monitor, Monitoring Analytics. Catherine?
Hi, good morning, everyone. I'm Catherine Tyler. I work for the Independent Market Monitor for PJM. who was on a panel in the last conference that began to address some of these issues. So we appreciate the opportunity to come back and speak to them some more. I will start by pointing out that the way the question is framed, I think, is not quite the right question, or at least not where our concerns are. The question isn't necessarily whether resources offer flexibly. What we need is for them to perform flexibly. So there is a difference there. The PJM rules require offering flexible parameters. We have must-offer requirements in energy and reserve markets. There's plenty of flexibility on paper. There's a general lack of accountability to perform flexibly in the markets. PJM has rules to establish physical offer parameters that must be included in parameter-limited offers. These should be used in market power mitigation and during stressed market conditions consistently. But PJM's implemented the rules in a way that makes it very easy for resources to avoid commitment on those offers. As the market flexibility needs increase, using those parameter-limited offers will become more crucial. We observe situations where offers are flexible, but actual performance is not flexible. The market needs to account for the performance of the resources. Customers pay a premium for capacity that is meant to meet performance standards. Some examples. PJM has called synchronized reserve events for low ACE on high load days when units could not achieve their economic maximum due to ambient temperatures. And there are no repercussions in the outage rules or the uplift rules. This is a failure to meet energy market must-offer requirements, and the solution would be penalties based on capacity market prices. Combustion turbines in PJM have been called on based on cost-based offers with a short notification time, but the units could not come on because they were not staffed, and there are no repercussions for this. PJM's told these resources since to submit what they call real-time values, which are overrides of the required notification time, but there's no repercussions for this situation, and PJM hasn't proposed a workable solution to the problem. The logical solution here, again, is penalties based on the capacity market prices, which are paid for meeting certain performance standards. PJM also is regularly reducing the amount of reserves that it calculates from what is offered because PJM does not trust the ramp rates or the performance of certain units. The ramp rates are offered, but they're not achieved. It would be better to clear reserves based on the offered ramp rates and then use stronger penalties for non-performance so we can get the right offers to match the performance. So overall, the flexibility is offered, but it doesn't always translate into real-time performance. This undermines reliability. PJM needs rules that discourage rather than reward this behavior. In most cases, the reward for this behavior is uplift payments. Resources that do not follow PJM's dispatch instructions should not receive uplift. Where we do see limited offer flexibility is, as has already been mentioned, generator modeling, especially for combined cycles. This leads directly to less flexible offers than what generators can perform to. The stakeholder process has been an obstacle to improvement in this area. And this is because better generator modeling goes hand in hand, as it should, with more accountability for performance. And so we need some, perhaps, help there to move those proposals forward when they stall in the stakeholder process, even though they're very much needed. On the question of the gas scheduling, the PJM rules accommodate inflexibility due to gas scheduling restrictions. These restrictions are becoming more common, and it's not only in the winter, it's also on hot summer days. And the rules are accommodating the inflexibility. We have we allow 24-hour minimum run times and long notification times based on something that's coming up from the gas pipeline. And this is accommodated through generous uplift payments that allow the cost of this pipeline inflexibility to be passed on to customers. This shouldn't be an acceptable standard. Capacity resources should be required to have dual fuel or flexible firm gas supply arrangements. And currently, the accommodations for the inflexibility on the gas side are all being pushed from the gas business to the electric business. Reforms are needed not just on the electric side, but also to get more flexibility and accountability from the fuel suppliers as well. So yeah, overall, I think the comments that we have, and I think they fit with a lot of what we've heard already, are that we need to set some standards on the capacity side to make sure that we know which flexible resources are there that we need, and then to hold those resources to higher performance standards. Thank you.
Thanks, Catherine. And thanks to all the panelists, their initial responses. At this point, I encourage each panelist to respond to the great points made so far. I invite Emma, the chairman, and commissioner also to ask follow-up questions. If you have comments, please raise your hand, and I will call on you in order. Thank you.
Karen Honoran, you have your hand up. Please go ahead. And then we will have followed by Sherman Knight and Tom Caswell, please.
Yeah, thank you, Emma. And I just wanted to follow up a little bit on what Dr. Tyler had to say, as far as penalties. And I do agree, we're always, about cost causation and beneficiary pays. And so I want to make sure that when we do have specific penalties, perhaps for those that commit but do not show up or do not perform as flexibly as we expected, that there is a mechanism to make sure that those penalties are not then transferred to customer costs. So just wanted to make that point, but absolutely do agree that if penalties are necessary when there is not the performance expectations, but just want to protect those customers and make sure that that's just not, those penalties aren't then transferred to the customer.
Thanks, Karen. Sherman Knight from CPB.
Sure, thank you. I think I want to address Dr. Tyler's some of her comments. I think penalties do make sense to a certain extent for obligations that want to put on. It totally makes sense. I think if we set a standard on the capacity market for a certain flexibility, I think we're, as an overall ISO, we're going to be clipping the total capability of all of the units. For example, a standard sets a minimum hurdle in which you have to apply. But I think there's a lot that can be done with some of the existing generation fleet that could create additional flexibility. And a lot of it just kind of is right around the edges. So for a specific example, a lot of our combined cycles have, you can ramp from the minimum, operating condition, and you ramp the gas turbine up, the steam turbine comes up at one ramp rate. And then you put in duct firing, which is gas directly to the boilers, which just does the steam turbine. And that ramp rate is a different ramp rate because it's really a different mechanism. But there's really no way to put in the two different ramp rates. So to the extent that there's penalties for not putting in a ramp rate, for example, for not meeting a ramp rate, the natural inclination you'd go with the lower one, so that you're not getting penalized. But that would then preclude a significant amount of ramping that occurs in the lower portion of the combined cycle. So I'm not trying to say that specific one, but I just think that there's a lot of very technical specific things in each, and that's just a combined cycle. And I don't know about hydro or other resources that I think if one only sets a minimum standard, we're going to end up with a lot of generators that are only meeting that minimum standard. And that's where I think it's more important to set it up such that there's an incentive to get the maximum out of each of the generation assets. And then everybody out there, each of the, I should say, resources, storage, demand response, then everybody goes to the drawing board and then can think about what is the most effective economic way to create that flexibility in the system, which may not be obvious to any of us on the panel. It's probably obvious to a lot of engineers behind the scenes, but not necessarily from our perspective.
Thank you, Sherman. Tom Caswell, First Light.
Thank you, Emma. It's encouraging to hear the focus on this panel on the importance of making sure that the products that are purchased, that the resources are required to deliver them. I would emphasize, though, that carrots are certainly more effective in markets than sticks. If we don't have revenues to reinvest in the facilities that provide flexibility, it would be a very inefficient loss of flexibility. So if penalties, when they're used in this term, are code for financial settlement of performance obligations not delivered, then we would agree. The problem, at least in New England, I think it probably exists in the other markets too, is that the capacity market obligation is not the same for all. Our facilities, particularly our pump storage facility, operates every day, and it provides a lot of saves the system many times each year from having reserve deficiencies. Yet we're paid the same price as another one of the resources in our fleet that rarely, if ever, runs. And so we're missing something there. We had great hopes in PFP, and I still am a big supporter of that. I think that we're just relying solely on deficiencies to enforce the flexibility that we need to avoid deficiencies is probably where the shortfall is in that initial design. So hopefully there's some focus on that going forward. Thank you.
Thank you, Tom. Can we hear from Greg Sorensen from STT-MMU?
Yeah, thank you, Emma. I would like to note that, I think Karen Onderon was definitely onto something by highlighting the importance of increased demand participation, because there is a lot of opportunities in both demand response and distributed energy and other types of collaborative efforts to increase the amount that demand can respond to prices and increase the amount that demand can actually respond to other types of emergencies. And I think that's essential for flexibility as you continue to add more and more intermittent resources. Have to figure out who is willing to get out the system at some price in order to keep the rest of it reliable. And I think also as we think about the value, what is the value of the generation, and then what does the generator need to get paid in order to perform? And certainly during the winter weather events, it was definitely highlighted that the generator needs to be compensated not just for their actual cost, but the short run marginal cost of providing the generation, but also they expect to recover some amount to cover their risk of actually, being able to start in an emergency. So they have to be able to cover both of those to feel like the value that they're getting paid is sufficient for them to actually be able to perform both during emergencies and just provide general flexibility. Thank you.
Thank you, Greg. Can we hear from Catherine Tyler of Monitoring Analytics?
Yeah, thanks. I appreciate the other panelists' comments on the question of penalties. The penalties versus higher payments, both of which are incentives, is an important question, and we do acknowledge, recognizing Sherman Knight's comments about ramp rates, that generator modeling issues contribute a lot to some of these inflexibility issues that come up, especially for combined cycles, and better modeling to match the capabilities of the resources would help a lot. The thing that we see over and over, at least in the last several years in PJM, is discussions of flexibility leading to new market design changes. So we'll say capacity performance, fast start pricing, PJM's proposed extended operating reserve demand curve, all in the name of providing more revenue streams for resources that are flexible, but in all cases, they also create higher revenue streams for the resources that are inflexible at the same time. So we can keep doing this, but it's not going to lead where we really need to be, which is in a place where the resources that are in the fleet are those that are flexible and are ready to perform flexibly. We need to look at these proposed changes and not only how they affect the resources with the flexibility, but those with the inflexibility. Thanks.
Thank you very much. I have some follow-up questions, but I wanted to confirm that the chairman, Chairman Glick, or commissioners have any questions. If you have any follow-up questions, please go ahead and jump in or raise your hand. All right, hearing none, thank you all very much and for your answers there and responses. I think it's certainly very important that we both need a resource to have the incentive to both offer, and I think we all sort of assume that an offer flows through naturally to performance, but thank you for clarifying, Catherine, that we do need both resources to make their flexibility available to the market and respond flexibly. And we've heard, I think, a lot of sort of two schools so far, sort of the carrot and stick approach, and Tom, that's exactly how I think of it, Tom Caslow, in terms of how do you get the best performance out of people. I'd love to hear your thoughts as to which is the more effective approach, and also we've also heard some discussion at the last conference and this one now as to is it the energy market or the capacity market that is the most appropriate to procure and compensate resources for flexibility. We heard a lot of comments in the final panel on market design on the last conference that energy and ancillary services markets are most ripe and appropriate to incent and reward flexibility because they're real time, they're very dynamic. A capacity market is often 3 year forward, and you have a single capacity requirement for the entire year, whereas flexibility requirements, not only do they vary within the day or the hour, they change markedly depending on weather events. So I'd love to hear some discuss, if the panel could, to talk about, for those who think capacity markets are the appropriate mechanism to require flexibility, how would a capacity market incent and reward flexibility if it's so forward, so long in advance? And also any comments that you have on sort of the carrot versus stick approach of incenting through payment versus punishing through penalty of resource flexibility. So by raise your hands, I'd love some comments. How about first we have Dr. Nicole Boucher, or Bouchez, I think it's Boucher is the French pronunciation, but please correct us. And then I see Tom Caslow. So please, Nicole.
Either pronunciation works, Emma. So we don't think the capacity markets are the primary way to incent flexibility. And really sort of energy and ancillary markets, and even most importantly, the real-time market is really where the rubber meets the road. That's where the need is, and that's where the response matters. And so we've really focused on those areas in terms of both what is needed from the resources and also what capability can the resources bring to the table. We want the broadest participation possible, but we also want effective participation is what it comes down to. You asked about the stick. I mean, I think both come into play. If you don't have the carrot, it doesn't make any sense, right? You need to correctly compensate for the cost and make sure that you're covering the costs incurred of units who are responding. On the other hand, there are consequences to not responding, and those are needed as well. So, I think both carrot and stick are at play there. Thanks.
Great, thank you very much. Nicole, can we hear from Tom Caslow? First slide, please.
Thank you, Emma. I think it's useful to have these panels because we all arrive with different perspectives. Following the last comment, I recognize that it is the real-time operation where the rubber hits the road for the RTO ISO system operator. That's their focus, keeping the lights on. However, the rubber hits the road well before that from a commercial standpoint. If the consequence of making a capacity sale is that our resource has to offer its full design flexibility into the day-ahead and real-time markets, the title is transferred there. That's where the commercial transaction is really made. The rest of the discussion about what happens in the day-ahead and the real-time is really just a question of whether or not there is any payment and at what level. The sale has been made. It may be that certain resources end up being more flexible and more economic to provide that flexibility on a given day in the day-ahead and real-time, but the obligation on all of them starts in advance. So if that is ignored, we would be ignoring the fact that that forward obligation is actually bounding the future day-ahead and real-time outcomes. They have the obligation to do it each day. So I think they all work together as I use the three-legged stool. They really can't be separated or else the stool will not stand.
Thank you, Tom. Dr. Catherine Tyler?
Yeah, thank you. I absolutely agree that the energy and capacity markets need to work together. Of course, there's a real challenge there when you have cost of service markets or parts of your market that are, and then that question really doesn't apply, and creating incentives for investments becomes much trickier. In PJM, luckily, we have a capacity market that that could be used better in this regard. If the capacity market payment, or even also your uplift payments in real time, are your carrots that you're offering out there, that comes with these obligations, as Tom Caslow was just saying, to perform flexibly and to provide the services that the market needs. The capacity market puts that out there for the needed investments to be made, for the needed maintenance to be done. And, in PJM, we've been working towards a new approach to the ELCC. That's a tool that could be used both for renewables and for thermal resources to really look at who is available and who performs the way that it's needed. And then you have a situation where you can make sure that you are offering that incentive to the right set of resources, but then you need to have something in place to take that away when they don't provide what they are being paid to provide.
Great, thank you. I think we also have Greg Sorensen from STP.
Yes, thank you, Emma. Just a short comment, and I think it's important to recognize that the need for flexibility is not the same during every single hour of the day, and it's not the same as you go from month to month. So, for example, in SPP, the regulation up and regulation down requirement is calculated for each hour, and that's based on the value of the load, how much we think the load is going to change, and also how much intermittent resources we have and how much we think they're going to change in each hour. And so that's very important because certain hours I might only need to make the consumers come up with 600 megawatts of reserves. Other times I might need to come up with 1,000 megawatts of reserves to provide reliable service. And that provides an appropriate balance between making sure we're flexible, making sure we're reliable, and not procuring more reserve services than we actually need. And similarly, ramp and uncertainty price will be allocated. The amount that's required will vary each hour based on the anticipated system needs. Thank you.
Thank you very much, Greg. I have one other follow-up from the movers and shakers that are our generators on the panel. We had heard and Tom Sherman Knight and Tom Caslow that right now the markets are not giving you the incentives, and that essentially you would get the same, to be flexible, you might get the same compensation or just receive your cost for being flexible versus not. And we'd love to hear from you. What do you need, and what markets, if any, do you think are doing particularly well in this area? Greg just mentioned this ramping product that I know that's not in force in the Northeast yet, but it's existing in MISO and California, and will come out in the STP. Would something like a ramp product or other reforms work? I would love to hear what you need, what resources need from these markets to have the incentives to both offer and perform flexibly during to meet changing system needs. So if Sherman or Tom has a response, we'd love to hear from you. And I see, Tom, your hand is raised. Please go ahead.
Thanks. We're not discouraging if there's interest in some type of a ramping product, though We're not in the markets that currently have one of those. Anecdotally, I'm hearing that they're not particularly effective, at least in terms of supporting investment and flexibility. And as a practical matter, I think it would be useful to look at the contribution of capacity market revenues over time to resources revenue adequacy. The capacity payments are a substantial portion of what the resources rely on to continue their reinvestment in facilities. So you need to look at all three. It's a three-legged stool, but there is no substitute for getting the capacity market right. And to point back to Karen Honoran's comments earlier that consumers really don't want to pay for capacity from resources that they're not getting much from, we completely agree with that. There is a problem in the New England market right now where the surplus that we have, you get 1350 megawatt surplus beyond the installed capacity requirement, and now you're down below $3 per kilowatt month. And if that was all based on a common product sale, that would be a fair outcome. The problem is the $2.60 price that we just had ends up being comprised of resources that know they're not going to be asked to do too much, and we know that firsthand because we have one. When I went through our fleet, I didn't mention we have this one little 20 megawatt kerosene-fired jet. It can do stuff. It hypothetically can, and under ELCC, it would probably do fairly well. But it just doesn't operate much because it's outside of dispatch economics. And so as a consequence, we really need something that's going to provide a common obligation. Now, everyone can't provide the same level of performance. And when I say a common obligation, not that everyone has to supply like 5 megawatts per minute ramp, but that there's an evaluation of the extent of contributions that they make that ends up factoring into their capacity compensation. So our little jet that can but doesn't probably doesn't deserve as much of a payment, and the resource that runs a lot like our pump storage facility probably deserves more than the current market price reflects because we're obligated to provide more than others are. Yeah, we get an energy payment, there's some operating reserve payment, but frankly, those are tiny compared to the capacity payments, other than gross energy revenues. I'm talking about net energy margin. So one of the thoughts that we've had and actually shared within New England is coming up with a common obligation. We've had several different ideas. We're actually trying to converge stakeholder proposals because having many proposals before the ISO just consumes a lot of resources. The efficient way is to have common need definition and a common solution. But it's coming, the current concept is probably more likened to some form of an energy call option where everyone's subject to the same type of financial settlement in real time. And the strike price on that would be very high when you're just at criteria, and would be much lower when you're in significant surplus. Kind of separate the wheat from the chaff when you're at significant surplus conditions. So hopefully there'll be more coming on that. I don't have more design to give you.
Great, thank you very much, Tom. And Sherman, you've also kindly agreed to answer, so fire away. Thanks.
Sure. Thank you for that. I think from our standpoint, I think the capacity, given that it's 3 years in advance in some markets, or at least a month-long product, it's not granular enough to fully provide, the needed flexibility when it's needed. And I think Greg Sorensen summed it up extremely well, that there's certain hours during the day and certain months during the, when more is needed and sometimes less is needed, and therefore the value of that, increase and decreases depending on the demand and supply of that. I think, to put it into more granular context, back to kind of the engineering of it, for example, at some of our plants, when we ramp past a certain level, we have to turn on a boiler feed pump. That every time you cycle that, it's known after 4,000 cycles, you have to spend $400,000. So we don't want to move it past that ramp point, because we're not getting paid to do so. Then we're just incurring costs, and that's a very granular thing. For example, will we do that? To meet a reliability? Absolutely. Will we do that? Are we happy about doing that when we get uplift payments and get paid our theoretical costs back? Not particularly excited about that. So, you know, there's not currently a mechanism to have that granularity in it. The other thing, you know, for example, is we can create more flexibility by lowering the min load of some of our combustion turbines or combined cycle plants, primarily because the min load is set by basically emissions at, you know, NOx levels. And combustor technology has improved. We change out the combustors and its investment, we can drop that and increase, you know, the amount that we can ramp by, you know, call it 5, 10 megawatts. I'm not exactly sure, for example. That requires an investment. And currently there's no mechanism to actually get paid for that investment. And going back to Karen's comment about from a consumer perspective, I think from an incentive point of view, I think we can do that much cheaper than building out a 5 to 10 megawatt battery. And so if the attributes are put in the market, and I think it has to be more in an energy and ancillary service or real time, because it is very you know, granular, that creates then the economic incentive to go about meeting those attributes in the lowest cost way. Maybe that's a lithium-ion battery. Maybe it's simply, you know, changing out combustors at some of the plants to be able to lower that min load. Maybe it's, you know, just cycling a boiler feed pump, you know, more. I don't know the actual answer, but right now there isn't that granular ability on a real-time basis to actually figure out the best economic trade-offs, which ultimately will lead to the lowest price for the consumers.
Thank you very much, Chairman and Tom, for answering. I'm going to now pass the mic to my co-moderator, Michael McLaughlin.
Thank you all for this great responses. The next question for the panel is, to what extent do existing self-scheduling rules in RTO ISO markets reduce the amount of operational flexibility available to the RTO ISO market? Are options for self-scheduling needed to allow resource owners to make the best use of their assets over time? Are there market design changes that might encourage more resources to be committed economically? Please raise your hand and we will call on you in order. Okay, so Paul's hand first, and then Tom. Nicole?
Sorry, you cut out there for a second. I didn't hear my name. Thank you. I think in this discussion we have to distinguish between self-scheduling and self-commitment, at least in New York, because the two are very different. And they have very different impacts on flexibility. Self-scheduling absolutely does reduce the amount of operational flexibility available in real time. It's less clear that self-commitment does, and I'll talk about that a little bit later. In New York, self-scheduling appears largely to be used to accommodate inflexible contracts. For example, natural gas contracts or legacy physical contracts even. And in more limited cases to reflect operational limitations, either of the resource itself or of the natural gas pipeline. And our focus should be to get entities to negotiate more flexible contracts and to have the natural gas pipelines provide gas as flexibly as possible, including potentially investing in flexibility. And the markets encourage that, right? We have more in the long run, because in the long run, it's not clear that self-scheduling is profit maximizing for suppliers, because ultimately self-scheduling leaves money on the table occasionally. It doesn't always, but it does, you know, and so the incentives at least are in the right direction there. But self-commitment is a little different because it's less clear that it reduces operational flexibility available in real time. Self-commitment, and in New York we think of self-commitment as either a self-commitment bid mode, which we have, or potentially by changing operational parameters to make the unit get committed, so we see that as well, is all about commitment horizon. The New York commitment horizon in the day-ahead market is 24 hours and is approximately 2 hours in real time, and I won't go into all the vagaries of that. But the resources that expect to operate longer than that, right, in a longer time horizon, bear the commitment risk to determine when they should be committed and when they shouldn't. And that's where we see these self-commitment modes and bidding behavior being used. So I think there are good reasons to continue to allow self-commitment, but there are also really good reasons to discourage the use of self-scheduling and to build rules so that the financial incentives are not to self-schedule in our markets. Thanks.
Thank you. I think Tom was next.
Thank you, Michael. Many of the discussions, including the start to this one, focus on the ISO registered resources, the ones that are observable and under their dispatch and control. However, one of the things that's happening in the industry now is an increasing amount of resources that impact the wholesale market, but do so from outside of ISO's site and control. I'm talking about resources that are connected to the distribution system or behind the meter that aren't registered. And all of their operation is a self-schedule and of an even tougher type. Since the RTO can't oversee their occurrence, nor even directly observe it when it occurs, you need to try to forecast those changes. And on top of the fact that they reduce the amount of net load that needs to be met by the flexible resources that are under the ISO's control. And while those resources by definition are outside of FERC jurisdiction, the FERC jurisdictional markets actually encourage this less flexible form of business model through preferential incentives that are provided under the RTO ISO market rules. For example, in New England, based on the recent forward capacity auction clearing, a 1 megawatt retail load could operate a 1 megawatt battery for the single coincident peak load hour of the prior year and obtain 140% of the capacity value of the same 1 megawatt battery if operated as a ISO registered resource in the capacity market. So that's based on the cost allocation design that we have. Others may have similar designs. And it also means that a customer could avoid paying any capacity charges, yet rely on the capacity purchases paid by other customers in all other 8759 hours. So that type of a functional signal to not be in the market and subject to the ISO dispatch may be one that gets the biggest bang for the buck here. With respect to resources that are under the RTO ISO control, I think the incentive to not self-schedule are a good 5-minute prices. If you self-schedule, you're going to get a lower price. But there are good reasons why some amount of self-commitment in particular, and I think that clarification is a good one, need to happen. We operate energy storage facilities, and much of the time, the coordination between the storage injections and the storage withdrawals happens within the constraints of the facility according to the day-ahead and real-time market outcomes. But that's not always. And sometimes there are a need to actually use some of the real-time generation to make space to accommodate day-ahead purchases. Other resources face similar situations. Gas unit might buy a gas package and face a not a very liquid gas market, and the better option is actually to liquidate that gas by burning it and selling the energy in the more liquid ISO electric market. Similar things happen. Resources fed by LNG need to make room for incoming tankers. Hydro stations need to do it in order to make room in the upper reservoir in anticipation of intense rainfalls when approaching storm front is forecast. Resource testing is another reason. So you can't be and shouldn't be eliminated. But I think it's important to have the right signals. And in New England, certainly the absence of a day-ahead operating reserve market isn't helping that. And that's something that needs to happen there in any event. thank you for the opportunity.
Thank you, Tom. Joseph, I think you're next.
Thanks. And I want to start off by saying that I agree with Nicole that commitment and scheduling have to be distinguished. They're two unique practices. But I end up landing somewhere different when it comes to the impact of self-commitment on flexibility, at least in markets like SAP and MISO, where I've looked at this issue most closely. And I want to start off by discussing how resource self-commitment differs in practice. And I'm going to use an example of like a coal unit and a wind unit, but like, those aren't the only resources that this example or illustration would apply to. So if you have a coal unit that is self-committed and is operating at P-min, the grid operator could turn that unit up if market prices go up and clear its cost offer. But essentially the grid market, the market operator can't dispatch that unit any further down, and it can't turn off that unit because of the commitment status, unless there's an emergency. Now this stands in pretty stark contrast to the way self-commitment works for a wind resource, where wind self-commitments have essentially no impact on price or flexibility because the ISO RTO protocols for wind resources require that wind to be dispatchable down to P-min, and for wind, P-min is set to 0. So that means that the operator can effectively turn off that unit, and you have the full flexibility of the wind turbine so long as that wind turbine is available. And so you have dispatch down, basically to 0 for most wind turbines in the U.S. And so the impact of self-commitment shows up in, say, a region like SPP or MISO in the form of wind curtailment. Now, I'm just going to say at the onset, I understand that a lot of wind curtailment is caused by transmission constraints, but there is emerging evidence and admissions by the utilities that operate these coal-fired power plants, and many of them also own wind farms, that their inability to be dispatched down below their P-min or operate below their P-min forces them to curtail wind resources. And it's my assessment that once transmission constraints are resolved, it is the inflexible operation of self-committed resources that operate at unreasonably high P-mins that will be the predominant bottleneck for maintaining cost-effective reliability while integrating higher levels of wind and solar and renewable energy and electric vehicles and sort of getting to the grid that we know is coming. And the thing is that many of these wind curtailment events in SPP and MISO are 24 hours long or 72 hours long, and if a single coal unit, not necessarily even the whole plant, but a 350 megawatt unit were to be turned offline, there are plenty of other resources available during those seasons when these events are happening, which is typically spring and fall, when there's a surplus in capacity. So the grid operator could maintain not only meeting peak demand and its reserve margins and have lower system costs and avoid these wind curtailments. I mean, it's actually, from an engineering perspective and an economic perspective, all a perfectly achievable outcome. And I think one of the things that was really surprising to me is over the past couple of years, I've started to talk to solar developers and renewable energy developers who have told me that one of the things that they look for when they're trying to locate where their power plants are, or where their facilities are going to be sited, number one is transmission, and number two is the power plant operations of coal-fired power plants and other inflexible resources, to see if that resource is going to suppress prices and create all sorts of problems in terms of flooding the resource or flooding the grid with an inflexible power source, such that they're the ones that are going to have to be dispatched down. They're the ones that are going to have to be curtailed because ultimately the inverter-based technologies, wind, solar, and storage, they're infinite. They're a lot more flexible than those coal units. So the grid operator will turn those units down. And so once those coal resources hit their P-min, there is now a flexibility issue at play. And what I'll say, what I'll wrap up with is saying is, those P-mins are not set in stone, right? they can be changed. There are, some of them require actual capital additions to make those changes, but some of them, have never, I work in a lot of state PUCs, and I'll get involved in these rate cases and ask, the utility, have you ever done an engineering study on what your PMIN should be set at? And none of them have. There's been a couple of utilities that have started to actually do tests to test their PMIN, and they found out that, oh yeah, we were at a 60% PMIN, and then we were at a 50% PMIN, and now we're at a 40, and now we're testing 30. So we're actually currently doing that process. But, most of them it's just been, oh, well, we've always operated at a certain level. Or they'll use their contracts, which I was alluded to earlier. They'll say, oh, well, we have a fuel contract such that we set our PMIN based off of an attempt to avoid liquidated damages in our coal contract. But at which point there's all sorts of other accounting issues that happen when they start doing that. So there absolutely are physical flexibility limitations that are on the grid when you have these high PMIN resources self-committing into the markets.
Thank you. I believe Greg was next.
Yes, thank you, Michael. Thank you, Daniel, for those comments. I do agree with you that it is a problem when people have inflexible fuel contracts, and the only reason why they're operating a certain, minimum is they got the fuel they have to burn. That's, I think, unfortunate for everybody, the consumer and the environmentalists alike. I think as far as I would agree that, transmission causes are the main issue with price divergence, at least the wind curtailments, at least in SPP. Another issue we do observe is that wind generators will tend to under-offer in the day-ahead market, which means that more units end up getting committed than what is otherwise needed. We sometimes see that the wind that's offered can be as low as 80% of what actually shows up, which of course, 80% of 15,000 is, you're leaving, you need another 3,000 megawatts of thermal resources that have to be committed in order to meet the reliability needs. But transitioning a little bit, we do observe that self-commitment does actually increase the amount of upwards operational flexibility. So during hot weather and cold weather events, that can be more important to the grid. However, as you did note, MMU analysis also notes that prices are suppressed, and generators that particularly can get subsidized by state regulatory processes usually fare much better by self-committing. We've observed that merchant generators, both thermal and renewable, are disproportionately hurt by this practice. And if you separate out who self-commits, you'll find that it's disproportionately people who have the state utility commissions as a backstop. So that's certainly a concern. Probably leads to higher consumer costs than what are otherwise needed. Self-scheduling, as we've already alluded to, that does greatly decrease the operational flexibility of the market. And just as an example, if we have a hydro unit with a ramp rate of 20 megawatts per minute, they set their economic minimum at 102 and their economic maximum at 104. That means there's only 2 megawatts ramp actually available to the market, right? So they're not actually being very flexible when they use some sort of either specific self-scheduling or have a very low amount of flexibility, and that's based on a variety of things. I think as some other people already noted, there are some reasons to do self-commitment and self-scheduling. Environmental testing, PERPA units, and long lead time resources that cannot otherwise be committed by the day-ahead market, as well as units in advance of extremely cold weather. It's important those resources are online ahead of time. Otherwise, they're really not good options, and particularly in SPP, the Southwest Power Pool provides uplift for resources in market status, which allows them to recover from the market, not from ratepayers to operate the generators. In contrast, self-scheduling, you assume all the risk of bad prices. Additionally, we've added the addition of major maintenance costs. Startup and no-load offers should allow recovery of costs of starting and operating the unit, particularly when the system operator has to start the unit for some sort of emergency, large forecast error in renewables or some other system contingency. Finally, the Market Monitoring Unit recommended its self-commitment study in its annual report that an additional day of optimization be used. And we think that would greatly reduce the amount of resources that cannot be committed by the day-ahead market. So that's another, when we've done surveys, that's why people say, well, I had to self-commit because I didn't think the day-ahead market was going to commit me. Additional day of study should help resolve that situation. Thank you very much.
Thanks, Greg. Catherine, I believe you're next.
Yeah, thank you. A lot of great comments here. We, for PJM, have not observed a lot of problems with self-commitment, and I definitely agree with that important distinction between the commitment of the resource and then how, actually what level it's scheduled at or dispatched at. The disqualification of uplift payments does limit this behavior, though we do acknowledge the less economic behavior of regulated cost of service resources. There are some issues there, and I will clarify, kind of going back to the earlier question, because this comes up here as well. We use the word penalties or sticks rather than carrots, but what we really mean is simply taking away the carrot that was given in the first place. Whether that's uplift revenue, capacity revenue, or reserve revenues when the resources don't perform, rather than necessarily additional charges. And that comes into play with this question of self-commitment and self-scheduling for sure, and uplift is very important in this discussion. Where we observe issues are when resources are receiving uplift, remaining eligible for uplift while either through their offer or through their behavior, they are self-scheduling. They're ignoring the economic dispatch instruction. Explicitly, this can be done in PJM by something that's called the fixed gen flag. Like you just turn it on and it says, hey, PJM, I am not following your dispatch instruction at all. So I'm just going to do whatever I'm going to do since you've committed me. Whereas other resources can effectively do the same thing by just ignoring their dispatch instruction. And these resources do remain eligible for uplift when they should not. They should be treated as if they're self-committed. Sometimes this happens for some resources because they require a phone call to change their output levels. But the market creates no incentive to install automation or AGC. The flexibility there is offered as if the resource could be dispatched up and down, but it's not provided because there's no communication of the dispatch signal to the unit. There's also lack of automation for scheduling CTs or diesels, other real-time resources, and that's unnecessary and inefficient. The PJM dispatchers are using a phone call to call on resources in real time and to call them off when, both on the PJM side and on the resource side, there should be software that sends specific call on and call off times that could then be used for accountability in the uplift settlement rules. And this ties back to that self-commitment issue because what you're looking for is economic and flexible and precise timing of when you need the resource on, when you need the resource off, and certainly there's plenty of automation and software available to make that happen and to create that accountability for when it doesn't happen. Thank you.
Thank you. I want to check to see if any panelists have follow-ups or if the chairman or commissioners have any questions they would like to ask.
This is Commissioner Clemens, I'd like to jump in with a question.
Great, thank you.
Thanks. This goes back a little bit to the previous question, but certainly is related to the set of answers that you all just provided. So if flexibility is not valued and therefore not compensated properly, I would think intuitively that good scarcity pricing on its own would incent some level of flexibility, so you capture the profits when the prices go high and you avoid operating, right, when the prices go low, but it sounds like this isn't fully working. I'm just wondering, when you talk about whether we need capacity changes or a ramping product or, some combination, how do we think about the part of the solution set on valuation that is the efficacy of scarcity pricing approaches?
not sure who was first there. Karen?
Yeah, thank you, Michael. And I'll follow up with Commissioner Clement's question as well. But I just wanted to, point out that consumers in general are not a big fan of self-commitment. I think what we agree is we would love to pay for the flexibility. What we don't want to pay for is inflexible units that commit themselves when they're otherwise uneconomical. So if they have a certain plant or that they want to keep online, but it's not necessarily clearing certain markets, and they want to continue to operate and get payments for it, we certainly don't want to prop up uneconomical products. And I think so in looking at the market mechanisms to try to disincent that, and I think, what Dr. Bouchet said, sorry about that, is, we have to work to incent for those not to commit. And I think what Dr. Tyler had said was, instead of maybe penalizing, we're taking away that carrot. And so, I really think that from the consumer perspective, we want to pay to make sure that we have secure power, but we're not going to prop up uneconomical generation resources.
Thank you, Karen. Joseph, did you have your hand up earlier?
I did, but it was in response to something one of the other panelists said. So why don't we continue with some of the responses to what the commissioner's question is?
Tom Kasla, I believe you were next.
Thank you, Michael, and thank you, Commissioner Clements, for the question. I think there's one thing that's useful to keep in mind when trying to understand why the current mechanisms don't work as well. If a market signal relies on running out of operating reserve, that's the definition of scarcity, at least under the paper performance. Those events can and do occur. The event that we had, I think, was due to a substantial change in import flows that actually turned to exports in New England when Hydro-Quebec experienced some problems on their own system. So that was I would consider that's a pretty extreme event, probably one that the ISO operators didn't plan on for that particular day. But if there's an absence of flexibility initially on the system, just to say some of the resources that are there are removed, ultimately in the day-ahead scheduling, the ISO is still responsible for developing a reliable operating plan for the next day. They can't plan into a scarcity. Indeed, they take actions to avoid that. So we've put ourselves in the situation of relying on a market signal that only comes into place when we run out of what we need. Probably not a good idea to rely solely on that, hence our companies and others within New England's focus on market signals that would send a premium for flexibility when the systems may be a little bit tight, but not in deficiency. And something that's more tied to the capacity market, not to rule out the possibility of something like ORDC, though I appreciate Karen's earlier comments about side effects of that. But something that requires everyone to provide more contribution toward avoiding scarcity events as opposed to awaiting the outcome of the scarcity event. I was a big supporter of PFB, thought that was a great idea at the time, and just finding out through experience that maybe we had a great design just off by a slight hair. Thank you.
Sherman, I believe you were next.
Sure. Thank you, Commissioner Clements. I think it's a good question on scarcity pricing. I think that the answer that I would give is 50%. It would help part of it. So scarcity pricing occurs, typically during real-time operations. So for those generators that are offline or are at their min, yes, it provides a very strong incentive to move up quickly, flexibly, as fast as you can. But for those generators that are online and running at top load, or were committed in the day-ahead market, it doesn't do anything. It doesn't incentivize the flexibility that's inherently there. So, bringing it back to an example, back to a combined cycle provides a huge amount of flexibility for the grid. They move up and down all the time, but when the market is tight, they're dispatched on the day-ahead market typically all the way to the top. They still have a tremendous amount of flexibility inherent because they can ramp down dramatically. So, for example, if wind or solar, or really it's wind, has a lot more output than expected, you can ramp those units down. That has a value. Scarcity pricing doesn't actually help that because they're already dispatched to the top, doesn't provide any more incentive for them to be flexible. So I think partly, but I don't think entirely.
Thank you. Greg, I think you were next.
Yes, thank you. I agree with Sherman's comments, and I would add that a lot of times in SUP, we only have a 5-minute scarcity price signal, so that tends to be actually too volatile for some generators to respond. The other thing that we observe is that system operators will actually commit units ahead in real time, which has the effect of removing those price scarcity signals. And so even though they committed a unit to get more flexibility on the system, that price signal does not make it into the market. So that's the other reason why it's important, I think, to look at these rent products and uncertainty products, which solve specific issues, just like Computer Series does solve specific issues on the system. Thank you.
Thank you. I think you broke up a little bit there for me. Did you finish your comments, Greg?
Yeah, I'm done. Go ahead. Thanks.
Thank you. Catherine, I think you were next.
Yeah, thank you. Shortage pricing is very important, and we do see, and I think it was expressed in the last conference by PJM that a operating reserve shortage is really considered to be an unacceptable outcome, and it's something to be avoided at all costs from the operations perspective. And perhaps we see shortages occur, especially short-term ones, that don't turn out to be a crisis, and the operators are not taking emergency steps to avoid it. So there's something of a mindset that is limiting the amount of shortage pricing that we're seeing, at least in PJM. And of course, we're facing a market design change that's imminent in May 2022, where PJM wants to extend the operating reserve demand curve out so that essentially what you get is scarcity pricing all the time, which is much more costly than and a much less targeted price signal than the shortage pricing that we see today. So that's an important distinction to make, and there is something that needs to be done there in ORDC reforms, and also with that mindset around what a shortage means, especially if it's not a crisis and not going to last that long. Thanks.
Great, thank you, Catherine. Nicole, excuse me.
Thank you very much, and thank you, Commissioner Clement, for the focus on the incentives for flexibility. What the NYSA rules do is focus really specifically on those incentives for flexibility, and the question is entirely correct that scarcity pricing is part of that solution. And again, it's really that focus on the real-time markets and on the needs that is really driving that. And yes, I love this discussion of carrots and taking away the carrots. We don't see that the right answer is to focus on capacity market compensation for flexibility, because it's just not at the right time when we need it, and it's hard at that point to match sort of performance with what it is that was purchased. We have under and over generation penalties in the settlement and dispatch model, in real time, and those intervals align perfectly. So If they are not performing, we have a penalty for it. And in addition, to go back to some of the discussion, we do not provide make-whole payments for units who are self-dispatching either. So we are taking away sort of the carrots, to go back to that. And we think that that is really the way to go, because you're tying performance to when you actually need it. Thank you.
Thanks, Nicole. I wanted to circle back around to Joseph. I might have missed your hand earlier. If so, I apologize for that.
No, it's okay, and I realize we're short on time, so I'll keep my response as brief as possible. But it ties into what sort of the theme that we've been talking about carrots and sticks. And one of the things that keeps me up at night is that if, as has been mentioned by a couple of the other panelists, and my research also says the same thing, if you have a group of power plant operators, the vertically integrated utilities, not responding to the current suite of carrots and sticks, then I'm not entirely convinced that changing the carrots and sticks are going to necessarily precipitate the changes that you want. So take the multi-day commitment practice that SPP is considering. Well, most of the coal plants that I'm aware of that self-commit in SPP, and I'm certainly not aware of all of them, but what they use for their commitment practice is a 7 to 10 day outlook of prices. And so if they get, now 2-day outlook from the market versus their own internal 7 to 10 day outlook, well, they're still going to self-commit at the same level that they have been, because their window for commitment is 7 to 10 days and not 2 or even 3. So that's where all right, well, if that doesn't work, what can the commission do? Well, actually, information and education can be a huge factor in helping precipitate change. And I'll take some ownership to some of the confusion around self-scheduling and self-commitment within my world, because the first time I wrote about this issue was 5 or 6 years ago, and I used the two terms interchangeably and was very quickly corrected, and I appreciated that. But it was about 6 years ago, talking about SCP, self-commitment practices, and almost immediately afterwards, state regulators would come up to me and say, oh, well, they never heard about this issue before. It just wasn't on their radar. But when I talked to people at SPP or the SPP Market Monitor or people at FERC, they were all very much aware of this issue. It was just never getting out into the public. It was never getting into the commissioner's hands. And so really engaging with those, with the public, which hopefully the Office of Public Participation will help do, and engaging with state regulators through venues like, which the commission is doing with transmission, with the Joint Task Force, but doing similar types of engagements directly with commissions to say, you can't necessarily report all of this data publicly because there is a lot of confidential information, but a way of saying, all right, well, we can't help but notice that the distribution of PMIN for coal units is really clustered around 30 to 50%, but there's a whole bunch owned by one utility that's at 70%. Why are they outliers? Are their boilers somehow of a unique vintage that they have to operate differently, or is there some other underlying factor that we can get at? And by publishing this data in a way that respects confidentiality, obviously, there's a certain level of shaming them and praising others for those who are operating the most flexibly, or operating the least flexibly. And I think pursuing or exploring those options through technical conferences, through direct engagement with the states, is a really powerful tool that I hope the Commission avails itself of.
Thank you very much, Joe. I think we have that's our final question from the agenda that we're going to be able to get to. I'd like to check in with our chairman and commissioners to see if you have any final questions for the panel. Oh, I think you're on mute. I can't hear you, Mr. Chairman. I actually can't. Oh, sorry. If you type your questions in the chat, we can ask her. Sorry, we can't hear you. Sorry, but hopefully we'll address your audio issue later, Mr. Chairman. But I think we'll go ahead and close this panel. I really appreciate, on behalf of my colleagues in the commission here, We really appreciate the panelists joining and, of course, the chairman and commissioners. We heard a lot of really important information about, I think we're learning just how difficult it is to operate ISO RTO markets. We have different regulatory structures, different costs, fuel supply arrangements, a lot of resource capabilities that have to be accommodated in these offer rules. So we really appreciate your expertise to make sure we understand the full breadth of complexity and your solutions. We're going to go ahead and close this panel out. The next panel will start at 11:15, and it's called Maximizing the Operational Flexibility Available from New and Emerging Resource Types. So again, to the group, thank you very much for joining all our panelists and chairmen and commissioners, and we hope to see you back at 11:15. And Capital Connection, we can go ahead and put on the hold slide. Thank you.
Hello, everyone, and welcome back. Thanks to our first panel for an interesting and informative discussion. It's time to start the second panel today, which focuses on maximizing the operational flexibility available from new and emerging resource types. My name is Aaron Siskind, and I work in FERC's Office of Energy Policy and Innovation. I'm joined by my colleague, Robert Ferris, with the Office of Energy Market Regulation. Panel 2 will run through approximately 12:30 and will focus on whether current RTO, ISO, energy, and ancillary service market rules present barriers to relatively new and emerging resource types, and if so, how market rules could be changed to allow these resources to offer in their full capabilities to the market, since permitting all resources, including new resource types, to offer in a manner that maximizes the operational flexibility available to RTO, ISO operators will better enable system operators to manage changing system needs. I would also like to remind all participants to refrain from discussing the specific details of the pending contested proceedings listed on the supplemental notices issued on October 1st and October 7th, 2021, and to refrain from any discussion of other pending contested proceedings. If anyone engages in these kinds of discussions, my colleague Adam Eldine from Office of General Counsel will interrupt the discussion to ask the speaker to avoid that topic. And thank you to our panelists for joining. To our panelists, chairmen, and commissioners, please use the hand raise button if you'd like to ask a question or respond to another panelist. The first question is addressed to all panelists. I will call on each panelist in turn to give their response. I'll ask the panelists limit their initial response to no longer than 5 minutes. After all panelists have spoken, we will give panelists a chance to respond to what others have said. So our first question, do existing RTO, ISO, energy and ancillary service market rules, practices, or procedures prevent or otherwise obstruct relatively new and emerging resource types, such as variable resources, hybrid resources, and energy storage, from fully participating in RTO, ISO markets and offering the operational flexibility they are capable of providing from a technical standpoint? Our first panelist is Betsy Beck from Enel North America. Please go ahead, Betsy.
Thank you, Aaron, and good morning for commissioners and staff. Thank you very much for the opportunity to participate in today's technical conference on energy and ancillary services. As Aaron mentioned, I'm Betsy Beck, and I'm the Director of Regulatory Affairs for the Central and Western U.S. for Enel North America. Enel is a leading developer, owner, and operator of renewable energy plants in the United States, with over 6.5 gigawatts of wind, solar, geothermal, and battery storage currently in operation, and several gigawatts currently under construction. We also are one of the largest providers of demand response in the country and also have an emerging distributed energy resource business. So we bring many different perspectives to this discussion. In general, we believe that existing energy and ancillary service market rules on paper do not limit participation of new and emerging resource types like solar and battery storage. That said, existing energy and ancillary service markets have historically been designed around system needs and operating characteristics stemming from conventional resources. With our rapidly evolving energy grid, there is a need to reevaluate certain market processes and procedures to ensure that they are enabling robust participation of new and flexible resources and sending efficient price signals. We do believe, and our experience has shown, that by and large, energy and ancillary service markets do not explicitly limit the participation of specific resource types. Order 841 and other efforts in the past several years have led to a close examination of tariff language and have mostly eliminated discriminatory language barring the participation of certain resource types. One exception to this limitation is on dispatchable variable energy resources and their ability to participate in the regulation up market in SPP. We're sure there are still a handful of other markets that bar participation, but by and large, these issues have been addressed in recent years. When it comes to the question of what is limiting flexibility and the participation of new and emerging resources in today's markets, I will echo and expand upon some of what was said by Mr. Daniel and Mr. Knight in the prior panel. Today's markets were built and designed around conventional resources who have traditionally not been highly flexible power plants. This historical bias towards the characteristics of conventional resources has direct and indirect consequences. As has been previously discussed, practices like self-commitment and self-scheduling of resources limits the ability of operators to dispatch down or turn off those resources. While, as Mr. Daniel noted, renewable resources like wind and solar can always be dispatched down to zero. Further, the participation of these non-price responsive resources in the markets mute and distort the price signals sent to the rest of the market. Also, parameters like PMIN and minimum runtimes are other elements of energy market dispatch protocols that need to be examined to evaluate their bias towards conventional resources and the impact that it's having on efficient pricing and flexibility. While these parameters were once necessary to run the market and solve for blocky resources, by continuing to solve around these characteristics, we ultimately compensate resources for their costs of inflexibility. Ultimately, this is muting price signals for resources like battery energy storage and hybrid resources that can provide near infinite flexibility. Additional elements of energy and ancillary service algorithms similarly limit the full flexibility of new resources to respond quickly, and as quickly as and precisely as they are technically capable. One great example of this that was also previously mentioned is ramp rate limitations. In SCP, where the bulk of Enel's wind fleet operates, for dispatchable variable energy resources, or DVRs, smaller than 200 megawatts, ramp rates are limited to 8 megawatts per minute. And for units that are larger than 200 megawatts, they're limited to 4% of their capacity per minute. So as Mr. Knight pointed out earlier, these fast-responding resources are capable of moving quickly in response to dispatch signals, but are limited in their ability to do so, and are paid the same energy price as all other resources. And I think it's also important to point out that this ramp limitation in SPP persists even after all non-dispatchable variable energy resources in SCP have been required to invest hundreds of thousands of dollars to retrofit plants to comply with new requirements to be fully dispatchable, a change which we did support. Lastly, as it relates to the flexibility delivered by ancillary services, I want to echo some of the sentiments we have heard today that we need to increase the quantity of ancillary services procured. We must recognize that the single largest contingency may not always be a large nuclear or coal unit tripping, but potentially a change in the jet stream affecting wind production or an unexpected storm impacting solar production. For Enel, ancillary service market fundamentals, the quantity procured and the price paid for them are some of the key factors we evaluate when it comes to investing in battery energy storage. And I think it's important to note that ERCOT is currently sending very strong investment signals through its ancillary service markets for investment in battery energy storage. So in summary, we don't believe that market rules per se are limiting flexible resource participation, but existing and legacy market design elements are having direct and indirect impacts on market dispatch, pricing, and compensation that are muting investment signals for new flexible resources. Thank you, and I look forward to our discussion.
Irwin from the Energy Storage Association. Please go ahead, Jason.
Great. Thank you so much. Thank you to the staff and certainly to Chairman Glick and Commissioner Clements, who is, I believe, attending this technical conference, for putting this together. This is a very important topic, certainly for the energy storage industry. I'm happy to speak to these topics from the perspective of the energy storage industry. Thankfully, Betsy did a great job of framing out the problem here, so I don't have to repeat to you the importance of how we need to avoid unduly discriminatory treatment by reducing our reliance on these accommodations for inflexibility that are built into market rules and processes, particularly because we have now other commercial technologies, like, for example, current-day battery storage, that demonstrate such accommodations are increasingly not necessary. And in addition to, as Betsy noted, revealing the presently embedded costs that inflexibility poses to system operations and allowing us to have more robust price formation that reflects the value of flexibility. It's also about increasing operational efficiency and reducing reliance on out-of-market actions to be able to provide flexibility. So from an energy storage perspective, we don't have a lot of experience with significant levels of storage in energy markets, not only in just the megawatts deployed, but also the track record in energy in multiple ancillary services. A lot of storage is, of course, been providing frequency regulation. So we are still learning as we go, as these new technologies begin operating at scale in energy and multiple ancillary services markets. And suffice that markets have been showing they can lean on assets like storage, which has no start times or ramp limitations or P-min. And I expect we'll learn plenty over the next couple of years beyond just the topics in discussion today. But one of the first things we're learning is that flexible storage is running into market processes that are not providing commensurate operator control, because, again, they weren't designed with that thought in mind. The system operators level resource that is always online and bidirectional and ramps instantly and quickly, but this flexibility might not be used appropriately due to the simplifications or accommodations in the market rules and operating practices. So in the California ISO, we're sort of seeing a first window into this. Storage is being reflected in the software as infinitely flexible. That's good. That's what Order 841 was intended to accomplish. But storage assets are getting jerked around significantly as you move from hour ahead to 15-minute ahead to 5-minute ahead optimization and then dispatch due to that flexibility. And that's incredible. The ISO has an asset that can turn on a dime and move around significantly as you approach a given interval, but asset managers, they're locked into bid parameters 2 hours in advance of the interval. So all that flipping around doesn't actually include significant updates to standard charge or operational status of the storage, price preferences of the storage's plant operator, even as the lost opportunity cost is swinging around a whole bunch during those different optimizations. So that disconnect between slower bidding rules and fast and frequent change in dispatch or potential dispatch instructions can impose significant costs on storage units with uneconomical awards. We're seeing a lot of out-of-merit dispatch of energy storage in CalISO, maybe 10 to 20% of intervals lately, including that, and that seems to suggest some trouble with forming price signals to produce the desired behavior within market. Certainly one potential solution that I think we can take from this is that asset managers' discretion should match the flexible capability of the asset. So a helpful solution might be allowing storage asset managers the ability to more readily respond to real-time pricing and dispatch volatility, such as allowing them to modify bid parameters much more close up to the sched interval. I note this is apparently the planned new practice for storage in ERCOT, and this could certainly allow for better price formation that reflects asset options and preferences, which helps us deal with the second issue of out-of-market actions. We are seeing out-of-market actions affecting storage flexibility. CalISO has a requirement for storage used for RA to maintain now minimum state of charge. We're seeing pricing anomalies leading from time to time to exceptional dispatch decisions that effectively now are keeping storage from dispatching, so in interaction with that requirement. those periods where storage is being forced to hold its state of charge despite price signals that indicate otherwise are first a lost opportunity cost that is not being compensated, but also at the same time, those units are removed from the market temporarily, affecting price formation. This is in contrast with thermal generators that are regularly kept burning fuel and spinning because their startup lead times might otherwise make them unavailable in future intervals when they may be needed. Those generators are paid to remain at P-min value. Those actions are therefore compensated even when they're not necessarily benefiting the market during that pricing period. More generally, those thermal generators are otherwise free to participate in markets. So I think we need to be reducing reliance on out-of-market actions to produce flexibility. That reduces the price signal for flexibility that might otherwise be available for other assets. And it is really inappropriate for out-of-market actions for one resource type to be accommodating their constraints and paying them for it, whereas for another resource type, those assets are penalized for their constraints and are not paid for it. We need to be doing what we can to reveal price signals for flexibility, not obscuring them. So on this count, we should be minimizing the distortions of out-of-market units on price formation, and perhaps more radically, in keeping with an idea of a performance-based future where resources can make single-part offers because they no longer need to have startup times or ramp rate limitations, we could see a world where we're eliminating those kinds of make-whole payments based on inflexibility and letting the generators actually go procure the flexibility they need rather than have the system operator granted administratively. Certainly, I think there's a lot more to say also about the nature of how ancillary services markets could be evolved into a wider set of flexibility reserves that have been covered at least at some part in earlier parts of this and the previous technical conference. I think a key thing that we would raise here is that when you have current day ancillary services valued on the lost opportunity cost for providing energy, but in the higher renewables world, we're going to have energy prices presumably lower zero for significant stretches. That poses problems for valuing flexibility, especially if that main reference is energy pricing. So how we value flexibility, if it's an ancillary service or a flexibility reserves construct, may need to be revisited and independently derived. I know that we've obviously had a discussion of ORDCs in these technical conferences before as one way that might look, but pay-for-performance principles, to the previous notes I've made about who bears and presents the costs and benefits of inflexibility and out-of-market action, pay-for-performance principles also point a way to ensure flexibility reserves or ancillary services show up as needed. And that can evolve from use only for system emergencies to something continuously assessed in markets where flexibility is needed, and they can be designed to not be a cost to load, but rather a transfer between less flexible and more flexible assets based on the performance meeting the needs of the grid. The grid of the future will need more flexible, fast-starting resources, so we need to make sure that we reflect the cost of a lack of performance to meeting that. Anyway, I know I've gone a little long. I'll conclude just by saying that my remarks today on the need for better asset manager control flexible resources, on avoiding out-of-market actions that distort price formation, on moving to a new conception of ancillary services as pay-for-performance-based flexibility reserves, these all point potential paths forward, given the needs of a higher renewable energy system and the availability of flexible storage technologies. But I'm sure we can take a wide view on many different paths forward. I'm just eager that the Commission continue to ensure policy keeps up with technology rather than let the technology limitations of the past constrain our future. Thank you.
Thank you, Jason. Our next speaker is Mike DeSocio from New York ISO. Go ahead, Michael.
Thank you, Aaron. Good morning. We very much appreciate the Commission for its focus on these important issues, and thank you for the opportunity to be part of today's conference. The topics are front and center in New York, and I'm looking forward to today's conversation. New York's market design is structured to promote flexible resource operation. From the beginning, the NYSO set out to develop features and advancements to enable new technologies, like limited energy storage resources. Back in 2009, we enabled those types of resources to provide frequency regulation when they came to us and offered discussion of their capabilities. And again in 2009, we enabled wind on dispatch, where we allowed resources to provide costs of dispatch and let the ISO consider those costs when dispatching, which has become vital in trying to balance today's grid. The structure is built to reward those that can move quickly, follow dispatch instructions closely, and be responsive to emerging grid needs. New York's energy and ancillary service markets are open to all resources that can meet minimum eligibility requirements. There is no prohibition that prevents a resource, existing, new, emerging, from participating. However, sometimes the characteristics of new resources require new functionality or dispatch constraints to be modeled, and often this is referred to as a barrier. In fact, wholesale markets were created to maximize consumer surplus, and ISO RTOs were given great responsibility to operate the grid as efficiently and reliably as possible. To do that, ISO RTOs have information that is critical to grid operations and confidential market information about each asset participating in the wholesale market. It is true ISO RTOs also make as much data transparent as possible to improve market competition. But ISO RTOs also have confidential data on costs, output levels, current response rates, and future commitment of resources. This information asymmetry places ISO RTOs in the best position to make decisions that maximize consumer surplus for all customers. This can best be achieved when ISO RTO has line of sight to schedule and settle each resource, rather than aggregating these resources and leaving optimization to the set of resources to a market participant. That said, aggregations are still important when thinking about managing sets of small resources, and the ISO has created rules for such a structure through its DER participation model. Being responsive to feedback from its stakeholders, NISO continues to focus on improving its market models and minimizing any perceived barriers to participate fully in its wholesale market. For example, NISO led the way with implementation of a full energy storage model, which was released back in August of 2020. The NISO is working diligently to implement its FERC-approved DER participation model and address new requirements presented by Order 2222. The NISO is on track to implement its FERC-approved co-located hybrid storage model by year-end. The NISO also continues to work with its stakeholders, considering opportunities for aggregation model for hybrid resources. And finally, the NISO is working to develop a model for new internal HVDC lines that are planned to deliver clean energy into New York City. These are just some of the improvements to New York's market structure that is important to make sure all resources can participate wholly. However, to facilitate and be prepared for the clean energy transition and the grid of the future, we need to think more broadly than participation models. As the fleet transition to one that is largely based on renewable resources and energy or duration-limited resources, the ISO also needs to be thinking about how their market structure, look-ahead capabilities, settlement structures work together to ensure that the resources continue to respond to grid needs and operator instructions. The NISO's grid and transition efforts are critically focused on evolving its market structure and looks forward to working with Commission and its stakeholders to continue to build upon New York's well-designed wholesale market structure. In addition, we need to be thinking about opportunities where we can strive to increase the ability for resources to submit additional data to the ISO more frequently. I think Jason Berwin said it very well. There is a need to provide additional information more frequently, and the ISO is working on that. In fact, for its energy storage model, the ISO encourages that energy storage resources reach out to the ISO and look for ways to make offers more frequently in real time. And this promotes improved efficiency and better price formation. But we are transitioning, and we don't have a grid fully dispatched based on renewables energy storage. So in the meantime, we still need to manage these constraints, such as PMINs and response rates, to make sure that we keep the lights on as we transition. All of these pieces and parts are important, and the ISO continues to look forward to working with the stakeholders and the Commission on improving its market design. Thank you.
Thank you. you, Michael. Our next panelist is Brian George from EPSA. Go ahead, Brian.
Well, good morning. Thanks, Aaron. Good morning to you, and thank you to Chairman Glick, the commissioners and staff for inviting me to participate on this important panel and continuing the broader dialogue around modernizing electricity market design. As always, my views today do not reflect those of a particular EPSA member. As the trade association representing America's competitive power suppliers, EPSA believes that well-designed competitive electricity markets should provide price signals based on well-defined operational needs, such that all qualified and capable resources can compete to maintain reliability at the lowest cost. EPSA members own and operate nearly 150,000 megawatts of generation capacity from all types of fuel sources. Today, our members are actively developing new wind, solar, and battery storage projects all around the country. Our members' experience in developing and operating these resources can provide unique insight into how the Commission can utilize competitive markets to maximize the operational flexibility available from new and emerging resources. Efforts by the Commission to reduce barriers to the participation of new and emerging resources, such as Orders 2222 and 841, have helped ensure these resources can compete in wholesale electricity markets. In particular, the biddable parameters for energy storage resources included in Order 841 was a good first step. However, operational experience may highlight areas for additional exploration and potential revision. Importantly, the Commission should strive to design markets based on well-defined operational needs where all resources capable of providing a service have the opportunity to do so. While the Commission must remain vigilant for market rules that erect barriers to resource participation, it should avoid designing markets around the capabilities and limitations of particular resources. The question for intermittent and use-limited resources is less about their physical capability to provide certain services and more about providing the right incentives. In many cases, the potential to provide essential reliability services, traditional ancillary services, or flexibility already exists. As such, unlocking the full potential of intermittent and use-limited resources will require well-designed markets that align individual commercial interests with system operational needs. And I think Jason put it well when he was describing it, and I think we would agree. For example, and in general, system operators who optimize large amounts of resources across geographically diverse balancing areas have more information about system-wide operational and reliability needs than do individual asset operators. Conversely, individual asset operators who optimize their resource from a commercial perspective may not have full insight into the broader needs of the system at a given point. Due to this information asymmetry, system operators may take action to posture use-limited resources based on an operator's expectation of when that asset will be most valuable to meet system needs. For use-limited resources like storage, this can result in a mismatch whereby assets are required to maintain a day-ahead schedule for a period that does not align with its greatest arbitrage opportunity in real time, particularly during tight conditions. While this example highlights some optimization challenges around use-limited resources, which will be addressed largely in the next panel, it also highlights the importance of allowing price signals to accurately reflect system operational needs. We should focus on getting as much information into the price signal so that asset owners can make the best commercial decisions that also reflect the best reliability outcomes. Going forward, successful integration of higher levels of intermittent resources requires maximizing operational flexibility. Operational needs such as flexibility are exacerbated by increasing levels of intermittent and use-limited resources. This effect will become more prominent as percentages of intermittent and use-limited resources increase. To effectively integrate more, we must maximize the operational flexibility of use-limited and traditional resources to offset the variability and uncertainty on the system. More broadly, as the economy decarbonizes, the power sector will be responsible for delivering more electrons without compromising reliability, while the power sector itself is simultaneously transitioning to a lower carbon generation mix. This highlights the critical need to have well-designed markets that align commercial interests and operational needs so that we can maximize the full value that all resources bring to the table. Thank you again for the opportunity to participate on today's panel, and I look forward to the conversation.
Thank you, Brian. Our next speaker is Dr. Walter Graff with PJM. Please go ahead, Walter.
Thank you, Aaron. Thank you, Mr. Chairman, commissioners, and to the FERC staff for organizing the panel today. I think it's a well-organized panel to dig a little deeper into a range of important topics related to flexibility, and I do appreciate the opportunity to represent PJM here today. My name is Walter Graff. I'm the Senior Director of Economics at PJM Interconnection. So I'm going to kick off today with a bit of a devil's advocate position. Perhaps there will be something here that strikes a nerve or gets a response from other panelists and spurs a discussion with my fellow panelists. I'm very much looking forward to learning from the other panelists here today. So at the risk of being labeled anti-flexibility, my thesis is that the objective should not be to maximize operational flexibility, but to incentivize the efficient level of operational flexibility across all resources, given the relative cost of providing that flexibility and given the needs of the system for that flexibility. So PJM happens to be behind some other areas in the country with respect to penetration of emerging and intermittent technologies. So we have the benefit of having a little more time to address any market design deficiencies before they become problems and to observe what does and doesn't work in other ISOs and RTOs across the country as they face higher penetration of renewables before we do. So I won't spend much time on it here as it best fits under the panels, the topics covered under panel 1, but I would point listeners to take a look at the pre-conference comments that I filed to discuss the trade-offs between incentives and requirements for flexibility. The high-level takeaway is that incentives for flexibility are a natural result of well-functioning energy and ancillary service markets that reflect the balance of supply and demand throughout the day. And operating flexibly and investing in the capability to operate flexibly has real costs. Echoing some of the comments Mr. DeSocio made earlier in this panel, PJM continues to believe in the ability of the competitive market to signal value through prices and the ability of the competitive market participants to best make those trade-offs. So it is our role as market designers to ensure that the market best reflects value and incentives, and that the incentives facing resources are aligned with what we'd like them to do. Dr. Tyler, the Deputy Market Monitor for PJM, in the last panel pointed out a number of ways that she and the IMM believe that there are deficiencies that could be corrected in the market to better reflect the value of flexibility, to better incentivize flexibility, and to penalize failures to perform. I may agree with some, disagree with others, but here I do think there's a point of fundamental disagreement with the perspective that we must maximize flexibility. Trying to use the capacity market or any other means necessary to enforce an obligation for maximum flexibility will ultimately leave efficiencies on the table, and it will leave flexibility on the table. As Mr. Knight pointed out in the last panel, enforcing minimum standards means that we're going to get minimum performance at the standard, rather than unlocking all the flexibility that's available from each resource at the right price. And so, agreeing with Dr. Boucher from the last panel, incentivizing flexibility and ensuring that we have sufficient flexibility when we need it is the role of the energy and ancillary service markets. We certainly see at least a few ways that we can improve these market rules and procedures to enable new and emerging resources. Finally, getting right at answering the initial question. In general, PJM believes that operational needs should guide the design of needed services and should not be compromised to accommodate resources that are unable to comply. That said, there are cases where value can be unlocked or enabled without compromising on these operational requirements. So one example that PJM is considering today is the potential to redefine certain ancillary service products as separate up and down products, which PJM does not have today. This could have at least two distinct benefits. First, it allows the demand for those products to be differentiated if that's warranted by system conditions. So it might not be necessary to procure as much up ramp as down ramp or vice versa under certain conditions. And second, it allows different resources to supply different parts of what is today a single product. if and when that's a more efficient use of resource capabilities. So for example, intermittent resources operating at their full available capability can offer fast responding down ramp capability without curtailing first to a lower level of operation. And at the same time, thermal resources dispatched at their economic minimum can offer fast responding up ramp capability. Together, these resources can provide the total needed ancillary services at lower cost than would be possible under a single product definition. So this, and maybe there are other examples as well, we think that there are ways in which the current market design does limit flexibility and can be improved. But overall, we think that the definition of the various ancillary service products should be informed by both system requirements and resource capabilities. And as new and emerging resources become more widespread, it will become important to continue to evolve product definitions. We think that by respecting both, we can efficiently enable the flexibility inherent in each technology without compromising the operational needs. Thank you for the opportunity, and I look forward to the discussion.
Thank you, Walter. We appreciate that. And our last panelist is Dr. Nikita Singhal from EPRI. Please go ahead, Nikita.
Thank you, Chairman, Commissioners, the Commission, and the Commission staff for inviting me to speak today and providing me with the opportunity to discuss on these pressing issues that the industry is facing with. RTO and ISO market rules, practices, and procedures are generally designed to enable and increase resource participation in energy and ancillary service markets to enhance competition. The bulk system operators generally endeavor that their rules do not discriminate against any technology or resource, but they require that certain characteristics and capabilities of all service providers be met. Market rules should be technology agnostic in that any resource will need to satisfy existing performance requirements to qualify for service provisions. Restrictions on participation in a specific service may be applicable based on probably specific resource attributes or failure to comply with well-established performance requirements. Now, such performance requirements or eligibility criteria are typically employed to qualify a resource's participation in the provision of ancillary services and are often based on a stipulated reliability standard requirement. However, it is important to ensure that such restrictions are based on attributes and resource performance that are founded on technically sound principles. It is also important to regularly allow new and emerging technologies to provide their performance and demonstrate that they are able to participate and meet these requirements through testing and certifications. For instance, some ISOs do have response rate tests. For some emerging technologies that potentially consist of mixed resource types, restrictions and participation in a specific service may be applicable based on the technical capabilities, attributes, and performance of the most limiting resource in this technology mix. For example, let's take the case of hybrid resources. These hybrid resources consist of storage and variable energy resource components, for instance. And if they were to elect to participate in the market using a single integrated resource model, restrictions on participating in a service may be based on technical capabilities, attributes, and performance of the most limiting resource. This limiting resource may be the storage component or the variable energy resource component. In other words, eligibility criteria may be dependent upon what the individual resources that constitute this hybrid resource mix are qualified to provide and able to provide. If the hybrid resource were to elect to participate as two separate independent resources using the two independent resources model, then each constituent technology will need to satisfy the existing eligibility requirements. That is, variable energy resources may need to be curtailed to provide most ancillary services. Storage must have sufficient energy to provide, based on the state of charge, to provide most of these ancillary services. Now, another form of operational flexibility that was offered to these emerging technologies in the context of storage was specifically mentioned in FERC Order 841, which is to do with state of charge management. According to one of the requirements, storage was allowed to self-manage their state of charge. Now, this is a very important operational flexibility that was provided to these emerging technology resources. There was discussion by the prior panelists about the ability to update the offers closer to real time. Now, the challenge there is that offers are allowed to be updated closer to real time, but there is existing discussion on whether or not there is enough time to mitigate those offers. So typically, these offers are updated close to the real-time market window, about 60 to 75 minutes. So if these offers were allowed to be updated closer to real time, will there be enough time to mitigate these offers? That's where the question comes when it comes to updating offers as well. Thank you.
Thank you, Nikita. So before we go to the panelists' responses, we first wanted to check and see if the chairman had anything to say, and if not, we'll move along to the commissioners. Mr. Chairman?
Thank you, Aaron. Just quick, I wanted to pick up on the previous comment on this single up, and I wanted to ask maybe Jason, because I know we have limited time here, but maybe if you and maybe Betsy can respond. I'm just curious on the hybrid. I'm real interested in the hybrid resources and curious about what changes you think might need to be made in terms of market rules, given the benefits that hybrid resource might be able to provide in terms of flexibility. What changes you think might be necessary to be made in the RTO ISO market rules to further encourage the ability of those technologies to participate in the ancillary services and energy markets, for that matter?
Good thing. Thank you.
Thank you, Commissioner. I'm sorry, Dr. Jason, go ahead.
Go ahead, Nikita. I think the question was for you first.
Okay. I was just going to say that the one change that may help is to allow these technologies to participate using multiple participation options. For instance, the 1 hour option, which is being widely discussed in the industry, that allows for significant operational flexibility from the asset owner's perspective. Whereas, on the other hand, the 2 independent resources option allows for the unique characteristics of each technology that constitutes the hybrid resource to be modeled more accurately as well. So just having the multiple participation options itself may be a good flexibility to have.
Thank you.
And then, building off that, I think that, as Nikita noted, the sort of concept of state of charge management being characterized in Order 841, that principle of sort of self-management, I think, carries through here on the hybrid resource side as well. I think where we are in some ways is that the asset manager has much granular visibility and control over its hybrid resources. And that perhaps in a theoretical future, you could have a market design that effectively optimizes those assets such that a hybrid resource operator would be satisfied that the way that that resource is going to be used or operated is going to be in line with what an operator decision might be in light of system needs and how they've been communicated. But I don't think a lot of operators are there today. And that's probably part of the challenge here, right, is that the way in which you look at, just simply the day ahead versus the real time for these assets will be very different. And similarly, the extent to which those components of the hybrid can be operated in an optimal fashion to meet needs seems to be, at least from some of our members, Betsy can add further clarity, limited in terms of what they are allowed to offer, given the way that the market may choose to optimize those resources in its software. And so I think that it's really a question of potentially where we are on the path of a transition to the higher computational granularity and potentially complexity that I think is being implied by a number of the different pieces of creating more flexible operations. And so that, at least in the interim, if not for the whole long haul, is probably a key principle to underscore in terms of how hybrids can then be enabled to provide their full flexibility.
Yeah, and I'll just jump in and agree certainly with the both of the answers already to this question.
we think that having multiple participation options is really important, whether that hybrid resource wants to participate in capacity, energy, or ancillary service markets as separate, unique resources or as a hybrid resource. Having that option for us is really important. I think it depends on the market, what that resource is targeting, whether that battery and that hybrid resource is really being developed as a capacity resource, if that battery is really trying to target ancillary service products, depending on the region and the market pricing incentives, we may want to participate in under different participation models and think that flexibility is important. And another reality that we think about and how we participate in the markets is sort of the contracting and investment reality. The way that we contract and build renewables and variable resources today is still somewhat different than battery storage resources. And so sometimes there are sort of outside of the market limitations and realities of how we finance and contract these resources that impact the way we want to participate in the market with them as well. So we think it's important to have the flexibility for that reason, too.
Thank you. Did anyone else want to weigh in on this? Or, Mr. Chairman, did you have any follow-ups?
I appreciate the responses, but no, I don't have any follow-ups. Thanks.
Okay. Commissioner Clement, did you have any questions?
No, I'm fine. Thanks, Aaron.
Okay. Thank you. And just a real quick follow-up to this, because I think we've kind of gone there already. If anyone else did want to respond to one of our next questions, was going to be what market reforms could be adopted to ensure that these new and emerging resource types are able to offer their full operational capabilities into RTO, ISO, energy, and ancillary service markets. If anyone wanted to say anything else here, please, now's the time. Otherwise, we'll move on to our next question. Thank you. I guess you're up, Robert.
I do see a hand from Brian, actually, Brian, if you want to weigh in quickly.
Yeah, I just wanted to weigh in real quick, and I think this maybe goes back somewhat to Walter's point, around, maybe not necessarily maximizing the amount of flexibility, but incenting the most efficient flexibility on the system. And I think that boils down to ensuring that asset owners know what capability is most valuable at a given time. And, this points back a lot to some of the ORDC curve discussions, right, from the last panel. And so I think, just making sure that those asset owners see when their system is most valuable to the system, I think will go a long way in incentivizing that most efficient flexibility. And then the second point that I wanted to make, and this kind of follows on some of Jason's points, around bidding parameters. I mean, I think one thing that we're seeing, right, is that, these certain things change depending on, like, state of charge. For example, ramp rates may be different based on where, a particular resource is with respect to its state of charge. So how do we think about allowing asset owners to reflect those changes in a way that does allow for effective market monitoring and mitigation, but ultimately conveys to the system operator that they do have this ability to provide that need to the system? So, thank you.
Thanks. And I think with that, we'll go ahead and move on to the next question that we want to cover. Hi, everybody. I'm Robert Ferris from the Commission's Office of Energy Market Regulation. I wanted to follow up on a few points that were brought up in opening statements by Betsy and Walter and a few others. And, both of you discussed the fact that variable resources can be dispatchable and provide, different services depending on where their dispatch point relative to their maximum potential energy output. And, I think your discussion was kind of interesting in light of the fact that, folks often refer to variable energy resources as non-dispatchable resources or inflexible resources. When, I think the reality is that, based on your comments, that they are capable of being dispatchable. And I wanted to drill in on that a little bit. Could you just speak to kind of to what extent variable energy resources are capable of being dispatched up versus dispatched down? how this might kind of vary based on their particular operating situation, and try and distinguish them from the sort of dispatchability that's provided by a conventional resource. I think we'll start with Walter. Go ahead, Walter.
Yeah, thanks for the question. I'll kick it off and then interested to hear other thoughts. So I would say these resources absolutely are dispatchable. In PJM, we've been working on enabling intermittent and variable energy resources to respond to dispatch instructions. We're not 100% there yet, but we're working on it. Just a few examples. So we've leveraged SCED, the Security Constrained Economic Dispatch, which has a 2-hour look-ahead period to dispatch wind. The objective here was to improve congestion control, not originally to provide flexibility, but I think there are opportunities to enhance it to better meet that challenge. This market design change specifically introduced a new notification to wind units to indicate that they should explicitly follow PJM's dispatch to reduce output. So they absolutely are dispatchable. For solar, there are more opportunities to improve dispatch logic in the SCED. I think we're not quite as far as we are there with wind. But for both solar and wind resources, the objective is to enable the technical capability to be dispatchable, really to have that be available to the system. As to the distinction between being dispatched down and being curtailed, I think it's probably mostly semantics. The way I understand how we've used those in PJM, I think we tend to use curtail when the operator picks up the phone and asks the resource to turn down, and dispatch when it's an outcome of the various economic dispatch engines that we run at different timeframes. Of course, to the extent that there is value to enabling that flexibility, and we think there absolutely is, we'd love to move away from manual operator actions to enable that flexibility within the economic dispatch engine, and we are moving in that direction in PJM.
Thanks, Walter. Next, let's go to Mike DeSocio.
Thanks, Robert. A good question, and similar to what Walter was just mentioning, New York has had renewables or variable resources on dispatch for quite some time. And we did that early on to make sure that new resources understood what we were looking for when they integrated and interconnected them to the system. The way the New York's model works is we take the approach that we're going to do our best to accommodate the wind or solar forecast output of the resource, and to the extent that resource is providing and maximizing its energy output, our market design is really designed around achieving that, which makes it difficult when you think about combining a intermittent resource with storage, because now you end up with some dichotomy on maximizing renewable output versus doing something different. We use the term curtail because, generally speaking, there isn't an incentive for the renewable resource to hold back its capability so it could be dispatched up at a later interval. So we're really focusing on starting from a point of having that resource have being at its maximum output, and then curtailing it or dispatching it down to control the constraints. And we do that through economics. We aren't picking and choosing which resources to schedule. We look at security constrained economic dispatch to make that choice based on its offer. And this is where it becomes very important that we think broader than just the competitive wholesale markets, because the out-of-market payments to these resources become very important in considering whether there's really optionality for that resource. When you think about having a resource hold back its output, it is now going to forego other payments, maybe a REC payment, maybe an ITC credit. And so in order to do that, that means the wholesale market price needs not only cover that loss of revenue, it needs to overcome that loss of revenue plus loss of energy capability. So you talk about high hurdle rates from a cost perspective for these resources to do that because of other incentives outside of the wholesale markets. Now, New York has been thinking and considering separating its reg up and reg down for a lot of the reasons that Walter mentioned that PJM is considering it. We think there's opportunities to have requirements that may be more effective and efficient across the times of day. We do think there could be potential opportunities for renewable resources to provide regulation down in this case. And we also think that there's opportunities for other resources that may be at a PMN to provide regulation up when today having a symmetrical product that is reg up and down, that resource would be excluded from. So there's some opportunities there, but I think just focusing on the capability of the resource is probably not going far enough when thinking about whether there's value in providing such a feature.
Thank you. Next, let's go to Nikita Singhal.
Thank you. I think Mike covered the specific questions really well. But technically, there is no distinction between being dispatched down and being curtailed. The two are synonyms, but one has typically carried with it a negative connotation. The overarching goal should always be to ensure that a resource is operated in a manner that's most effective from the system perspective and to devise ways to incentivize it accordingly. Now, there may be instances in which a standalone variable energy resource may need to be curtailed to ensure reliable operations or dispatched down to accommodate changing system conditions. Now, from a technical perspective, variable energy resources may be curtailed or dispatched down either due to transmission congestion, either due to which could also be low load or minimum generation constraints, or to ensure that there's sufficient available rampable capacity available to accommodate future instances of unavailability from variable energy resources. For instance, due to limited options to manage transmission congestion, sometimes variable energy resources need to be curtailed to relieve that congestion. Now, during those instances, the VRs must be dispatched down or penalized. Given that these facilities also earn additional revenues from production-based mechanisms in parallel to wholesale electricity market revenues, typically there are limited economic incentives for these resources to provide upward reserve service, such that it requires the resource to be backed down or for it to forego energy sales given production tax credits, for instance. Typically, it is the economics that impacts the ability of variable energy resources to provide upward response, because there are very few instances and conditions when it may be economic to dispatch a resource below its forecasted upper operating limit. For example, curtailing or dispatching down a variable energy resource to provide ancillary services may reduce the need to commit an additional resource. This results in accompanying system benefits in the form of reduced commitment costs that are potentially not always reflected in prices. Otherwise, in majority of the instances, due to the zero marginal cost and the negative offers, these resources are typically scheduled at the upper operating limits. Thanks.
Thank you. And next, let's go to Betsy Beck.
Thanks, and I think the previous panelists mostly covered it well. The only thing that I wanted to reiterate was that, yes, new and modern energy storage, wind and solar resources are very much dispatchable and do follow market dispatch signals. Typically, as was mentioned, because they are going to be the lowest cost marginal resources, the system is just mirroring what the actual output of the plant is at any given time, unless, of course, there is a dispatch down or a curtailment signal sent, at which point all of the automated dispatch signals go to the renewable plants and they can respond very quickly. And as I think I mentioned in my opening comments, SPP did and other markets have required resources to convert to be dispatchable. So some of the older legacy projects that were originally built, a decade ago, did not have the full dispatchable capabilities, but have since converted, spent the money and invested in the upgrades necessary to put those systems in place to become dispatchable. And now just completed this process in SPP for several hundred megawatts of wind that were some older projects. And at the beginning of 2021, we did become compliant with that new requirement and now have a fully dispatchable fleet. And I believe the vast majority of wind in SCP has completed that conversion to date. And so that's great for the operators to now have that increased ability. And again, it was a costly endeavor for some older resources, but something that we were able to make the investments in retrofit to accommodate. But again, everything that's being built now is already being built with those capabilities. But I did want to mention again, one thing that I mentioned in my opening comments was that when wind or solar, for example, is curtailed and then the curtailment is released, those resources are able to come out of that curtailment and start generating again up to their full capability at that time in a matter of seconds, not minutes. And so that is a place where we see those ramp rate limitations come into effect because, prices go up, they want to release that curtailment on the resource, and the resource wants to respond quickly to respond to those price signals, but is limited oftentimes by these ramp rates, even though that they can respond much more quickly. Thanks.
Thank you, Betsy, and all of the panelists for their responses to that question. I wanted to follow up. Considering a number of you mentioned the fact that the incentives really aren't there just based on, prevailing market conditions for a zero marginal cost resource to hold back its potential output in order to provide an up-ramping type capability. How do you see that potentially changing as the penetration of these zero marginal cost variable resources increases? Would that create a greater incentive potentially for resource owners to provide some of these up-ramping capabilities? And in I think either way, or if so, what market rule changes might be necessary in order to accommodate that? Thanks. Mike?
Robert, I think your question is a really good one, and I wish I had my crystal ball to be able to give you the answer that we'll all see in a few years. I think the ability for the wholesale markets to overcome the out-of-market incentives that exist is going to be really challenging. And I look at that in the face of the amounts of procurements that are being signed up by various states to achieve their local policy goals. I'm not suggesting that's a bad thing. It's just the incentives that will be outside the wholesale market in those cases will just be very large. And it's not clear to me that it would be more advantageous to try to get other services provided by these renewable resources rather than investments in other types of technologies like energy storage or other flexible resources that may be more advantageous to fulfill the energy droughts that we're going to end up having when some of these resources aren't around. And in those cases, I see that modifications to reserve requirements. New York is focused on developing ways to dynamically determine the reserve requirements, not only based on a deterministic loss of the largest resource, but also on the probabilistic loss of a swath of offshore wind plants or a swath of land-based wind plants, because now the contingency isn't the loss of a 2,000 megawatt nuclear reactor, it's the loss of 50% of 10,000 megawatts of offshore wind. And that loss is much bigger, which would create upward pressure on the need for reserves and their pricing. And I think when I think about those things, I don't envision that you'll see the economics of curtailing renewable resource to provide that being the most effective way to manage it. I see other resources really looking to fulfill that gap. Thank you.
Thanks, Mike. Next, why don't we go to Jason Berwin?
Thank you. I wanted to just follow up on what Mike was saying, what you started saying. What I was going to suggest here, right? This, in a high renewables future, a temporary reduction in output from wind and solar and a forced outage from a thermal generator are going to become more and more indistinguishable. But the services to provide flexibility for each of those two situations currently varies, right? And so this is, I think, the heart of this question of how do ancillary services maybe need to evolve. You know, contingency reserves are event-driven, but a higher renewables world might need these to be more continuously deployed at varying timescales and forward procurement windows. This is what I think, this is what I mean by flexibility reserves, a concept that folks are covering in papers. I know the Renewable Energy Buyers Association's report on designing a 21st century electricity system started diving into this. And so that change is going to be very important, one, to make sure that we're actually working with a high renewables future and the system needs to come from that based on that change to how we think about outage and change in output. But this gets back to also, I think, the second question of how you value flexibility. And Mike makes a very good point. Not only do you have zero marginal cost resources, but the out-of-market payments are going to make it so that an energy price reference for such services becomes increasingly challenging and problematic for actually providing that signal of value to them. I agree that, in fact, in some ways it almost forces, without those evolution of ancillary services and price formation associated with them, forces you into a world of thinking about how do we change the behavior of the variable renewable generators. And I think that the way I would describe this is that you actually have multiple paths out of that question, one of which is to focus on changing the variable renewable generators' behavior, the other is to focus on the market product and price formation.
Thanks, Jason. Next, let's go to Brian George.
Yeah, thanks. I would just add real quickly, I think that this goes back to the point of making sure that we're designing our markets around the capabilities that we need. To the extent that resources can provide those services, that's what we should be going for. And I think, in addition to the point around, zero marginal cost, I think that's where it becomes all the more important that what we're doing is actually providing an investable signal for folks to develop the resources that have the services that are needed. And that's, I think why we need to look at not just these changes with respect to the ancillary services markets, but also within the energy markets and ultimately the capacity markets where they exist, so that we are, providing folks with the right investment signals to make sure that we are deploying resources with these capabilities that we know we're going to need. Thank you.
Thanks, Brian. Next, let's go to Betsy Beck.
Sure. I just wanted to build off of one comment that Mike made a little bit, which is that as we think about what the system needs in an increasing grid with more renewable and variable resources, when we think about that contingency and what ancillary services and reserves are needed, when we think about the offshore wind losing, a large portion of that, we're not expecting to see that trip offline the way we would think about a conventional resource tripping. Rather, the things we need to be planning for are uncertainty in forecasts. And it's a little bit different time frame, and it's a little bit different problem and needs that we're going to need to start shifting to plan for. So it's differences and deviations in from the day ahead to the real-time forecast, or it's a weather system that shifted, 100 miles in one direction, but that we have, a bit of visibility into maybe a few hours or 30 minutes in advance. And so, as we think about forecasting around, weather-dependent resources, it's less of an unforeseen, tripping of a resource, but rather, how can the system have the ramp that it's going to need as we expect, wind or solar to perhaps have a steep ramp, which again is something that we are getting better and better at forecasting. And so our ancillary services and reserve products need to perhaps shift in their time frames and what they're looking at to plan for these different types of events that are going to occur in a high renewable penetration future, because they are inherently different from the types of events that we've planned for on the system historically.
Thanks, Betsy. Next, I want to go to Walter Graff.
Yeah, thanks for the question and great discussion so far. I wanted to second Mr. DeSocio's comments regarding the distortionary effects of out-of-market revenues. There is just a disconnect between what some of these policies ultimately report to value, which is displacing carbon, and what they do, which is paying for megawatt hours of clean generation, even when that generation does not displace carbon. And it may well displace other low or zero carbon resources. That disconnect really is, it does introduce difficulties into the wholesale market. And it's a difficult problem, one that we have yet to resolve. I do want to agree with some of the comments that other panelists have made, but I wanted to add one more thought regarding how do we value that flexibility. First, this is not a fundamentally different problem from that which our markets have been designed to address, and I would say have done a reasonably good job of meeting that challenge. Uncertainty, whether driven by changes in load or changes in thermal or intermittent resources, is not new. It is not a fundamentally different problem. I think that we should not be looking for fundamentally different solutions. And second, I'd like to suggest that the increasingly variable and volatile prices that we get under the type of future that you've described will themselves incentivize flexibility, because those resources that can best capture those high price periods and are those that have flexible capabilities and are operated flexibly.
Thank you, Walter. Next, let's go back to Mike DeSocio.
Thanks, Robert. I think Walter covered a lot of what I wanted to say, but in response to others that have pointed out desires to focus on capacity market reforms to create flexibility or flexibility products, I'd encourage us to maybe step away from that paradigm and instead focus on making sure we're valuing capacity resources appropriately. I think capacity accreditation is one of the more important things we could be doing with the capacity market to make sure we're incenting the fleet that we need to manage the grid of the future. And certainly New York is focused on that right now and looks forward to continuing to evolve that. Thanks.
Thanks for that closing comment, Mike. I think with that, I'll turn it over to my colleague, Aaron, to close us out.
Sure. First, I wanted to check to see, Chairman Glick, did you have any final comments for this panel?
No, other than to thank the panelists. This has been a very interesting discussion.
Thank you, Mr. Chairman. Commissioner Clements, did you have any statements?
No, same. Thank you for the participation. Really interesting conversation and helpful.
Okay. Well, thank you, Chairman, Commissioner Clements, and all of our panelists. I think this was a really great discussion. This concludes our panel here. We'll now take a lunch break, and we'll be back at 1:30. Panel 2, panelists, please sign out of the WebEx meeting. If you'd like to continue watching the conference, you may use the link, the public link available at FERC.gov. Chairman, commissioners, panelists for panel 3, please be online at 1:15. We'll run through the technical logistics that time to make sure everyone's been able to connect. Thank you and have a fun lunch.
And thank you for joining us. My name is Alex Smith, and I'm with the Office of Energy Policy and Innovation. My colleague Tom Dautel, also for the Office of Energy Policy and Innovation, and I will be co-moderating this third panel. This panel will focus on potential changes to RTO-ISO energy and ancillary service market models, software, and operational practices to optimize the changing resource fleet. The discussion in this panel will refer to RTO-ISO software used for market clearing and pricing of energy and ancillary services, and any software supporting that function, including software for advisory commitments, look-ahead commitments, and resource modeling, among others. In addition to the panelists, which I'll introduce shortly, I'd also like to welcome Chairman Glick to this panel. Before we start the question and answer session,
I'd like to once again remind all participants to refrain from discussing the specific details of the pending contested proceedings listed on the supplemental notice and to refrain from discussing any other pending contested proceedings. If anyone engages in these kinds of discussions, my colleague Adam Eldine from the Office of General Counsel will interrupt the discussion to ask the speaker to avoid that topic. And before I go further, I should also welcome Commissioner Clements to the panel. Thank you for joining. I will call each panelist in turn to give their response to our first question. I ask that panelists limit their initial response to no longer than 5 minutes. Our question is, what are the challenges to incorporating uncertainty within the current RTO ISO market software? For example, how can improvements in forecasting, the use of intraday commitment processes that include a range of forecasts, or longer look-ahead commitment and dispatch horizons result in a more efficient unit commitment and dispatch in real time? Panelists, please answer this first question, and in turn, I'll call on you by name. I'll start with Dr. George Angelidis.
Hello, and thank you. Can you hear me okay?
Yes, thank you. Please go ahead, George.
Thank you. So the challenge incorporating uncertainty in the market is twofold. First of all, you have to design a market commodity and procure it and reserve it in the market. So this particular task requires a multi-interval optimization because this commodity is really reserving ramp capability from one interval to the next, so that this ramp capability can be available and deliverable in the next market run when uncertainty potentially materializes. And the second aspect is you have to come up with a reasonable methodology for calculating the uncertainty requirement without tremendous effort, because you have to do it constantly as the market runs to update the requirement. So for that, you need to harvest historical uncertainty data and regress this data along with the current forecast that you have available for each application, synthesize the regression results, and come up with an uncertainty requirement. And for this work, you can take a simple approach of calculating a regression on a single regressor, like the net demand forecast, which is your demand forecast reduced by solar and wind forecast. Or you can take a more elaborate approach, which is more accurate, and do it over 3 regressors separately, as we do it in the California ISO, where we handle demand forecast, solar forecast, and wind forecast as separate regressors. So we harvest the data separately, and then we regress it all together to come up with the uncertainty. And we use a 180-day or rolling horizon for calculating this uncertainty. The requirement is calculated for each balancing authority area in the energy imbalance market. So that's a static calculation that repeats every day. But there is also a dynamic component that you have to calculate this on the fly for every market run, because we have a process where we procure this ramping product. We call it flexible ramping product. For the group of balancing authority areas that pass a resource sufficiency evaluation test, and this can change for every interval and for every market run. So you also have to do this dynamically, so it's very performance intensive. So that's one of the biggest challenges that we're facing. Thank you.
Thanks very much, George. Next, I'll call on Dr. Eric Ela.
Great. Thanks, Alex, and thanks to Chairman Glick, FERC commissioners, and FERC staff, including Emma and the team, for inviting me to participate today. So just a quick background, EPRI conducts R&D on behalf of the electric sector, and one of the areas that we have supported in recent years is on electricity markets and electricity market clearing software. Through advanced simulation and analysis, we look at the potential advantages and disadvantages of emerging market designs, operational strategies, and software implementations, and provide those insights back to the RTOs and stakeholders in the hope they can be useful in determining design and implementation decisions. So in regards to the question of incorporating uncertainty, I think there's some information that's useful to start with that I think we'll hear from other panelists potentially as well. Day-ahead forecasts for load, wind, and solar that are utilized by the ISO are currently only used in the reliability unit commitment process, which is called the RUC, sometimes the RAC, reliability assessment commitment, or forecast pass, etc. These processes primarily are run after the day-ahead market, with a primary focus of committing sufficient resources that require a day-ahead notification time, while minimizing the residual unit commitment costs. So resources committed in the day-ahead market are not decommitted if, for example, the renewable forecast is higher than the renewable bids. In addition, it is often the case that the energy costs are ignored, so the incremental energy costs are ignored or largely discounted, so that only the commitment costs are of concern, things like startup costs and no load or minimum generation costs. So this implies that improved day-ahead forecasts of load and renewables have somewhat of a limited impact on economic efficiency in a direct sense. That said, it is important to consider that improved forecasts can improve efficiency when these are used directly by loads, market participants, renewable resource assets, as well as financial participants such as virtual traders, when these forecasts are used in their offer strategy. So moving into real-time and the real-time dispatch and most other intraday processes, such as the intraday reliability unit commitment or real-time unit commitment. In these cases, these forecasts are used more directly in the ISO processes. So the ISO gets these forecasts for individual resources or for load zones, for example, and uses them directly into the scheduling processes, into the market clearing software. So this means that improved forecasts and other enhancements of forecast applications, such as longer look-ahead horizons or multi-scenario forecast utilizations, can have a more direct impact on both reliability and economic efficiency. So those were some of the comments I wanted to start with in terms of uncertainty and use of forecasts, and look forward to the rest of the session. Thank you.
Thank you so much, Eric. Next, I'll call on Dr. Bethany Frew.
Great, thanks, Alex. It's an honor to be on this panel. I'm a researcher at the National Renewable Energy Laboratory, and I'm going to be providing some opening remarks to this discussion on uncertainty from a strong computational modeling perspective, drawing from various studies that we've done collectively at NREL over recent years. But I'll note that we are actively doing more work in this space to continue exploring specifically the role of forecasting accuracy and look ahead. So first, related to forecasting improvements, it probably goes without saying that better forecasts make things more efficient, specifically from a production cost and curtailment perspective. But the value of improved forecasts depends on both the amount of renewables and thermal units in the system. And so we've seen consistently across different studies almost this transition zone where as you start to increase the amount of renewables on your system, specifically variable renewable resources like wind and solar, and you start to reduce the amount of thermal units in the system, there's sort of this transition beyond which unit commitment-related impacts can be diminished. And so specifically, startup costs are one of the areas where we see a lot of value of improved forecast. But as you remove or many of those thermal units could be retired in future scenarios, the value of those improved forecasts decline. So there's really this interesting kind of interplay between what's happening in the rest of the system and the forecast quality. There's also a bigger issue of timescales with this conversation on forecast improvements, where forecasts and improvements of them won't do much good unless the timescales of those forecasts are explicitly synced to some sort of decision process in the system. Secondly, related to the look-ahead topic, we've also found repeatedly in our grid integration studies that the look-ahead extent and the resolution can significantly impact trade-offs in the operating reserve and unserved energy penalties, as well as startup costs, specifically of peaking generators, as well as in feasibilities as the model sees it. Storage is particularly sensitive to these look-ahead settings, and so there's really a strong link between the information quantity and the granularity, at least, again, from a modeling perspective. So beyond kind of these two key topics that we're focusing on, forecast improvements and look ahead, there's also, from a more market design perspective, we found that there are often multiple ways to achieve the same end result. And I know others in this panel have done work in this space. Eric at EPRI, I know, comes to mind as one, but there's various products, there's rules, there's pricing mechanisms, the data issue itself and having better quality data. There's the operational sequence and frequency, which gets to the multi-interval point that has been mentioned a couple of times. Even out-of-market mandates and even other technologies where there can be trade-offs, for example, with storage, demand response, and transmission to provide flexibility for the system. And so there really needs to be a process to identify and assess these various options for specific systems and specific futures to understand which combinations or which items might be best suited for those particular applications. And ultimately, I think what we're getting at is a trade-off between better information and an increased computational burden. And getting better quality data is not a trivial or a free task. And I say that from both a research perspective, where it's a heavy lift to get better data, improve forecasts, increasing the granularity of our models, having additional look-ahead horizons or additional intervals over which the operations and the market is clearing. And that's also true for continuous day-to-day operations, which has been mentioned at least once in this conversation already, on the need to kind of do on-the-fly calculations. So just want to end with that point, and so there's this kind of trade-off question that I think has to be discussed. Thank you.
Thank you, Bethany. Next, I'll call on Dr. Song Wong.
Yep. Thank you to the Commission for hosting this event and for inviting me today. At MISO, we are looking at a variety of ways to address growing uncertainty and variability, including the approaches posted in this question. I'd also like to broaden the discussion somewhat beyond those measures. First and foremost, in our minds, characterizing uncertainty correctly is one of the largest challenges and greatest needs before we figure out how to change our commitment dispatch model. Once we figure that out, then we can integrate flexibility into the optimization model, either through reserve products, stochastic or robust optimization or combination, but each approach has its own challenges to fully reflect the operational needs. And finally, almost all of these approaches contribute to increasing computational burden. So regarding uncertainty characterization, the inputs we give our commitment dispatch engines define the problem we are asking them to solve. So we really need to have a good handle on the uncertainty. Otherwise, as the old saying goes, the garbage in, garbage out. This entails collecting not only forecasts, but also their confidence intervals, understanding their correlations, and aggregating them in a timely manner. The problem is becoming harder as uncertainties increase in intensity and variety. As we are hitting the 30-gig mark of wind and expecting rapid growth of solar, the variety and uncertainty are coming in greater volume. But it's not just about growing forecast errors. For example, the net scheduled interchange, transmission and generation outages, and fuel availability are all moving parts. And the changing weather patterns are making things harder to predict. So furthermore, uncertainties correlate, and their impact differ across time. We have experienced extreme ramp challenges on a day where underestimated steep wind drop was coincident with the evening load ramp. That resulted in almost 600 megawatt loss every 10 minutes. That's almost equivalent to a loss of large combined cycle every 10 minutes for over an hour. So a priority for us is really to improve forecasts and particularly to quantify and aggregate uncertainties.
Once uncertainty is characterized, feasibility needs, flexibility needs can be accounted in the commitment dispatch model. And that is primarily done through reserve products. However, operations monitor and manage uncertainty throughout the day or even day or days ahead. We are exploring new how existing or new flexibility products, each with a defined time frame, can align with our operational flexibility needs, and how different products can work synergistically together to address the evolving uncertainty across time. Our unique regional situation further emphasizes the challenge of the deliverability of uncertainty. Unlike energy, where we model transmission and regional transfer limits explicitly, reserves are not allocated on a granular basis, so we can run into the risk of obtaining reserve in one place but not deliverable to where it's needed. We are currently working on the issue, reviewing the reserve requirements and enhancing the deliverability. We are also looking at the stochastic look-ahead commitment to manage flexibility. However, those scenarios, especially if we combine with a longer look-ahead horizon, increase the problem size significantly. The computational time then will become a major issue as it increases exponentially with the problem size. Along with the unit commitment approaches, we are also exploring best practices for selecting scenarios and improving computational time. And getting the time right is critical because operations have strict decision-making time frame, as resource flexibility diminish due to their startup notification time, regulatory constraints, etc. And this is particularly hard for our footprint with a tightening supply margin and good portion of long-lead units. So incorporating uncertainty into the market software is promising and is needed. However, we must start by correctly characterizing the uncertainties. The commitment and dispatch problem will become harder to manage the varying flexibility needs across time as well as geography. So finally, almost all of these changes contribute to an increase in computational challenges. So I look forward to more discussion today. Thank you.
Thank you, Song Song. Next, I'll call on Arnie Olson.
Thank you for the opportunity to come here today and present some thoughts on ancillary services. I'm Arnie Olson. I'm a senior partner with E3. I'm going to start with maybe some broader brush recommendations from our work, years of experience in market design, transaction support, and energy systems modeling, both of existing power systems but also of future systems under a trajectory toward deep decarbonization. And our views on ancillary service market reforms are summarized in our recent white paper called Scalable Markets for the Energy Transition, which I'll file in this docket. In that paper, we consider reforms that are needed to efficiently and reliably scale clean energy. We observe that the grid's need for energy, capacity, and grid services will remain the same under very high levels of clean energy resources. However, the nature of the resources that provide those services will be very different, and markets must evolve to optimize the use of these new resources. In particular, inverter-based resources such as wind, solar, and battery storage have the capability to respond very quickly, much more quickly than conventional resources, to dispatch signals, but they can only offer that capability at certain times. And their cost for doing so is based not on direct out-of-pocket costs like for conventional resources, but on lost opportunities to sell energy contemporaneously or in the future. Fully optimizing these resources based on grid conditions will be critical to ensure a reliable and cost-effective transition. So our recommendations for ancillary service markets are fourfold. First, market operators must develop scientific methods for determining the quantity of ancillary services needed based on continually changing grid conditions. There are initiatives underway at EPRI, at E3, and others, some of them, including ours, funded in part by ARPA-E, to develop software that projects net load uncertainty across multiple time steps as a function of changing load, wind, and solar forecast error using advanced computational techniques such as machine learning. We think these models can help reduce costs by identifying periods in which grid conditions are stable and lower quantities of reserves are needed, and increase reliability by identifying periods in which higher reserves may be needed. So just as an example, when wind and solar production are very high, there's little need to procure downward reserves in case production goes up even further. And conversely, when wind and solar production are very low, there's little need for upward reserves in case production drops further. Second, market operators should take steps to ensure that inverter-based resources are bidding their full range of capabilities into the various markets. Wind and solar projects can be dispatched downward all the way to zero nearly instantaneously. They can also be dispatched upward, but only if they're producing below their maximum potential. They should have the capability to bid both upward and downward flexibility, with bids reflecting their opportunity costs of lost sales of energy and clean energy attributes. Third, upward and downward reserve products should be specified and procured separately. Wind and solar projects have asymmetric cost functions for providing upward and downward reserves. The cost of providing downward reserves is only the lost revenue that is experienced during the few real-time intervals in which the resource is actually dispatched downward, whereas the cost of providing upward reserves is realized immediately in reduced hourly energy revenues for the entire megawatt quantity offered, and is only partly ameliorated when the service is dispatched upward in real time. Energy storage may also have asymmetric opportunity costs for the provision of reserve services. If owners expect energy costs to increase during the project's storage horizon, their cost to provide upward reserves is a function of their lost opportunity to earn additional arbitrage revenues by charging now at low cost. And conversely, if they expect prices to go down, they'll be willing to provide downward reserves only if the price is compensatory for the lost revenue from delayed discharge. And these values can be very different at any given point in time. And finally, and most ambitiously, we should look to market software to optimize the use of energy storage. This is the most flexible resource available in the market, but its costs are entirely defined by market opportunities to buy low and sell high. As substantial quantities of storage are added, it will be increasingly important for market software to optimize its use, meaning that in an ideal world, we would allow the market software to determine when energy storage is charged and discharged on a daily basis. We should look to the market software to determine which reserve products are provided by energy storage optimally. And lastly, the market software should be able to calculate endogenously the energy storage opportunity costs based on market clearing prices for energy and ancillary services, and fully compensate the project owner for the value of all services provided. So those are my opening remarks, and I'm really looking forward to the rest of the conversation this hour. Thank you.
Thank you, Arnie. Dr. Jinye Zhao.
Good afternoon, everyone. I'd like to first thank Chairman, Commissioners, and Commission staff for inviting me to participate in this very important technical conferences. So as I listened to the opening remarks of other panelists, I realized some of the comments I prepared the first may reflect other panelists' view, so I apologize. It may seem a little repeating of what others have said. So in order to manage uncertainties during the operating period, we need to address two main questions. So the first question is how to reduce the magnitude of uncertainties. So in other words, is how to reduce the problem size. And the second question is, given that there are always uncertainties in the system, so what solution strategies can we use to manage uncertainties? So let me start with the first question, how to reduce the magnitude of uncertainties. I think improving forecasting will be one of the most direct ways to reduce uncertainties. So without a good forecast, we would have a garbage in, garbage out problem in our commitment and dispatch process. This is, Song Song also mentioned that when she spoke. And in addition to reduce uncertainties, ISO New England also implemented do not exceed limits, or we also call it DNE limits. So we use that as a dispatch instruction for renewable resources. The DNE limit allows us to maximize the usage of extra renewable generation above the forecast value, but at the same time, cap the generation below a level that won't violate system reliability. However, uncertainty is in the DNA of power systems. No matter how we reduce the size of uncertainty, there always exist unexpected events, such as contingency, generators not following dispatch signals, and with climate changes, power systems are likely to be exposed more frequently to large uncertainties under extreme weather events. So therefore, it's important to develop uncertainty management strategy, which leads us to the second question. So there are multiple ways to manage uncertainty in the market software, and in previous panels has listed a few very good approaches. So I view these approaches can be separated into two buckets. So one is a deterministic approach. So the industry has been using 10 minutes and 30 minutes reserve products, and also has adopted some new ancillary service products such as ramping and flexibility products to cope with uncertainties. And these reserve and new ancillary service products can be considered as deterministic approaches. So they are straightforward and also computationally efficient. They serve well to simplify the decision-making process in time-critical applications. However, the drawback of the deterministic approaches is that if the number of random variables and the system complexities greatly increase, then collapsing all the sets of possible future outcomes into a single reserve requirement or ramp or flexibility requirements may not be a very effective way to handle uncertainties. So besides the deterministic approach, then there is probabilistic approaches. So the probabilistic approaches include scenario-based stochastic optimization, robust optimization, and these approaches have drawn a lot of attention because of their capability to explicitly model uncertainties in the dispatch and commitment problems. However, the stochastic and the robust optimizations are still computationally challenging, so they are not quite ready yet to be used in productions. And in terms of the look-ahead horizon, I think a longer look-ahead commitment or dispatch horizon is always beneficial for scheduling resources to manage predictable changes in theory. So especially when we have a system is time-coupled through ramping energy storage resources as well as limited energy resources. I feel in this case, look-ahead, have a longer look-ahead capability is very important. However, the issue with look-ahead optimization is the further out we look ahead, the more uncertainties we have, right? So it becomes very difficult to know the effect of a decision you made ahead of time without a perfect forecast, foresight. So some decisions made early may not be efficient or reliable when uncertainties is materialized. So in summary, different ways can be used to mitigate uncertainty risk, and some methods may be more effective than others, but depending on the magnitude and time scale of uncertainties. And because each region has its own unique characteristic and the resource mix, and ISOs and RTOs faces different uncertainty challenges. So there's no one-size-fits-all solution. And as each ISOs and RTOs develop a set of solution methodologies which are suitable for its own regional needs. And I also think it's very important that we learn from each other using the opportunity like today's conference. So I really appreciate the other panelists for sharing your insights on this topic today. And I look forward to the panel discussion. Thank you very much.
Thank you, Chairman and Commissioners, for any questions they may have. Starting with Chairman Glick. Mr. Chairman, can't hear you.
try it again. Alex, I just want to thank you, but I don't have any questions. Can you hear me? Okay.
Yes, perfect. Thank you so much.
Thank you.
Next, Commissioner Clements, do you have any questions?
I do not at this time. Thank you very much.
Thank you. And Commissioner Christie, thank you for joining us. Do you have any questions?
No questions at this time. Thank you very much.
Okay, thank you so much. In that case, I'll ask if our panelists have any further comments they'd like to make in response to question one or any of the other panelists' responses to question one. Please go ahead with hand raises. The participants in case anyone wants to say. George, I see your hand is raised. Please go ahead.
Yes, thank you. And Zinyu just mentioned that when you have a multi-interval optimization for having a look ahead, which provides you the ability to, first of all, procure flexibility for the next market run, you need to have a look ahead, and also provides you the ability to make some short-term unit commitment, which is very important to position resources for what your market horizon can see for future intervals. There is this trade-off between performance and accuracy. Of course, it's clear that the longer the time horizon, more intervals you have to solve. That's the performance-intensive part. But then you have to trade this off with what accuracy you can expect to have too. So, yes, further into the future, your uncertainty is greater, so system conditions can only be forecasted to a certain extent. But you have the benefit with a longer time horizon to actually perform some higher quality short-term unit commitment, because you'll be able to cycle more resources that their intertemporal characteristics fit into the time horizon. You want to capture and model accurately their commitment cost. So for that purpose, their startup time and their minimum uptime has to be contained within your time horizon. In the California ISO, we do have once an hour we run a short-term unit commitment application that looks up to 18, 15-minute intervals. That's 4.5 hours. So we are capable with this application to perform some short-term unit commitment for the next coming hours of a significant number of resources in the system. Regarding the uncertainty, which makes this process a little bit nebulous for future hours, particularly when you reach to the edge of the time horizon, this is only one part of the problem. The other part that is also problematic is usually for this long time horizons, your bids that you have from market participants for further hours out in the future, they haven't been finalized yet. You don't have financially binding bids. They're still advisory because the market is still open for those future hours. The bids can be revised, or you don't even have all the bids submitted. So it's really a challenge in the trade-off, trying to balance everything, trying to have as long a time horizon as you would like to, versus the accuracy that you can hit with those later hours. And that was, I wanted to comment on that. Thank you.
Thank you so much, George. Do we have any further comments from any of our other panelists? Okay, Jinyei, I see your hand is up. Please go ahead.
Okay. Yeah, I agree with George's comments. I feel definitely there's a benefit for having a longer look ahead horizon. And I feel one of the way to sort of handle the uncertainties issue in the longer ahead horizon is what we can do is do more frequent commitment run or dispatch run. So as the operator getting more updated information, and I think we should put this information into the commitment decision as well as dispatch decision, so that the commitment decision and dispatch runs can utilize the updated information and then make more informed, more efficient decisions. So we don't keep dispatching the system using the outdated information. And I also wanted to echo another comment I think brought up earlier by one of the panelists is the reserve quantity, right? So I heard it's very important to sort of harvest the historical information to produce better reserve requirements. So I fully agree in that because so for decades, the power system has set reserve requirements to reflect the largest contingency or the second largest contingency. So it seems we are constantly using the same reserve requirements all the time, all day. And however, with the increasing uncertainty level in the system, I think we need to rethink the definition of reserve requirements. And I think it will be useful that the operator take into account the available information to them and sort of understand whether the system is at a low risk or high risk state, and then correspondingly adjust the reserve requirement to properly reflect the system uncertainty level. Thank you.
Thank you, Jinye. I see, Arnie, your hand is up. Please go ahead.
Yeah, thank you. I thought I might just add on to that point a little bit that, this is where we see things like machine learning being potentially a good way to kind of bridge the gap between, obviously, ideally, you'd be able to do stochastic unit commitment, stochastic dispatch, taking into consideration all the potential future states and finding an optimal path through them that minimizes costs across the whole distribution of potential outcomes. But that's very, very computationally intensive. But one way to maybe bridge that gap is to use the best available historical information, continuously updated, with tools that continually learn from historical information. That based on this state of the system, this is where sort of a P95 or a P5 state for net load in the next interval might be, and the next interval after that, and the next interval after that, and the next interval after that. So you might think of it as like an envelope of net load uncertainty over successive time steps, all the way up to 5 hours, 8 hours, whatever the sort of the farthest horizon is that's needed. And so taking that information into consideration when looking at residual commitment, and perhaps even formalizing that as a reserve product to reflect this sort of option value that the system operator needs to be able to call on for headroom and footroom, upward dispatch, downward dispatch, is a way to bridge that gap with tools that can continuously learn and continuously get better over time as more and more data is added. Another last point I'll make there is that we've in the past kind of separated this contingency reserve, which as Jinye mentioned, is typically based on the largest single contingency on the system, from a regulating reserve, which is meant to deal with kind of short-term, minute variability. Those two things are going to increasingly get closer and closer to the same thing. They're going to be more continuous and less discrete as we have more dispatchable resources or non-dispatchable resources, more variable resources on the system. So large wind events, wind down ramp events might start to look like large contingencies. And there may be, wind down ramp events that are less large than your biggest contingency, but are still big, and some that are pretty big, but not as big as your next ones up. So there's going to be a lot more of a continuous range of these types of conditions that we'll need to consider. And so I think some form of formal ancillary service product that's in between regulating reserves and contingency reserves, that's dynamic, that reflects changing capabilities or changing needs on the system, is a promising way to kind of bridge that gap.
Thank you so much, Arnie. Any further comments from our panelists? All right, seeing no further raised hands, I'll now turn to Tom Dautel to ask our second question. Tom, please go ahead.
Yeah, thanks, Alex. I'm moving to the second question in this panel in our agenda, and noting that I think we've covered some of that material already. So just in the interest of efficiency and time management, I was going to focus in on one part of that next question. So question is, how would multi-period dispatch modeling in the real-time market help address operational flexibility needs, and what are the advantages and disadvantages of a binding as opposed to an advisory multi-period dispatch or unit commitment model? And if you want to answer, just raise your hand as you did for the previous question. Okay, I'm not sure who was first, but Eric, I think I saw you go up pretty quick.
Yeah, thanks, Tom. So, I think we heard the term time-coupled multi-period economic dispatch, which I think in terms of how that's being solved in the real-time market or how that's being used for the actual real-time settlements, I believe only New York ISO and California ISO use a time-coupled multi-period economic dispatch for the real-time market settlement. So, important thing to mention, a lot of good discussion in the previous question about this already. It's important to mention that it is a good solution in its current form. It only meets the needs for known conditions, not unknown conditions. So I think that's very important. The other is that it generally in these models do a better job of preparing for that expected ramp needs than a separate reserve product would be in terms of reliability and economic efficiency, and that's because these multi-period time-coupled models also are evaluating the costs of holding capacity for the ramp as well as the cost of deploying that capacity to meet the ramp, whereas a flexibility product is only, in its general form, only evaluating the cost of holding that capacity. So that's an important part. So I wanted to clear that up, but I think it's really the question of binding and advisory intervals is something that we've thought a lot about, and want to share a little bit of that here, and probably more so with the comments afterward. So, again, I mentioned that these time-coupled multi-period models do a great job of providing schedules that can meet expected ramp needs to enhance both reliability and economic efficiency. However, in its current form, there is a price formation challenge in the two ISOs that use multi-period models to clear the real-time market. I believe that both only use the prices and schedules of the first interval for settlement. And the reason this may cause issue is that during a ramping period where a resource is backed down in the binding interval in order to meet the conditions in the future interval. It's very important to recognize that, not only are these multi-period models looking ahead to see what is going to happen in the future, but that future may affect the decisions for now. And that's the time-coupled nature of them. So essentially what happens in this case is that the price of the first interval is depressed, which gives the resource the incentive to back down in order to meet that future interval. And then the price of the second interval, let's just use a 2 interval, is actually going to be high because that's the need, is to ramp up to that second interval. So this all actually looks pretty well until what happens is that once that second interval becomes the new binding interval, all of the information, well, not all of it, but the information is mostly lost from that previous first interval, which means that that high price may not actually show up, especially if the anticipated ramp does not result as high as it was anticipated. It's important to know, you might think, well, why should the price stay high if the ramp does not materialize? And I think for the most part that's true, except for the fact that you have made the decision already for that for one or more resources to back down in order to meet that upcoming ramp, and therefore they may not have the incentive and may have some profit that's impacted. So there are a few options to actually utilize the fact that multi-period dispatch has superior economic efficiency and reliability benefits, with the exception that it has this price formation issue. And, there are a few ways to meet that. I think ISO New England, Jinier might talk more about doing multi-interval settlements, so essentially settling on all of the intervals of that multi-period. There's also another option of essentially taking the constraint shadow price of what's happening to actually utilize that as kind of a reserve price. And you can do that and actually make it so it's more aligned with what a reserve price would be, but you have more of the benefits of a multi-period dispatch, which actually, as I mentioned, is superior to using a separate reserve product like a flexibility product for expected ramp capability. So the question of unexpected, being able to posture your resources for what may happen. I think we believe that a multi-period economic dispatch can do that as well, and actually price it in a way that can provide the right incentives. But this hasn't really been proven yet, so I think there's more work to be done. So in any case, just a lot of information there. There is this price formation issue. It can be resolved through at least two solutions, probably more. And we think that would be a efficient way of ensuring you can get the right incentives out and also meet your reliability and efficiency benefits for the time-coupled multi-period dispatch. Thank you.
Thank you, Eric. Next, we had a hand raised from Dr. Angelides.
Thank you. So I think Eric really covered these two cases. I just want to add a few more things here. Sometimes you see this effect of system conditions not materializing in the future intervals that you have in your optimization horizon, particularly for further intervals into the future. In the California ISO market, our 5-minute real-time dispatch looks up to 13 intervals into the future. And we have seen occasionally this effect, particularly for energy storage resources, that they have superior ramping capabilities, so they move very fast. They're not constrained by ramp capability, so they're dispatched so that you have a lower operation cost for the system for the entire time horizon, although you only settle the first interval typically, which is the financially binding interval. The results for the other intervals, although they're advisory and you don't settle them, their cost is part of the objective function. You minimize the entire objective function over the entire time horizon, and that's why Eric did say that your future conditions do affect your financially binding interval dispatch because they're all stringed together with ramp constraints. So the issue of trying to solve this, we're looking into solutions, particularly for energy storage resources, and maybe later on we'll talk more about that as we talk about models, that perhaps for energy storage resources, that they don't have intertemporal constraints, they don't have commitment costs, probably a long time horizon is not that much useful for them. So maybe in the objective function we can limit the optimization the first few intervals, say 3 intervals, and not have a cost and dispatch for the remaining of the time horizon so that we mitigate this issue. Although it's not all the time. We have seen this occasionally. So it may not be a problem. We're still collecting data and doing analysis on it. The option of actually settling all intervals in every time horizon, in every market run, which obviously will solve this issue because now you settle the advisory intervals, so you don't have to rely on bid cost recovery mechanism because your financially binding interval is out of the money for a resource or two, is appealing as a theoretical solution, but practically is very challenging. For the example that I mentioned in the ISO market, for the 5-minute market, you will eventually have to settle the same interval up to 13 times. That's a lot of settlement work, not only for the ISO, but also for the market participants that they settle the settlement. So this remains a challenge that we still need to face. Thank you.
Thank you very much. Next, Dr. Wong.
Yep. I'd first like to differentiate the multiple period model to a multiple period dispatch and then a multiple period commitment. We currently use a single period dispatch model, as Eric said, and then we use a multiple period look-ahead commitment. So the multiple period model, as commented by previous panelists, has the benefit to pre-position resources for expected or forecasted system changes, but they wouldn't be effective to address the uncertainties. So to that regard, we are still looking at reserve products to more address the flexibility needs. For example, we are looking at the 10-minute ramp capability product like CalISO does, and then a 30-minute short-term reserve. We are also exploring the dynamic reserve requirements to account for the varying uncertainties by time. So for the binding multiple period dispatch model, the resources can be potentially better compensated for their pre-positioning, but there are pricing and settlement challenges, like Eric commented, and we also discussed at prior technical conferences, especially when those models run on a rolling window basis, like when binding dispatch targets at the advisory intervals, that may not be actually helpful very much operationally because we always send the latest dispatch target reflective of the most accurate forecast for resource dispatch following. So next, we really want to focus on the look-ahead commitment side. Binding the look-ahead commitment decisions are actually our target, but also want to point out RTOs should be allowed with time to really improve the quality of the look-ahead commitment so that we can maintain the efficiency and least cost commitment, especially given the increased uncertainties and the regional diversity. As we noted earlier, we are really working to make sure the input is trusted and accurately capture uncertainty, and also we are strengthening our reserve products to really address the flexibility needs. Also, we are in the middle of our market system enhancement, so the binding of those look-ahead commitment decisions should be coordinated with our NGM schedule. And lastly, I want to point out, in addition to our look-ahead commitment, we also run commitment process from multi-day ahead to day ahead and then intraday. So for those longer time horizons, as previous comments mentioned, like there's really a balance between the further you look ahead, the more uncertainty you have, and also the balance of wait until closer to reserve the flexibility of short lead units when system conditions improve or the forecasts are more accurate. So for those longer horizon commitments, it makes more sense to keep it as advisory, as we think. Thank you.
Thank you, Sang. Next, we had a hand up from Dr. Zhao.
Thank you. I just wanted to add a little additional comments regarding the advisory and binding multi-period dispatch. So Eric give us an excellent example using a two-period dispatch problem to indicate if we only saddle the resources on the first binding interval and then treat the future interval as advisory interval, not settling them, then resources may have dispatch following incentive issues. So we also have been looking into the multi-period dispatch problem. And then one thing is we've been thinking is using the multi-settlement approaches. So instead of you just settle on the first binding interval And then one thing to address this dispatch incentive issue is you settle all the intervals in your multi-period problem. And I think one of the advantage of this is sort of reduce the risk exposure for the market participants, because once the participants are locking to a forward price, and then as you keep running this multi-period dispatch, and then every time when you settle the market, the participants are only settled on the deviation from the previous settlement. So as a result, the participants' risk exposure to the uncertainty or forecast uncertainty is only limited to the deviation of the settlement. So besides the incentive compatibility advantage, we feel multi-settlement has also this reduced participant risk exposure advantage. But as George mentioned earlier, I think the biggest challenge of implementing the multi-settlement in production is it just become very complicated to do in implementation, because there are so many settlements you have to bind every time. So it's a little challenge to actually realize in the ISO software. And and also I think another question is regarding the look-ahead horizon, right? So California ISO and New York ISO has adopted multi-period dispatch problem, which I think is helpful for their system. And however, there's a trade-off. You would always like to look ahead a little more, because in the system, there are always some resources needs more than 2 or 4 hours look ahead horizon to properly dispatch them. However, the longer you look ahead, the problem size become bigger. And so ISO New England also has this research work that we sort of considering a coordinated multi-period dispatch approach. So in essence is we can trying to keep the small dispatch problem size, trying to sort of limit the computational burden. But while keeping the size small, we wanted to introduce some information from future look-ahead horizon into the current short look-ahead dispatch horizon. So in this way, we want to sort of have a smarter, better informed short dispatch decision. And on the other hand, we can also incorporate some estimated opportunity costs and into the pricing problem, so that when we have a dispatch solution to the resource, the pricing itself also supports the dispatch solution, which trying to avoid some dispatch incentive issues. Thank you.
Yeah, thank you, Jeannie. We'll go to Arnie Olson. Mr. Olson, go ahead. I think after this, we'll go do another question just to make sure we get through the other thoughts also. But Arnie, you're next, and go ahead.
Yeah, great, thank you. Yeah, I just wanted to, I guess, emphasize and reiterate the need to start thinking about multi-settlement periods, especially as we move more and more towards a future in which many of these products are being provided by energy storage. And the cost that energy storage has for providing these services really is fully encompassed by its opportunity to, buy low and sell high over the periods in which the market is settling. So this will increasingly trend towards a problem of managing the state of charge of your aggregate storage fleet, ensuring that you have both enough downward and upward capability to be able to absorb real-time fluctuations. At the same time, I want to maybe make another little pitch for the potential to solve some of this through a reserve product. I think what we have now with an optimization that encompasses multiple periods, but a binding settlement only for the first of those multiple periods, is a bit of muddying of the marginal cost signal. We don't have a clear signal for the marginal cost of serving additional load during the current interval. We don't have a clear signal for the marginal cost of serving load over multiple intervals, or at least not one that we're settling on. So a reserve product, in addition to the short interval energy price, can allow the short interval energy price to reflect more precisely the marginal cost of an additional increment of load in that interval, but also then the cost of uncertainty and the cost of the need to reserve capability to manage net load variability and uncertainty over those future intervals. So those really are separate cost functions, cost drivers, and in that way they would be settled, and the cost of those would be seen and felt by the market separately.
Great, thank you very much. I might just pause before we move on to the next question to see if there's any raised hands from Chairman Glick or any of the commissioners. Otherwise, we'll move on. Just pause a second. Nope, okay. Noting that then, we will move on. Alex, we'll take the next question. Thank you.
Thanks so much, Tom. Panelists, our prior questions have concerned general modeling enhancements for commitment and dispatch. For this question, we'd like to move to modeling enhancements related to specific technology types. To what extent can software enhancements for modeling specifically technology types, such as multi-configuration modeling of combined cycle units or advanced modeling of storage resources, and others, help address the system's changing operational needs? Please raise your hand to respond to this question. See a hand up from George Angelidis. Please go ahead.
Yes, thank you. So there are two resources that require specialized modeling, and you mentioned the combined cycle, and it's a little bit more general. It's resources that they have multiple states of operation. And because each state has its own constraints, its own ramp capability, its own capacity range, and even its own cost. The cost is different for operating at different states. Having a multi-state model in the market is extremely useful to capture the characteristics of the resource so that you have an optimal dispatch that both reflects the cost of operating the resource and its capabilities so that you have a feasible dispatch, and then your market can optimally position this resource in the best state that can address the system conditions that you can see in the market horizon. It is a model that is challenging from a performance point of view because you have a lot of binary variables that are introduced in the problem. Each state has its own binary status, and as you know, when you increase the binary variables in your problem, it becomes harder to solve. So it's always a challenge to introduce multi-state models, particularly if the states are many. There are some combined cycle resources that they have multiple states, many states, and these are the most difficult to solve. So that's about the combined cycle and the multi-state. I believe it's important to have a model that addresses this in the market. And the other resource is the energy storage resource. Energy storage resources, they have up to two states, charging and discharging, and you may need to separate them and treat them differently in your market because there is usually a round trip efficiency that is less than 100%, and you model this usually in the charging state, that the energy that you put in the resource, some of it is not available to be dispatched because it's energy that is lost. So that's not too complicated that you have a binary introduced for energy storage resources. I think the more complicated part that requires a lot of work is that your traditional generating resource model is not sufficient to capture the characteristics or the costs of an energy storage resource. First of all, for the characteristics, it has special constraints that you don't see in other resources, like energy limit constraints, which basically require you to, in the market, to calculate and monitor the state of charging the device so that when you dispatch optimally the device, you take into account that the state of charge is there to meet the schedule. And also, if you award ancillary services, there is energy in the device to provide these ancillary services. So you have additional energy type constraints to your problem. That's one thing. The other thing is that the cost characteristics, the operation of the energy storage resource is different than the cost characteristic of a regular generating resource. The cost is not really a function of the power output. Is more related to how much storage is, how much energy is stored in the resource. It's more of a function of the state of charge. We know that batteries that are, almost fully charged or almost depleted, so at the edge of the state of charge range, they have a higher cost of operation. So you can only capture this if you have a different cost model for these resources. So all in all, you have to develop something specific for energy storage resources. So there's still research that is going on this, and we have been looking at potential models for energy storage resources at the California ISO. We have several initiatives coming up on this, but it's definitely something we have to look for in the future, because more and more of these resources become available and penetrate the system, so we have to have accurate models for them. Thank you.
Thank you, George. Next, I'll call on Song.
Yep. So overall, the enhanced resource modeling can help exert more flexibility from those resources. The past couple of years, MISO developed the enhanced combined cycle modeling and assessed 14 to 34 million production cost savings, really by allowing those resources to more fully and accurately offer their capabilities and costs into the market. Because the combined cycle resources, their maximum, minimum operating limits, their ramp rates, all vary by configurations and their operating mode, such as transition or duct burner. So the traditional model restricts combined cycle owners to offer those variations, and the configuration-based model more actually capture these capabilities. And similarly, our enhanced combined cycle model can be generalized, potentially expand to other resources like storage. Hybrid is another example, like George commented, and allow RTO to use their look-ahead software to better optimize their energy limits and allow better use of these resources when most needed. Lastly, I want to note another good source of flexibility, the demand response resource. MISO currently have like about 14 gigawatt load modified resources that we can only access during emergency. So if we can better model these resources, can access them through markets, then will really allow us like with more availability of flexibility.
Thank you, Song. Next, Eric, please go ahead.
Yeah, just to add on to some of the comments so far on this topic, I think everyone's kind of said, and I agree in theory, adding granularity to the characteristics of different technologies and how they interface with the market has economic and reliability benefits. And I think it's useful to say that we discovered this initially when we introduced unit commitment and three-part bidding. That is a unique participation model for, traditional technologies, but that's, a unique participation model. Europe has gone a different way. They don't include three-part bidding for the most part. So, we sort of discovered that, and I think we continue to. And it's important to say that, while that looks very well in theory, and of course we see the benefits from a system perspective, there's always reasons why, maybe the granular, the detailed model is not preferred, and we hear that sometimes from the community and some of the hybrid and storage participation models, which are analogous to the combined cycle, configuration-based model versus simpler thermal model. So I think it's important to recognize that we can capture a lot of these characteristics and constraints of the technology within the market clearing models, but we cannot capture them all, and including nonlinear characteristics, other sort of internal characteristics that we need to allow for the assets to be able to have that flexibility to reflect those into their bids as well. I want to close on this question as I think that the challenge that I think we all recognize, and I think the ISOs on the panel would certainly agree to, is that it does take time and money to develop these capabilities for each technology, and again, the software may not be able to handle some of these complex models. So it comes down to how do you prioritize, whether to focus on advanced combined cycle models versus advanced hybrid or storage models or advanced demand response and so forth. And that's a challenging assessment. The thing that I think we've been thinking about a lot is that, a lot of times there's some cost-benefit assessments that you can do to see, who's going to be using this. How much benefits would we see in terms of economic efficiency or reliability? Are they required? And sort of use that to help prioritize and, think through, what's the cost of developing the software, what's the cost of the stakeholder discussions to get to a point where everyone agrees upon, how many people will use this, how many market participants would use this, and sort of, thinking about those prioritization processes, because, it's, we always hear complaints of, oh, why aren't we doing this, why aren't we doing that, and we should recognize that it does cost money, and sometimes we build some fancy models that aren't used or may not have the benefits that are realized. So it's important to recognize the benefits are there in these granular technology-specific models, but we need to think about who's using them, the priority of which ones will provide the most benefit in terms of their usage, and also the computational issues. We don't want to build something that eventually we won't be able to solve our models in time. So, thank you.
Thanks so much, Eric. Next, I'll call on Jinye. Please go ahead.
Thank you. I just want to add a comment regarding the energy storage model. So currently in the ISO New England, in the day-ahead commitment as well as intraday commitment, we sort of use so-called self-management of state of charge model for energy storage. So meaning these commitment model really don't track the state of charge for energy storage depending on their clear the charge and discharge solutions. So far it has been working well in ISO New England. And however, the concern is if in the future there's a large influx of storage resources entering into the market, so we are talking about more than 1,000 megawatts of storage into the market. So it become a little scary that the commitment software don't have a very good visibility of storage state of charge. So this is sort of call for we need to develop, enhance the current storage model to have a ISO management of SOC type of a model for storage, in addition to the current self-management of state of charge model. So Eric mentioned earlier, we need to sort of view the trade-off, which kind of enhancements we should do first. I feel it all depends on each region's resource mix. And then I think for New England, depending on the penetration of storage resources in the system, maybe we are forced to sort of have to develop some proper SOC management model for storage resources. Thank you.
Thank you so much, Jinye. Next, I'll call on Arnie. Please go ahead.
Yeah, just to respond very briefly to that last comment, I mean, I guess, again, as I said earlier, I think this whole problem is going to evolve very quickly toward management of state of charge, as storage provides a larger and larger proportion of these types of flexibility reserves or ability to meet net load variability over various timescales. So I think it's really important to incorporate state of charge into these models as quickly as possible, and I think we'll see storage development happen maybe more quickly than people might have expected. At least I would have said so before some of the supply chain issues have emerged recently. The last comment I'll make on this is that I think we'll see a proliferation of various different configurations that we should also be prepared for. So we're already seeing lots and lots of solar and storage hybrid projects in the Southwest, and those have different amounts of, or different ratios of storage capacity to solar capacity and different ratios of storage duration. We're seeing hybrid storage and thermal resources. So we'll need to make sure that there's a way to have those reflected in the market models and optimized and be made available to the system. Thank you.
Thank you so much, Arnie. I'll call on Song again. Please go ahead.
Thanks, Alex. I want to follow up with Eric's comment on the challenges. I really emphasize the computational challenge when we enhance the resource modeling. That's something we experienced when we developed the enhanced combined cycle model. We have to limit the number of configurations because of computational challenge. And also, although we see very promising benefits from the optimizing the stable charge pump storage results through the research, computational challenge is another difficulty. That's why today, like in New England, with our energy storage resource model, market participants also managing the stable charge by themselves. So that's really an important piece. We need to look at it on the computational side. Thank you.
Thank you, Song. I'll now ask a follow-up question. Many of you have mentioned the challenges of implementing a lot of these software solutions, and a few of you have commented on the costs of those solutions. We've also heard in other panels about there being a difference between where the software is now and where we'd like it to be, and the costs associated with getting it there. And would any of you like to comment on the costs to introduce some of these enhancements, especially in light of where current RTO and ISO software stands and the industry conditions around software upgrades, getting contractors to perform software upgrades, et cetera? Any comments on the theme of the cost of some of these? George, I see you have your hand raised. Please go ahead.
So, although we cannot give you comments about the costs specifically, but, it's one of the market enhancements that you have to perform to improve your market. And it's always something that you can do, a lot that you can do to improve your market. So there's no shortage of enhancements you can do in the market. You just have to prioritize everything based on importance, what benefit versus cost analysis you can do, and how you can provide a better service to your market participants and to your operators, and in our case, for reliability functions, because we're also the reliability coordinator. So all of this will have to come together, and I think the cost, unless it is prohibitive, it's justified if there is sufficient benefit to it, and it's all up to really ranking your projects and placing the proper significance based on the outcome that you expect to have. So I think cost, unless it is really prohibitive, it's a secondary consideration. We're always struggling having the right priority among the initiatives. Thank you.
Thank you, George. Eric, I see your hand raised. Please go ahead.
Yeah, I think, obviously that cost is going to differ based on software vendor and everything else. The one thing I would definitely encourage is that when doing any of these cost-benefit analysis on an advanced participation model, as an example, or any sort of software change, I guess, well, maybe in particular to the technology ones, is to have some sense of what the participation might be. So, of course, we can look at, throwing lots of, these technologies on the system and, look, we'll save millions of dollars. Getting some feedback from potential market participants and existing market participants. Will you use this? Will you participate and factor that into what the benefits are? And then, I think that can help in terms of the benefit side, and then the cost side, of course, can be evaluated with the software vendor. And also stakeholder time, because that's not something to be ignored, is that takes a lot of time from stakeholders and the ISO and the analysis and so forth.
Thank you so much, Eric. In the interest of time, we'll now move to our final question, and I'll turn it to Tom to ask that question. Tom, please go ahead.
Thanks, Alex. So the final question: can multi-day-ahead market or hour-ahead markets help address operational flexibility needs in RTOs and ISOs? What's the objective of such approaches, and are there potential drawbacks? So if you're interested, I see George Angelides. Go ahead.
Thank you. So I think we provided, every panelist has provided sufficient justification here for hour-ahead markets, multi-interval markets in real time. I'm not going to comment on that anymore, but on the multi-day ahead, I have some comments on that. So from a market perspective, a multi-day ahead setup is really useful only if you have what we call very long start resources in your system. So it's really ISO specific, because if you have resources that take more than a day to start up from a cold state, you cannot really optimize them with a 24-hour market. So extending the market for future days will provide you the opportunity to commit this optimally. Now, you have to weigh in the benefit of that versus the implementation cost and the performance cost of having additional days in your day-ahead market horizon. And it also depends, as I said earlier, to how much capacity you have in your system in these resources that they need this market treatment. And there may be alternative ways to commit these resources through an out-of-market process. That's not the best case, but if you only have a few resources like that, maybe it's a good compromise. Now, this is from the market perspective. Now, there are other reasons why you may want to run a multi-day market, and that is reliability. You may use the advisory results for the additional days to do a reliability assessment of needs for your system in terms of coordinating outages. If your system is stressed for a future day, you may need to postpone outages. So there is some outage coordination work. You may run a reliability analysis with contingency analysis to identify weaknesses that your system may experience in future days that you need some time to work on. So these are functions, that relate mostly with reliability coordinator, which, in our case, in the California ISO, we are actually using the results of a market to run reliability coordinator functions and assessments. There is operations engineering groups that they look at the results for future days and then perform analysis and studies. So from that perspective, they're useful. From a market perspective, again, it's really dependent on how many very long start resources you have. So you have to weigh in everything. Thank you.
Thank you. I think Erica was next. Erica.
Yeah, I was just going to kind of an interesting comment. We had a panel session maybe a year ago with some ISOs that was called 15-minute day-ahead markets versus multi-day day-ahead markets. Which is the one that's better, or something like that? And it was just kind of an interesting, perspective. And we got in some good conversations there. But I thought, one of the things that I try to do that I thought I would just mention for this discussion is I use this exercise where I think about, if you had infinite computing power and infinite data availability, what would your market model look like? And it, might be you'd have 1 second intervals, with a look ahead of a week or a month ahead, and multiple scenarios and everything else. But then you sort of look at that and say, okay, I don't have all this data, I don't have all this computational power. Which of these things should I take away that provides the least benefit, but maybe has the greatest, doesn't have the data to support it, or will have the greatest impact on computation? And I sort of keep taking these things away to see which will lead to the greatest benefit. So it's almost like solving, getting your optimization problem. You have to do an optimization problem and say, what's the most value I can get, subject to the fact that I have finite data, finite computation time. So that was just nothing in specific towards the multi-day ahead and hour ahead, but I just wanted to provide that quick comment as kind of a useful exercise that helps us sometimes.
Great, thanks. That's very meta. You have to optimize your optimization. Okay, I think Song Song was next. Go ahead.
Yep. So MISO currently doesn't have a multi-day ahead market or hours ahead market. I was actually waiting for George to comment on the hours ahead market. But we are actually looking at a multi-day ahead market, so I'll add more on top of what George said. So objective of such market is really to better procure resource availability and provide better market signals for resource to schedule their outage, procure fuel, or even schedule external transactions. Especially important for a RTO like us with a tightening supply margin and the big amount of long lead units. However, I want to note a few challenges we are identifying. The computational complexity is a big one, given the longer look-ahead horizon. And then the resource offer accuracy and also other input quality are also challenging, like even the topology or transmission constraints. They are all affecting the quality of the market outcomes. And finally, the market mechanism need to be carefully defined so that the market can help procure and commit long lead units, but also we maintain flexibility with shorter lead units so that we can wait until get closer to real time to schedule those units as uncertainty reduce. So before we get to a multi-day ahead market, as a pre-step, we currently provide a multi-day operating margin forecast to our market participants, really to provide them the better visibility of system conditions and also help them help their scheduling of outage and other planning. Yep. Thank you.
Thank you very much, Song Song. Arnie Olson next. Go ahead. Oh, I think you're muted, Arnie.
Thank you. Just very quickly, there is already a lot of information out there to the market to help inform multiple day ahead commitment decisions in terms of the bilateral transactions that are priced on ICE and some of the other platforms. I'd also just note that we're moving more and more towards a world in which there are fewer of these 3-day ahead start type of machines and more machines that can start very, very quickly. And then the last point I wanted to make is that I think seems to me that some of these multi-day initiatives are, as what George said earlier, really aimed more at a reliability problem than a market efficiency problem. And I want to make sure that we keep those two problems separate in our mind. In particular, in ISO New England, it seems that the fuel security issue is really, to me, more of a resource adequacy issue that they've just had difficulty addressing through their forward capacity market. And so perhaps the multi-day ahead fuel security initiative is a way to address that sort of lingering issue coming out of the capacity construct, but it is, as George said, a reliability issue and less of a market efficiency issue.
Great, thanks. George Angelini, next, go ahead.
Thank you. I just wanted to respond to Song Song. I guess he was expecting some comments on the outer head market, and I didn't comment on that. So yes, the outer head market is important, as you know, we all said, for positioning resources, but there is something special about the outer head market, and this is intertie schedules. In the California ISO, we do have intertie bids, intertie resources participating in our market. And although this can participate hourly and in 15-minute intervals, and our hour-ahead market observes 15-minute intervals in the hour, so you can have a different schedule for each 15-minute interval of the coming hour. Most of our intertie resource participation right now is hourly, so they need to be pre-scheduled hourly. So the hour-ahead market has the ability to schedule intertie resources before the hour so that they can tag by T-20 is the latest time that they can tag. And then the real-time markets that run for that hour after that, they keep those intertie schedules fixed for the entire hour. So this is one function that the hour-ahead market can provide. So you can continue optimizing internal resources, but your interties are already fixed by some hour-ahead market that you ran earlier. Thank you.
Thank you very much. Okay, with an eye on the time, I may turn it back to Alex to bring us home.
Thanks very much, Tom. I'll turn to the chairman and commissioners for any closing remarks they may have first. Chairman Glick, any closing remarks?
I don't, Alex. I just again want to thank you all, but also thank the panelists for the good discussion today.
Thank you very much, Mr. Chairman. Commissioner Christie, I see you've rejoined. Do you have any closing remarks? You might be on mute, Commissioner Christie, if you're talking. I can't hear you. Okay. Well, with that, thank you all for this excellent discussion. Thank you to our panelists and Chairman Glick, Commissioner Clemens, and Commissioner Christie for joining us. We're going to take a short break and regroup at 3:15 p.m. to start panel 4. Panel 3 panelists, please sign out of the WebEx meeting. If you'd like to continue watching the conference, you may use the public webcast link on the conference event page at FERC.gov. Commissioners, please stay signed in to WebEx over the break, but mute your microphones and turn off your cameras until we resume. Panelists for panel 4, please sign in to WebEx. Thank you again, everyone.
Hello, everybody, and welcome back. Thanks for joining us again for our final panel today. My name is Bob Hellert-Dawson. I'm from the FERC's Office of Energy Market Regulation, and I'm going to be joined by my colleague, Emma Nicholson from the Policy Office. This panel, we're going to discuss out-of-market operator actions that the RSO and RTO operators currently take to address net load variability and uncertainty and the impact these actions have on prices and incentives for resources to submit offers that increase the operational flexibility available to the operators. These out-of-market operator actions include unit commitments, relaxation of modeled constraints, load forecast adjustments, and other actions that alter operations away from the calculations made by market software. As FIF white paper issued last month on this topic noted, ISOs such as CAISO and SPP have stated that out-of-market operator actions can undermine price formation. Let me take a minute to remind all of our participants to refrain from discussing the specific details of the pending contested proceedings listed in the supplemental notices issued on September 3rd, September 12th, and October 7th, and to refrain from any discussion of other pending contested proceedings.
If anyone does happen to engage in such discussion, my colleague Adam Alvin from the Office of General Counsel will interrupt us and ask the speaker to avoid that topic. So thanks everybody for joining us today. I want to start our first question aimed at our ISO panelists. And if you could please describe what kinds of out-of-market operator actions your ISO currently takes to address net load variability and why. Have these actions changed or increased in recent years? And if so, what has driven the increase? Let me first turn to Laura Rausch, who is the Director of Settlements at the Mid-Continent Independent System Operator. Laura.
Good afternoon, and thank you to the Commission for today's conference and the chance to join the discussion. At MISO, we do value and appreciate the power of market incentives to support resilience and reliability of the grid. A focus of our market design team is to continue to enhance the market products available to support the needs of our operators to keep the lights on and maintain system reliability. But at the end of the day, out-of-markets, and especially the use of out-of-market procedures as we approach emergency conditions and under emergency conditions, are a critical tool for our operators to manage through the uncertainty discussed in earlier panels and to manage day-to-day reliability. These out-of-market tools we have found have limitations that should be addressed for market efficiency. They have impacts on efficient pricing, a lack of transparency when the resources themselves are deployed, and procedures which, by their out-of-market and last resort nature, create inefficiencies. One of the barriers that we've experienced, and as we have seen an increasing use of emergency procedures and emergency out-of-market procedures, is not that these out-of-market resources have no value. In fact, we found these resources are a key part of resource adequacy plans for our membership. But the combinations of uncertainties which we've discussed through this day around load and generation, long lead times for many resources, including emergency-only out-of-market resources, and a lack of transparency that we've seen in out-of-market resources where we don't have the 5-minute updates on status, and tend to compound, coming together with bad case scenarios at the worst possible time. At best, these actions lead towards overcommitment of resources, and we don't have perfect transparency or tools to precisely dispatch these resources over the long durations that could be required, increasing those market efficiencies that I discussed earlier, and causing us to inefficiently deploy use-limited resources. As asked in the question, these inefficiencies are becoming more concerning as the number of emergency-only resources grow in the MISO footprint, both in the sheer magnitude and the share of the reserve margin which we rely on to peak load needs. We've also seen an increase in emergency-only resources, or emergency-only events, which cause us to rely on these more. Ultimately, the ideal state at MISO would be to design and modify markets to remove barriers and create incentives for emergency-only resources, such as load-modifying resources, or LMR, and in particular, long-lead emergency resources to be committed and dispatched through market operations. This paradigm enhances market efficiency through greater transparency, and it still allows us to recognize the value of resources which can respond quickly and are by necessity located behind those emergency procedures. I'll thank you for the time today and look forward to the discussion.
Thank you, Laura. Let me turn next to Chris Bassard, who is the Shift Manager for Real-Time Operations at the California ISO. Chris, go ahead.
Hi, Bob. Thank you for the intro. As Bob said, I am a Shift Manager at California ISO. I've been at the ISO and in operations for about 18 years, and I can speak directly to some of the manual actions that operators take. We do some of these things on a daily basis. I could talk about some of the most common manual actions that we take. I probably would start in the day-ahead time frame. Our day-ahead process, day-ahead market closes around 1300 time for the following day. In real time, we do a operations planning analysis of the results. We have engineers that evaluate the results, and they look at the next force contingencies, coupled with all the scheduled outages and forced outages for the following day. And if we see any issues as far as exceedances on system operating limits based on the day-ahead results, then we would manually commit resources as needed or decommit resources. The ISO, California ISO, is currently working on a more automated process for this. It's called the Day-Ahead Reliability Tool that looks at a more granular 15-minute time frame for day-ahead. Currently, we have it's an hourly market, and on a 15-minute basis, we'd be able to capture more of the volatility and ramping changes that could occur that an hourly market doesn't capture. In real time, we routinely use load forecast adjustments to balance the system. That's kind of our tool to keep our ACE, our area control error, and frequency within limits. If we have, say, a solar ramp off that's unforeseen, besides AGC units that are on regulation on AGC that will automatically respond, our manual action in that case is to change the load forecast up or down to respond to something like a solar deviation. If we had fires out here in California, we have fires frequently. It appears that climate change is rearing its ugly head, and we're having drier, hotter conditions out here. So we have fires that develop around our import lines that interrupt our import capabilities. So in responding to something in real time, we might do a load forecast adjustment in that case. For similar reasons in real time, we may change generation commitments that are from the day-ahead results or from our real-time results that are generated on a 15-minute basis. For example, if the 15-minute market produced a shutdown of a resource that was economic, but our operators identified a reliability need to keep that unit on, they would block or change that commitment from a reliability standpoint. And then kind of the final thing I'd mention is that we routinely also change the output of generators, individual generators manually for similar reasons, for reliability purposes. If there's heavy flow on a circuit that's not accurately represented in our market model for whatever reason, we may change the output of an individual generator or generators to unload a circuit in that case. Similar with a fire. If we had a fire, we may make kind of an urgent emergency phone call to individual generators to bring them online. They're outside of the market results. So thank you for having me, and that's all I have.
All right, thanks, Chris. A lot of great information. Let me turn to Yasser Babaz, who is the Manager of Reliability Coordination at Southwest Power Pool. Go ahead, Yasser.
Hey, good afternoon. First, I want to thank you and thank the Commission for hosting the topic. I think this is an important topic. As you mentioned, SPP is involved in some of the filings to make sure that SPP as a BA and as an RC that we ensure that the reliability has what it needs, and we find ourselves in, especially after the recent winter events, the best way to go about that is to make sure that there's market incentives. There's the most straightforward way to make sure and incentivize what you need. As SPP, we are BA of 51 gigawatts of load with a capacity of wind of 30 gigawatts. That's a fair amount of wind capacity, renewable. About 99% of it is wind. And as a BA that I've seen, 82% penetration peak of wind. We do struggle with a fair amount of uncertainty that we have.
Yasser, I think we might have lost you. Can you hear me?
All right, I'm back.
There we go.
My phone drops every once in a while. Okay. So as a BA that has a high penetration level of wind, we do struggle with a fair amount of uncertainty, considering the relative amount of wind penetration that we have in our footprint and the size of the BA. And we don't see that changing anytime soon. That's probably is the case for a lot of the entities, a lot of regions in North America. The amount of generation interconnection requests for wind and solar is increasing to even larger amounts. And so we think this is an important topic and an important initiative that we need to do. So in fact, SPP deploys what we call an uncertainty response team that talks about basically on a daily basis looks at the amount of uncertainty that we project to deal with, and then the bulk responsibility of this team is to recommend some amount of capacity of generation that needs to be online, whether it's online or quick status or quick stay or quick start type units for the BA. And these are all recommendations that are made out of market, and that's because we don't have a product that specifically deals with the uncertainty. Uncertainty is basically any uncertainty that we may have in the forecast for renewables, any uncertainty we have in forecast for the ramping of the wind, we must deal with as BA to make sure that we're reliable. And so that is, from our perspective, considered an out-of-market action. That's the first type of out-of-market action I'll talk about here, and that has to do with unit commitment. So we'll commit units sometimes out of a study, economically out of a study, but that's after we adjust the forecast to make sure that we do have some capacity, some excess capacity in our market coming out of the market to deal with this uncertainty in case the uncertainty does materialize. And in the cases when it doesn't materialize, obviously the outcome of that is that those generators that were committed may not have been needed, and that results in price suppression and essentially those resources may need to go through a make-whole payment, and that's the at least way from our perspective to ensure price transparency in the market. Second type of manual out-of-market action that we do take is what we call load offsets, and that's more in real time. So we do load offsets, obviously adjusted to obligation before real time, but we do it in real time also, and that's another function of the type of generation that we do have. The renewable generation we echo in real time, and as an echo, RTBM runs 10 minutes in ahead. So when you get to RTBM and you echo in 10 minutes and pass wind, and if the wind is changing, you do have that lag of reflecting the wind capacity, and that causes some volatility, especially when the wind is coming up or going down. And that essentially forces the operators to make sure that the BA is balancing, and they do put in some offsets in the system. And those offsets are needed. They're not perfect. They're often not perfect because it does require really proactive action and staying on top of them, and not to mention being accurate. And so that is a manual action, operative action that we do take. Last out-of-market action that we take is what we call an out-of-merit energy. And this has to deal with, we can do this for various reasons. For the most part, it's done for congestion. If there is a volatility, and a lot of the time it is from the renewable generation, and RCs are not comfortable with the amount of volatility that they're seeing on the constraint, they will issue an out-of-merit energy, and that's essentially an operating instruction, regardless of economics. And that can result, obviously, in that is directly an out-of-market type action. They'll do it, but often we do stay on top of them to make sure that it's done once they get in, that they get out of it fast, because they need to get to some sort of steady state and get out of those type of action. They do also do that for non-dispatchable type variable energy resources. We do have some of those, and those are considered out-of-market action that we do take. So a fair amount. There are various types of out-of-market actions. Most of them are to deal with uncertainty and the lack of a product for those uncertainty. And that's one way SPP is addressing that, is introducing market products that we can declare an amount of energy that we need for uncertainty and make sure that that product is compensated for for generation that we may need and commit in studies. So looking forward to a good conversation, and hopefully that gave some high-level introduction to what SPP does.
Yeah, that's great, Yasser. Thank you very much. Let me turn to a set of questions that really are for all of the panelists here. What impacts do out-of-market operator actions have on price formations in the RTOs and the ISO energy and ancillary services markets first? How often do they occur? Do you expect the impact is frequently material? So, for instance, several ISOs have suggested that out-of-market actions can inappropriately depress market prices. Like, how often or how much does that happen? To your own individual experiences and to what you see more generally in the markets in which you operate, that would be great. I'd like to give the other three panelists, of course, a chance to talk first on this one. So let me start with Liam Baker, who's the Vice President of Regulatory Affairs at Eastern Generation. Liam.
Great. Can you hear me okay?
Yep.
Great. So real quick intro. Eastern Generation, we're owner-operators, about 5,000 megawatts between New York City and PJM, and price impact. So, in a nutshell, we see out-of-market pricing impacts bigger problem in PJM than in New York. As far as, and I talk in more detail, but as an owner, the reduction that out-of-market, out-of-merit actions take, it impedes the ability for accurate price formation, right? And that's directly correlated with suboptimal market outcomes. And when you have suboptimal market outcomes, I have less predictability, less stability, and less reassurance that my investments in those assets will have an opportunity to be rewarded. Where we've seen a reduction in out-of-market, out-of-merit actions, particularly in New York, they've done a good job over the last 20 years. We've invested accordingly. We've responded to reductions in out-of-market because we've seen better price formation. But in other markets in PJM, they still have some work to do, as we know. But for us, I don't want to hog up the mic, but for us, really, it's about where am I willing to put my capital to work? And I'm willing to put capital to work when I have a reasonable expectation the prices I'm seeing and the market products I can provide are being informed by something that's closer to, workable competition and not the actions of a system operator.
Okay, thank you, Liam. Up next, let's have Noha Sidho, the Chief Investment Officer of the Therapist Fund. And you're also here on behalf of the Energy Trading Institute. Thank you very much. Go ahead, Noha.
Thanks for having me today. Yeah, out-of-market operator actions and load biasing, they're harmful for both long-term and short-term efficiency of the market. In the short term, these actions are often opaque and cost implications aren't known for several days. And therefore the market responds, similar to kind of what Liam said. In the short term, it's muted, or there's lack of participation in the market because there's too much uncertainty. And in the long term, it's difficult to incentivize investment in infrastructure and research and development of new technology when those costs are not transparent. So from a reliability perspective, these out-of-market actions are often necessary, but there needs to be a market mechanism to price these operator actions and provide that additional transparency. Operator actions must be priced into the LMP and ancillary services. The creation of products like the imbalance reserve product at CAISO is a step in the right direction. The ORDC changes that are adopted in some markets and still in progress in others are also a positive step. We also think a secondary reserve market where reserves above the minimum reserves can be procured and priced would also be beneficial to the progression, or sort of what we've been saying is like LMP 2.0. There's also just more work to be done in this area. I think ancillary services are often overlooked and they're a critical tool in an operator's toolbox. I'm really appreciative of kind of the Commission's focus here. There are also a few pivots that I think that the Commission can make in short order to kind of get us to a more expedient solution. For about the last decade, there's been a really strong focus on capacity markets. And as noted in the March and May 2021 technical conferences, capacity markets are great for resource adequacy, but they don't incentivize necessary investment in new technologies, battery storage, additional flexibility. So we really kind of need to refocus. And we also need, price signals and incentives for clean energy and a reliable grid kind of have to work together. So I think some of that cost transparency, very similar to what Liam was saying, you know, we're going to put our dollars where we can see what's resulting in those prices, including emission costs. And I know some of that is out of the Commission's hands, but still something to be mindful of. Value of grid services needed to manage the grid, and energy and ancillary services have to be co-optimized in both the day-ahead and the real-time market. We also really need to view reserves a little bit differently. So our assessment, should it just be focused on a single severe contingency? You know, I think it was Arnie on the last panel said, you know, there seems to be reliability issues, and kind of hinted at a little bit of a stronger focus, especially for the gas issues in the capacity market. But really, I think we need to be thinking about all the uncertainty we've been talking about today. Renewable forecast errors, load forecast errors, and how do we price in that flexibility and those other attributes. We also really need to increase coordination between demand response at the LDC level and the RTOs and ISOs. State programs often incentivize very necessary GR, and that's a significant benefit, but the ISO just sees it as missing load. And this can have the effect of depressing prices when the ISO has called on additional resources. So the impact is high out-of-market payments that are unhedgeable to load, and therefore result in higher prices for the consumer, and then low real-time prices and a lack of transparency about that responsive DR. So I think some of those like state-federal coordination efforts that the Commission is starting to undertake are positive. In some markets, we see a significant out-of-market payments, and we don't have a really robust day-ahead market. So that's another thing that I think it would really benefit the Commission to focus on, is making sure we have a robust day-ahead market. In MISO, for example, as they started integrating wind, virtual transactions were a great indicator of the amount of wind that was going to show up. But in some markets, we're paying really significant uplift. And as a result, you're not getting that robust day-ahead signal from the competitive market. The same is true in SPP. And then while New York has done many things well, they're still zonal in their day-ahead market, which really doesn't allow for that really granular price signal to the market. And also then ensuring you have a robust forward curve. And I think FTRs are also a key product to this transition. You know, London Economics recently did a study for PJM, and one of the things that they found was between 2017 and 2019, the majority of the combined cycle units that came on as part of their financing arrangements utilized FTRs. So really you have to have, if you want to gain this market efficiency and maintain reliability and investment in R&D, you have to have a good short-term price signal, transparent prices, and a good long-term price signal. I look forward to the rest of the discussion today.
All right, thanks, Noha. Let me turn now to Bill Fields, who is the Deputy People's Counsel for Maryland's Office of People's Counsel. Go ahead. Thanks.
Thank you. Thank you to the chairman, commissioners, and staff for the opportunity to be on this panel and for reaching out to customer groups to be included in this technical conference. I'm Bill Fields, and I'm Deputy People's Counsel with the Maryland Office of People's Counsel. My office is active in CAPS, the Consumer Advocates of PJM States, although today I will be speaking just for my office. CAPS is certainly very helpful in getting an understanding of issues like the subject of this panel, although CAPS would have to go to another level to be truly able to be versed in the technical aspects of this discussion, so my comments today will have to be higher level, but hopefully will be helpful. Many retail customers are hedged for the rates they pay month to month, although in retail choice states like Maryland, there are policy initiatives for customers, including residential customers, to pay variable prices that reflect short-term wholesale electricity costs. As we've seen recently in Texas, that can be very risky for customers. In Maryland, many retail choice customers pay monthly variable prices, which can reflect price spikes in short-term wholesale markets. Whether the retail customer is hedged or not, unnecessarily high wholesale costs will still have an adverse effect on customers. For the most part, retail customers see costs such as uplift costs as part of the aggregate of all markets as they show up in their bill. So any response to those, to having those costs, should create efficiencies in total to ensure that there is a benefit to customers. in other words, looking at this issue in a small context, as sort of an issue-by-issue basis, may lose the forest for the trees, in that you're trying to solve one maybe small problem, but creating larger costs in total. So that should be carefully considered in any proposals where we hear about pricing operator actions into the market. I think that'll be all for an initial statement, and look forward to the rest of the discussion. Thank you.
Thank you, Bill. Thanks, everybody. Let me take a moment here if anybody has any responses to what we've heard so far. Go ahead and raise your hand, and see if we can take you in turn. All righty. Laura, looks like you're the first one. Go ahead.
I think I would just repeat what has been said. From the MISO perspective, we have seen that out-of-market actions, including some described by our peers, can lead to price suppression. Not surprisingly, our independent market monitor has noticed that as well. And so we've looked at how do we enhance scarcity pricing based on our evaluation, based on his recommendations. Some of these things are exactly what was discussed, looking at the operating reserve demand curve, what is the appropriate value of lost load and loss of load probability. Recently, we've done some changes to have more administrative options to go and make sure that when we do some of these out-of-market activities, such as implementing load-modifying resources, we're valuing at least those megawatts in a way that is reflective of market value. So creating emergency offer floors to avoid price suppression when we have the new megawatts from LMRs enter our market. Also looking at revisions to fast start resources to define what is fast start are crucial, both based on out-of-market actions and also because some of these out-of-market actions require several hours of lead time. So making sure that those mesh together is important. Administrative floors may not be our end goal. In fact, we are still looking at this, but it is an example of how we need to look very carefully at what are the tools and make sure that our tools to maintain operational reliability end up supporting market efficiency as well.
Thanks, Laura. Noha, looks like your hand's up. Why don't you go ahead?
I just wanted to touch on something, and obviously I echo Laura's comments, but I wanted to touch on something that Bill mentioned, which is, making sure that we're not increasing prices for the consumer. The way I look at it is, for load, uplift is an unhedgeable cost. We saw that in FERC's investigation in the 2014 polar vortex. LSCs that were largely hedged in terms of energy market prices that faced extremely high costs associated with the uplift payments. The same thing happened in ERCOT in this last winter storm. Folks were hedged, but then they had the really, really significant uplift payment. So I think minimizing some of that stuff actually really ends up saving the consumer a lot of money and allows the load to offer those fixed price contracts at a much more efficient price for the customer.
All right, thanks, Noha. Sort of related to that, Bill, let me follow up with you a little bit. So you're, as a customer representative, so what do you see are the trade-offs between that loss of market efficiency in the short run with out-of-market operator actions and the actual cost savings that might come out of it? So, for instance, if you were to be incorporating more of these actions into the actual market optimization, it might be raising the LMP, for instance, whereas paying just a single unit outside of the market could actually be cheaper for consumers. Is there a way that you sort of balance that trade-off of short-term market inefficiency and not necessarily sending the right efficient price signals versus a straight-up perhaps savings to the consumer?
Yeah, thanks. This really touches on an issue that's frustrating for some of us on the customer side in dealing with these issues and dealing with the and being part of the stakeholder process. Is a lack of information on how different proposals, which may sound reasonable viewed as singly, but how do they actually impact what total costs are going to be for the customers in whole? So that would be the first point, is that it's very hard to make these kind of assessments with the limited information that, a single a stakeholder, especially one, coming from a state consumer advocate office, is going to have to make that kind of analysis or judgment. I think another point would be thinking about how does this actually incent, or what resources are being incented by this, and what are they being incented to do. We have concerns about approaches where if you just are increasing a reserve requirement in a way that keeps units spinning and available all the time in order to deal with an additional need for flexibility, well, perhaps that's not really rewarding flexibility, and it's actually paying inflexible units. So I think, we think about, is this going in the right direction of providing incentives for the units that the system really needs to maintain reliability? And after all, these out-of-market actions are the system operator needed for the system operator to retain reliability. And we have to recognize that the markets are based on simplifications of what's going on in the real world, if you will. And so these actions are going to be taken, and maybe even to think about them as out of market may not be always the right way to think of them, because it's just part of running the system. So I don't know if hopefully those thoughts were helpful. It's a hard thing to judge kind of how it's going to benefit or harm the consumer in the end, but those are some of the things that we consider.
All right, thanks. Yeah, that's definitely very helpful, Bill. I appreciate it. Any responses to that, or any other hands up? If not, I have a follow-up for Liam. You're on notice. Deals. So how do the out-of-market commitments affect Eastern Generation's business and operations? So one could argue that there might be little downside to getting paid via uplift if you are committed outside of the market, since your costs are going to be covered. Can you tell me if that assumption is even correct, for starters? And second, what would you prefer and why? Compared to an out-of-market commitment.
Well, I guess if you're at the gravy train, you like it, and if everybody else in line, you don't like it so much. In many cases, our experience, and I'll pick on New York, even though I said they're doing a pretty good job. I don't want to be like a paid infomercial for Mike DeSocio. Now, they've done a really good job over the last 20 years improving things and reducing out-of-market commitment. They still do that, but they do it for reasons that are kind of odd. They'll do it for fuel security commitment, and that's all at cost. And they'll do it for other very local reserve requirements, and that, again, is at cost. Because of old market power rules in New York City, I have to offer most of my products at cost or at zero. So as an investor, and we are investing in new technologies, particularly batteries, I want to see accurate price formation. You're only going to do so well for so long as someone's just covering your costs. Like New York has done a very good job in driving uplift down. Uplift for the last several years has been persistently negative or zero. Unfortunately, I can't say the same for PJM. In PJM, what we see regularly, and PJM, to their credit, recognizes there's an issue. They're working on it, fully support that, and appreciate the efforts they've made, and we're all familiar with some of those dockets. And they're doing that because there is a consistent sort of bias towards over-procurement in the day ahead, and that has a downward impact on pricing. And my point back to anyone who would be asking is, of the operators, what do you need, where do you need it, and when do you need it? Okay, why'd you pick that resource? Why is the security constraint commitment algorithm that we've heard so much about earlier today not picking the one that you did? Why do you not have 100% faith in the dispatch? We know no dispatch is perfect, but if you can't answer those questions, like what's the what? Is it reserves, regulations, the fuel security, and the where and the when? If they can't be modeled because you don't have sufficient accuracy, then, to Mr. Field's point, maybe the combination to promote security is, in addition to increase and improved granularity around securing those products you need, and no dispatch is perfect, and we don't have machine learning super duper computers, sometimes you need additional surplus. You need some, but for certain products in certain locations, but no one likes paying for a necessary surplus. But the alternative, not maintaining reliability, is totally unacceptable. So, like New York is working on this, additional granularity, additional locational, attacking the problem in very specific areas, especially with intermittents coming in a big way in very congested load pockets. But it's really going to be the combination of those two. Until we have 100% accuracy and the crystal ball or the 8-ball, or whatever it is you want to call it, the day ahead, you're probably going to have to live with some additional level of surplus to supplement when you're not right. Okay. So the long answer to your short question is, in New York, it's predominantly at cost, and it is what it is. And in PJM, I would submit that it's generally negative, because we have very efficient peaking facilities in PJM. When you fast peaking facilities go, you have a combined cycle, highly efficient. So I want to see good price formation. I don't need the gravy, and then the gravy, it's not even that good. That's the short answer.
All right, thanks, Liam. The gravy's a little bit lumpy, I guess. Let me follow up with one question, and then I want to turn it over to Emma so she can ask a couple. But we've heard you're never going to get rid of all uplifts. So do we have a sense, and maybe this is more a question for the operators, is sort of what uplift is just always going to be okay? What out-of-market operator action is going to always be okay? Is there a hierarchy of things we ought to be aiming to make sure we get them into the market? And then after that, again, this is, a trade-off of how much money do we spend on trying to fix problems up to the point where the cost is higher than the benefits. There are things that we should be aiming for to integrate into the market, and then and then what can we sort of let go because we just know we have to have it as uplift, as out-of-market action. Any thoughts? All right, Yasser, you got a hand up. Thanks. Go ahead.
Yeah, I'll have a go at that. So, yeah, I think, and I'm not hearing that we should eliminate. I think that's probably a perfect world. Eliminating all out-of-market actions, right? Because there will always be, likely always be, circumstances that we didn't forecast or didn't project the day ahead. Things happen, right? And so, to the extent that we can project a need the day ahead, or as long as we can reflect those needs in a product, I think that's probably the best we can do, at least from where I sit. There will always be market operating out-of-market actions that things just happen in real time. Transmission elements strip, RC's got to react, and they have to take certain actions. And those we want to minimize, but there will likely always be out-of-market action need. But I think we can greatly minimize what's done today through various products and through price incentivizing or through designing a price formation that is better than what's done today. So.
Thanks, Yasser. Yeah, Chris, go ahead. And then Noah will have you after him.
Yeah, I totally agree with what Yasser said. I would just maybe add on top of that, one thing I see in California is, and we have an initiative for this, and it is a more granular day-ahead market. I think I opened it, or I mentioned this in my opening statement, but at least for us having we have errors in the day-ahead time frame compared to real time that I believe are forecastable. That we do have the means to foresee and to take care of in the day ahead. But I think having a 15-minute day ahead, like we're trying to do in California, would help this a lot. That would more accurately represent the in-hour ramping capabilities that we need, that we see in real time. And I think it would instill confidence from an operations standpoint, and it would more accurately represent what we're going to see in real time.
Thanks, Chris. Go ahead, Noah. You are muted.
Hi. somebody has to do that first, right? So I echo what Chris says. The more granular the product, the better. The more confidence you have in the system. Also, the more ability for the operators to kind of purview things and see what the model is telling them. Same with granularity in the day-ahead market. I think that stuff is really important as well, and making sure we head in that direction. Bill is right. There's always going to be some level of out-of-market actions. Like Yasser said, transmission elements are going to trip. There are going to be some things that happen that we just have to deal with in real time. But I really think the closer we get to accuracy and granularity and the more effort we put into those things, the better price formation that you get that Liam and other investors are looking for. He's not the only one. And then really we get better prices across the board. And that just has to be a strong focus. I think it's kind of fallen by the wayside. And we've had some interrupted focuses on price formation. But I really think we're at a point, particularly post-Texas, where we've really got to do something about this now. We really have to improve our models, our technology, and develop the appropriate market products for this. I do feel like industry has really been grappling with these issues for some time, with not a lot of tools in the toolbox. I feel like PJM has kind of gotten picked on a little bit, but they've wanted to make some of these changes for a while, and they really struggle with the stakeholder process. Things like transmission outages, for example, in New York ISO, if a TO doesn't properly schedule their transmission and they cause congestion on the grid, they have to pay for it. I mean, that's not even a starting point in PJM. And SCP, I know, has really struggled with this issue as well, as getting proper outage scheduling, making sure they can model those things in. So a little bit different, but also, I do really feel for these ISOs. They sometimes want to make these rule changes and they just can't. So that's really where we need the Commission's help on some of these issues as well.
Snellhaw, I think Yasser's ears were burning. Go ahead, Yasser.
I want to just add to that, and specifically to something Liam mentioned with, I work closely with operators as a reliability coordination manager, and I can tell you that trust in the system is not sometimes something that they can afford to do. It's one of those things where if you get burned once or twice, they often are very gun shy to wait on the system, to trust the system's going to do its thing, right? So we're internally working on a few things as short as like very short-term uncertainty thing, and just make sure that the operators know what's coming in the next 30 minutes, how transmission constraints are being solved in the 30 minutes ahead market, and trust the system. Don't overreact and take action right away, thinking that something that's maybe a generator that's going to come on in 10 minutes is going to solve the problem for you. Don't worry about taking out-of-market action now. And so there are some things that we can do even in real time to make sure that it's about the appropriate modeling, and it's also making sure that we give the systems a chance to do its thing. So trust is a big deal for operators, and in their eyes, they can't afford to take a chance. And so that's something else that I know we're working on, and probably the other RTOs too.
Thanks, Yasser. Chris, I see your hand up. Why don't you go ahead?
Yep, 100% agree with Yasser. And I would give another example that we run into from a trust standpoint that I know is not good from a market standpoint as far as manual intervention. That is regulation, AGC regulation procurement. When we have volatile solar days out here in California, we have our peak solar output, I believe right now is it's around 12,000 megawatts, 12 to 13,000 megawatts peak. And on a cloudy day, if we have a slate gray day, which is not that common in California, but if we do have that, it's fairly easy to model and expect what we're going to have for solar. But when we have these more fluffy clouds over a region that are fast moving over regions and stuff, we can have on a 5 to 10 minute time frame, we can have 1,500 megawatts, close to 2,000 megawatts on a 5 to 10 minute basis ramp off and then ramp back up in the next 5 minutes. And I think what we grapple with at California ISO sometimes is we look at the statistics from a market standpoint and we say, well, that only happens rarely. I don't know what the numbers are, but that happens rarely. So we don't need to procure extra regulation. But then we run into this trust issue that Yasser is talking about, that the operations, we say, no, we do need to get the regulation. That's our only tool that we have right now at this point in time to respond to those solar deviations like that. And if it happens 2 days out of the year, that's enough. The impact from a reliability standpoint is severe enough to where operations says, no, we need to get that extra regulation. Even though from a market standpoint, well, it rarely happens, it's only 2 days a year. So that I just wanted to offer that.
Yeah, that's good to know. Thanks, Chris. Let's go to Liam now.
So, having no experience in either one of your markets, gentlemen, but it sounds like you just answered my what question. You know, for Chris, the what is reg. For Yasser, the what is fast ramping, either online or fast ramping reserves that can come online to support wind as it trends down. You know, so the question you got to kind of wrestle with, maybe not you all, but your market operations, market design group is, all right, well, how do we promote price signals for people to respond with at-risk capital to build these kind of assets or invest in existing assets to provide those market products? Because if you want more reg and you only have X amount of resource provided, well, that you only have X, so maybe you need to say, okay, we'll send a forward price signal if someone's actually going to invest in something that can provide reg, like batteries or like, God forbid, a peaker. But for fast ramping reserves and SPP, it might be a unit that says, look, if I take the next upgrade package from GE or Siemens or Mitsubishi, I can improve my ramp rate. I can upgrade to the next distributed control system for improve my ramp. You know, I can bring an old mothball GT back that it has a 10-minute return. You know, those are the kind of things people will respond to and put money at. And so that's why. And I feel your pain. We don't have hardly anywhere close to the amount of wind that you guys are dealing with or solar, but if you believe the goals, we're going to have that one of these days, you know. So the operators will be struggling with the same kind of things you're struggling with, but I think now is the time to sort of start asking those hard questions.
Thanks, Liam. Yeah, those are good points. Emma, let me turn it over to you to take on some of the next questions here.
Thank you very much, Bob. We really appreciate the questions you've asked so far. You've answered so far. One question I have is I really appreciate the frank comments from our operators. We understand that you get a lot of, if you do your job perfectly, you almost get no attention or applause, but if there are issues, you certainly get a lot. So I understand your driving desire to keep the lights on, and conservative operations. And of course, we can see the points from our market participants that would like more transparency and better, stronger investment signals. We'd love to hear from the group of what is sort of a threshold level of out-of-market actions that might warrant in-market response, so might warrant implementing market reforms. We've talked earlier how we know we're never going to have a situation where we have zero out-of-market actions. That's just not feasible with the CFD system and the kind of systems operating conditions happening so quickly. But can anyone inform us on as to when are out-of-market activities significant, frequent, or material enough to start bringing them in the market and consider bringing them into the market, while also considering how expensive and timely it is for stakeholders and RTOs? What is sort of the threshold level of when you realize that an out-of-market action is significant enough that we need an in-market solution? So any thoughts on that sort of threshold? And I understand reasonable people can disagree on what that is. It'll be helpful for us. And I think, Liam, you still have your hand raised, or maybe it was last time?
No, I just real quick, I mean, the way in which we've measured it in New York, and I think that, again, no cheerleading, but it's a function of uplift, right? I mean, we used to have really outsized uplift, and customers are paying that. And as Noah said earlier, it's something that they can't hedge, and they just got to eat it. And no one likes paying for something that can't shop around for. So I think, to answer your question, you know, what's the threshold, or how do I make that? But how does that equation get addressed? You know, to move something out of market into in market, it's what's my uplift to the customers currently, and And is it de minimis, so it's not worth the effort, or oh my God, that's a lot of money, and and it's not going away anytime soon. We need to commit the effort to, to improve our market design and to build that system necessary to start pricing that attribute.
Thank you very much, Liam. Noha?
Yeah, I would say it's a combination of uplift and the amount of investment that you're getting in the market. I mean, you heard Liam clearly say at the beginning, look, New York ISO doesn't have this. We're throwing our money there. We're a little bit, more cautious in PJM because we're not getting the right price signal, and that's what we really want is better price formation so our investors can have some comfort. I mean, I can tell you as somebody who talks to investors on a daily basis, they don't want to hear that you're getting a side payment. That may go away. Those rules may change. They want to know that the prices in the market that you're transacting in are accurate prices. And that's really the only way you're going to incent some of this investment, and you're also going to get better R&D. People aren't just going to invest in what they know, they're going to invest in what's next if they have some price certainty. So I'd focus on those two things. You're also hearing some of the operators say, not to put words in their mouth, look, we don't have all the necessary tools, and that's why we're trying to make these improvements in the stakeholder process. And so I really think it is sort of incumbent upon the commission to say, okay, we're going to try to make it easier for you to make those changes when you can't overcome all the hurdles in your lengthy processes.
Thank you, Noha. I think we have Bill Fields and then Laura Roush.
Thank you. Yeah, I wanted to just, in response to that question, reiterate the point that, from a customer perspective, we look at it or at least I try to look at it in terms of is there going to be efficiency here in terms of total cost? And I think that's what, to some extent, I think maybe what other people were getting at. If you have a small level of uplift or something else, maybe it's not worth it. But when you look at the potential market solutions, it should be a primary consideration of whether this is going to reduce total costs. If there is uplift cost there, maybe it's true that LSEs, load serving entities, can't hedge that, and they don't like to pay that, and uplift would get factored into retail offers or standard offer service or polar prices. But if you price something into the market, that's going to get factored into those retail prices, retail costs as well. And maybe it's an easier pass through in some way if it's part of the market as part of uplift. I don't know, but one way or the other, I think it's getting passed through to customers. And so I would say that for us, a primary concern is going to be whether you're getting a more efficient solution from a total cost basis to the customer.
Great, thank you very much, Bill. Laura?
I think just to put a different twist on what others say, there's a lot of different ways you can look at this, and ultimately it is the most value delivered to the customer. And that really means that from MISO's perspective, we have to align with our members on what those costs should be, what should be the price formation, what should be cost allocation, communication, what are our roles. My life before settlements was in resource adequacy, and when you're talking about long-term resource decisions, market aspects are a portion of that, but there's a lot of other things that MISO doesn't own and should not own that come into play with that. The other aspect I'll mention is I think it also depends on what you think the future will have. It would be no surprise to anyone on this call that judging what tomorrow's operations will look like by today's events or last year's events is going to be very short-sighted. I think we've all seen more extreme events. We all want to use different resource types that somewhat change our operating paradigm at the end of the day. And for MISO, that's why we're looking at something we call our reliability imperative, which is how do we look at what our market should look like in the future? This is materialized in resource availability and need. This is materialized in larger market redefinition products. And so portions of this is less what is our current uplift, but what needs do we see coming in the future? And this has led to things like our introduction of a short-term reserve product that will go live in December based on what we think tomorrow's needs will be. So I think it's a very complicated question. And the viewpoints that are on this call are the ones that we need to, because it's not something any one market participant, any one RTO can make a solo determination on.
Great. Thank you, Laura. And Noha, I would love to follow up in terms of you asked if the Commission can help with the stakeholder process, and also I think we heard that from other folks. This is a challenging process. It's time and resource intensive, and oftentimes difficult to get things through the hurdle. We'd love to hear from you, Noha, if you have any suggestions, and it's fine if you don't, and how the Commission could help with the stakeholders to facilitate or streamline any of the stakeholder processes that would make incorporating out-of-market actions or market reforms more generally easier to get through.
Absolutely. I think when the Commission provides guiding principles, as you guys do in any rulemaking, that is a good starting point for the stakeholder discussion. So we're not arguing about should we do anything at all. We're more arguing about the details of what we're doing, and I think that at least gets us through a good portion of that discussion. Just really making sure you guys are clear and, okay, we want to see this level of out-of-market action or this level of uplift as a goal. What do you guys need to do to get there, to get a just and reasonable rate for customers? And what types of products, too, incentivizing those products. So saying things like you have to have a short-term reserve market that is above and beyond single contingency planning, so something similar to what Laura was mentioning. Or, kind of heading it in that direction with the granularity of the product. Things like, hey, New York, you've been zonal for 20 years. Maybe it's time to go nodal like the rest of the market so that we're getting a more granular price signal. Things like that are all hugely beneficial.
Thank you very much, Noha. Does anyone else have any comments or suggestions to that question in terms of making it facilitating the stakeholders or any other anything the Commission could do on that regard? Yasser?
Yeah, I just want to iterate something that was mentioned. It's important that we don't look at just what's today, right? And so I think Laura mentioned that and others mentioned that. And so I think it's really important, especially, I mentioned how I think the grid is changing everywhere else, just not just SPP, but we need to make sure that 5 years from now, 10 years from now, we have the essential products, right? Because it's just ramping today. It may be inertia tomorrow. It may be other products that inverter-based type resources may not be able to give you, or you may need to incentivize them or require it one way or another through your resource adequacy process to make sure that you have what you need coming into day ahead and real time or the operation horizon. And hopefully, that ideally, that maps to a product, right? That maps to a product with quantifiable requirements that have prices set with them, right? So you have a certainty product, you have an inertial product, whatever. And so ideally, that is where we ideally should land. And SPP is, we're looking at this, and especially after the winter event, we were doing some work before then. We were looking at it from a reliability attribute standpoint and what does SPP need in the future, considering the different futures that we're looking at. So it's ramp, it's inertia, like I mentioned, it's Black Star resources, what kind of resources we need out there. Still to be determined whether that's going to be priced, what market we would have for that if we do have a resource adequacy market for it at all. But certainly in real time coming into operations and the market, they should all map to some product. Anything we require ideally should just be a requirement and a product. And that's the best thing that I think we can do and to minimize out-of-market action.
Thank you. Bill, do you have your hand raised as well?
Yes. I just wanted to agree with Noha's point, maybe add to it a little bit that the stakeholder process, I'm obviously familiar with the PJM stakeholder process. There's obviously lots of incumbent resource interest there in the stakeholder process. It's going to make it difficult in a lot of ways to get changes, and sometimes it's going to need a push in the right direction from the Commission to get those new type of initiatives to happen.
Thank you all. That's really helpful to hear. I have another follow-up question. We heard a lot of comments about demand response. Is the issue is that an issue that is limited to emergency demand response? Is the concern there that when they're called, they result in they reduce the prices, but it's not accurately reflected? I'd love to hear some more color on the comments, because we heard from a couple of different of you experts on some pricing issues with demand response, and I believe it was emergency demand response in particular, but please correct me if I'm wrong. I think Laura had some comments and Noha. And I see Noha, you raised your hand. Can we hear from you, followed by Chris?
Sure, and I'm happy to answer that. I raised my hand in response to sort of the previous question about just resource adequacy issues. And I think resource adequacy, obviously, incredibly important. You know, I think in 2012, the Commission held a tech conference on capacity markets, and back then it was a 90-10 split. 90% of the revenue is earned in the energy markets. Now it's probably closer to 70-30, if not more so, in the capacity market side. You know, just by way of reminder, when ERCOT went into this winter, they had a 43% reserve margin. They had plenty of resources. What I think we really need to focus on is pricing the necessary attributes that provide the necessary flexibility that the operators are looking for to manage this grid. And I totally agree with the officer. We have to think about what's ahead. In fact, I think I don't want to say failed to do that, but we're a little bit behind the ball of, I think, where we really need to be. But to answer your question, Emma, my comments about demand response is not necessarily emergency. Sometimes it is, but it's basically when the LDCs, so some state programs will offer significant payments to reduce, so at the retail level, but then the RTO really has no window into that. They're not getting communication from the LDC saying, hey, we've called on demand response, we're paying, they don't even need to say we're paying the maximum amount, but they, you know, here's how much we expect them because we're providing the right price incentive. And as a result, the ISO is seeing it as missing load. So they've called on more expensive resources, and so the out-of-market payments have gone up, but because the load drops, then the real-time price is suppressed. And so it just seems like missing load for the RTO, but really it was an appropriate program to have in place. It just wasn't ever communicated to the operators. So I think that's something that we just need a little bit more coordination on those efforts.
Thank you very much for clarifying, Noha. I'm going to hear from Chris next, and then Laura.
Yeah, in regards to demand response, at least in my chair when I'm on shift, if I utilize demand response, I totally get how we have demand response is a market product and it has a price, and it sounds like the expectation is it's dispatched in merit order or economically with other resources. The issue that I run into when I'm on shift in these cases on a peak day is much, if not all, of my demand response is buried behind emergency procedures and NERC criteria of EEA levels. And be careful what I say here, but when I'm on shift, declaring an EEA 2 or higher to dispatch something economically is not something that really makes sense from my standpoint. If demand response was not reportable or whatever as far as an EEA to NERC, and it was just another resource, then I would have no problem with it. But it just comes, at least at California ISO, when I'm on shift, if we're going to utilize demand response, there's a bunch of other baggage that comes along with it besides market pricing and market things. I don't know if that makes sense or not, but
it did. Thank you very much. Laura, can we hear from you, and then Yasser?
Well, I think Chris covered a lot of it. From a MISO perspective, we do have multiple forms of demand response, including in-market units and ones that are more behind emergency procedures. We see similar questions and concerns with what NOHA said and with what others have talked about with, do we have appropriate transparency into those resources? And so as we think about, especially in the future, where we might have more forms of demand response, including distributed resources, behind the meter generation, load modifying resources in general, I think there is a question on how do we move those to market, because a combination of long lead times and a reliance on NERC emergency operating procedures to access those is a very inefficient way to run a market, especially when combined with a lack of transparency, because we don't necessarily have insight into whether those resources have been called on for local load serving needs. And so we have less visibility we do than with market resources on how much will actually react or the incremental reaction to a given call.
Thank you very much, Laura. Yasser?
Yeah, I think Laura and Chris captured most of what I was going to say on demand response. I'll add another challenge. So I think of demand response as two tiers, right? So there's the market participating in demand response. We don't have a lot of those, and I know we have some, but they're not participating in the market. So when they don't participate in the market, as far as SPP is concerned, it's a load reduction. And the load reductions in themselves, they cause us a problem of uncertainty within that, so it's load that we projected it was going to show up, but it didn't show up by virtue of having a generator that comes on next to it, right? That's what demand response is. So to the extent that demand response comes in front of the meter or is participating with the ISO RTO to that extent that's possible, then it would be priced. The challenges with that, I think, is how distributed they are, right? And depending on what their point of interconnection is, and if we need to make sure that they're modeled on the right transmission, on the right point of interconnection, because it does make a difference in terms of transmission impact. All the other demand response, if it's not modeled explicitly in the market as dispatchable, then it does become what we call interruptible or curtailable load, and that is only accessible through emergency type conditions as specified by NERC, and that's the EA2 level that Chris was mentioning. So,
great, thank you. I have one final question, and given that I think we had heard before that it's sort of unreasonable to expect, just given the primacy of keeping the lights out now, how hard all our real-time, all ISO staff work to keep the lights on and reliable energy, and how much we appreciate it as load. Given that we are going to have certain level of out-of-market operator actions, that we won't be able to get them all into market, or simply just takes time to get into the market. We've heard some folks, including Laura, you mentioned it, say maybe as an in-between method, have an administrative price for those out-of-market operator actions. And I'd love to hear the group's thoughts on if that's sort of a viable approach, and maybe it's a short-run approach or sort of a reasonable means to address it. And then, of course, like the million-dollar question is, like, what would you assign? What kind of price would you, administrative price would you assign to that out-of-market operator action? So if anyone has any thoughts on that proposal, which we've heard from some folks, please let us know. And I think we have Liam Baker has his hand raised.
Well,
maybe,
I mean,
you do.
Yeah, no, I mean, just being in the New York City market, it's pretty much, it's a market, and we get made fun of a lot because it's a lot of administrative constructs kind of boil into one, because it's so heavily mitigated and so concentrated. So I'm very used to different flavors of demand curves for capacity, for reserves, for a whole host of things. And when they're properly designed, they can be very effective. And we've had that experience in New York. I mean, they can be effective. As far as, I'm no economist, but as listening to smart ones, it's a representation of how they value lost load. Now, it's not going to go from zero to the moon, because at some point you have to put a value on it. But, I mean, that's how I understand how, over time, the ISO has broken out the various curves, with the exception of capacity, which is based on, net cone. But that's how I understand it. And I think there's a time and a place for them, and I think they can be effective in the absence of having a more, I'm sure there's a right economic, term for it, or a more fluid market, a more workable market where you can't actually represent the true marginal cost, but a solid representation can be reflected in a curve. I do believe that.
Great. Thank you very much. Does anyone else have any thoughts on it? More administrative prices or associated with out-of-market operator actions rather than pulling the market as kind of an intermediate step? Right. Scanning our panelists, I don't think anyone does. Thank you again so much for your comments and your expertise on this important topic. We certainly understand as a commission that out-of-market operator actions are often an indicator of a potential need for reform, but there's a lot of other considerations. And I think you, as this panel, have really enlightened us and the audience as to what those are. Before we close, I just wanted to see if anyone on the panel has another comment or a question for their fellow panelists. Yasser?
Yeah, we can talk about this all day. But I was going to mention something, Liam's point about, a load reduction is the load loss, value of loss of load. And so to some extent, I agree with that. The challenge is that there are other steps in between before we get to load loss that are not priced, right? So we talked about the different emergency levels, and and within those emergency levels, there are several actions we take, including BA to BA assistance from our neighbors and curtailing exports. And so things that we need to think about is that how do we price those things before we get to the lowest of load? Because those certainly would be steps that we would take before we get to shedding any load. So anyway, so there are some logistical and some other, I guess, I won't call them administrative, but there are some other regulatory type steps that we do need to take and likely need to price, as well as demand response type action if we were going to price it as a price of loss of load.
Thank you, Yasser. Laura? I think you're on mute, Laura.
Thank you. It has to always be two in this, so I fulfilled the second role there. At the end of the day, MISO does believe markets work, so a lot of the responses to out-of-market actions default back to how can we get more resources into markets. We think that provides efficient signals to maintain reliability at the least cost, and a paradigm where we move emergency-only resources, especially long lead resources, really enhances market efficiency and transparency, helping our members and generators to make more efficient decisions. At the same time, market tools and services are constrained by practical limitations. As we noted before, we can't be perfectly accurate, and even talking about how accurate can we get, the market systems themselves can be a barrier in the implementation of tools because of limitations on computational and human resources to bring valuable reliability and market improvements. So as we look at MISO and balance some of these different competing factors, we are looking at how we maintain reliability via the reliability imperative, our market system enhancements. But at the end of the day, it is a conversation that we need to continue to have on how do we balance which needs to provide the best market signals and making sure that we're focusing on the right things at the right time to pursue that ideal state that we'll never reach but always strive for.
Thank you very much, Laura. Liam, did you have a comment as well?
Just real quick to Yasser's point, yeah, like for instance in New York, we have a series of steps when you're kind of in a pinch that are not priced. I mean, between public appeals and there's voltage reduction, there's all kind of things that the operators have the flexibility to take, and those aren't priced actions, and no one would ask them to be priced until you start getting to, your day ahead demand response, your emergency demand response, and then you start going into which are day ahead. It's mandatory, but they need notice, and in day it's kind of voluntary, but there's all different levels, but my point is that there's a lot of steps that we don't worry about pricing. You just have to accept that that's reality, and it's fine. It's totally fine. But when we get into the real time, when you're calling these resources, the ISO does have really good mechanisms to reflect that in the market, so you don't have, and it generally works, where you don't have the bottom falling out of the price when you're really up against it and calling your DR. But it doesn't always work. But there are a series of steps, many of which are not priced.
Thank you very much, Liam. Bill Field?
Thank you. Just wanted to make a brief point about value of lost load. It's a complicated topic. I mean, the value is different to different customers. A 1 hour outage is going to be different between a residential customer or potentially some industrial customers, particularly one that's unanticipated. Now, something multi days long or something more extreme is going to be different. So when you look at those, that as a number, just a sort of a caution to be thinking about what kind of customer you're talking about, and are you really getting the right answer for the system?
Thank you very much, Bill. Do you have any more closing comments from our panels? Oh, we do. Chris Bassard.
Thank you. Since we're talking about manual actions by operators, I thought, we're talking about kind of negative stuff here and how we can improve. I thought I might share from California ISO a kind of a success that we had, especially this last summer. As you guys might be aware, we had a brutal summer in the West and in California with very, very high temperatures, dry conditions, and a lot of fires. So the system was stressed. Our power grid was stressed for weeks and weeks. And one of the things coming into this summer that we were anticipating needing to have operators babysit and take care of is batteries, or non-generating resources, I believe, as we call them also. And babysitting them from the standpoint that when we get into peak and net load peak, they're fully charged. And that we're not, and I believe this summer, I don't have exact numbers, but I believe we were pushing 2,500, maybe close to 3,000 megawatts of batteries on our commercial batteries on our system. That had RA contracts that were being counted on for capacity. So there was a big concern that they'd be available fully charged to provide megawatts during peak and net load peak. And we went through quite a bit of effort company-wide to build a process and a tool that the operators would use to essentially, out of market, manually dispatch the units early in the day, late morning, afternoon, to force them to charge during the day when the solar's up and they're available at peak. Well, actually, the success in this is that while there was some growing pains at first, by midsummer, at least, we found that commercially the generators, the batteries had, I don't know what they did on their point, I'm not privy to that, but they were bidding and scheduling themselves to where they were charging themselves in the afternoon and for the most part fully available, fully charged during peak load time and discharged. It was a great success, I think, seeing it. So I just wanted to share that kind of positive thing.
Thank you very much, Chris. And to disabuse you of any assumption, I think we are all eternally grateful. We love electricity, and having this conference would not be possible without you operators. So I think we all understand that, how important your job is. And no one, I don't think we would accuse you of being bad, but we always strive to do better. And we really appreciate all the great minds here helping us try to continually improve these markets, particularly given the large changes that we all see at the horizon. In fact, ISO and SCP are already in the middle of large changes. And I think that's what, to you, both of all the ISO's credit, I think there's a general recognition that out-of-market operator actions can signal a market failure, and we see you independently work with stakeholders to address them through RAMP products and California's DAME proposal. So we certainly are really grateful for all the hard work at the ISOs and in the stakeholders to the stakeholder process. I really appreciate the panel today. I think, Noha, did you have another comment before we close?
I'm just going to thank staff for putting this together and for everybody for their input. And, I'm really hoping that we see some expedient action on these issues because, it's very necessary, I think, for us to get there. And, Chris, that's a fantastic story. It makes me so happy to hear that all of this is starting to come to fruition. I mean, that's investment in R&D from stuff, years ago now. So thank you, guys. We appreciate it.
Well, thank you all to our panelists. It's been a very illuminating day for us, this panel, as well as all the 4 panels we had today. I think we're going to go ahead and wrap up this technical conference. I wanted to thank, in addition to all of our panelists from all 4 panels, we had Chairman Glick, Commissioner Danley, Commissioner Clement, and Commissioner Christie participate as well. We're really grateful for your participation, and to all of our panelists on both days of this Energy and Ancillary Service Tech Conference. We really informed us a lot about this incredibly complicated and challenging problem, but we as staff are very heartened how many bright, smart people are analyzing this problem from different points of view, so we can crowdsource some really good solutions here. We expect, as is typically the case after a technical conference that the Commission holds, that we would issue a call for post-technical conference comments. When that happens, when and if that happens, very likely would be posted in docket number AD 2110. And I would also like to thank my colleagues in at FERC staff for helping put this conference on, which we had folks from the Office of Energy Policy and Innovation, Office of Energy Market Regulation, Office of Electric Reliability, Office of the General Counsel, Office of Enforcement, the Offices of Information Technology, External Affairs, and Executive Director. So it really does take a village, and we're very grateful to everyone for your participation. And I think that will close our conference, unless Bob, did you have any? Sorry. Okay. Thanks again, everyone, for your time today. We really appreciate it. And Capital Connection, you can close the feed.